Invest smarter, faster, easier. V Summit 2021, gearing up for exponential growth. Ladies and gentlemen, this is Pauline, V College Executive Director, as well as your MC for the 2 days. Welcome to V Summit 2021. Wow, before I start the session, I would like to see how many of you are here. Whoa, 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 wow. Okay, if you can hear me, some of you said no sound. So let me do a sound check with every one of you, yeah? So if you can hear me loud and clear, please type in your chat how you are feeling right now. Everyone, type in the chat how you are feeling. Let me know. Oh, some of you said, morning, great. Okay, some of you said you're feeling great. Sorry, the chat is running so fast. I want to catch some of you, but I couldn't do so. Thank you very much for all your responses. Good to know that you are feeling great and as excited as I am for these 2 days. Why? Because this V Summit has hit a three first. What do I mean by a three first? First, this is the first time that V Summit is going for like a double digit. What do I mean by a double digit? Because it's the 10th V Summit in 2021. The first one was way back in 2012, where we see only 500 packs in the V Summit. And of course, our community has grown tremendously and exponentially over the years. So much so that we hit a second first, which is this is the first time that we are seeing more than 2,000. In fact, okay, let me see the latest number. It's going to hit more than 3,000 people. Yes, in this V Summit. In the past, due to probably constraint of venue, or some of you reluctantly probably didn't want to fly to either Singapore or Malaysia, this time round, really, no venue, no space constraint. We can come over here and hit our third first, which is first time we go virtual. This is where at your comfort of your home, right, you can enjoy the 2 day summit. And of course, for those who have the all access pass, if you miss certain parts, you can still watch the video, the playback. Isn't that great? Yes. So this V Summit in gearing up for exponential growth, we have actually lots of case studies. We have invited experts from different parts of the world, from the US, Australia, and some of them from Germany, to join us for this summit to share with you more how you can get what we call like multi-baggers, having an exponential growth. And we have seen that 2020 is really what we call an unbelievable year. We have been through the first time, many of us. Even right now, we do have friends in Malaysia, correct? Not? Yes, friends in Malaysia. I know right now you are at home, okay? Now we are still having, some of them are having still the lockdown. And 2020, we are seeing it in terms of the COVID. And those who are looking at active income, probably they see like pay freeze, pay cuts, or even retrenchment. But you know what? Why I say it's an unbelievable year? For people with passive income and investors like us, really it's an unbelievable year. How many of you have actually invested like Fastly? Okay, say yes, yes. Invested like Lemonade, yes, please say a yes. You all must be very happy, right? Or maybe Square, Stone Cold. Okay, don't need to tell me how much you all have made, okay? Because me too, we will be sharing with you all these case studies. Yeah, I see. Matthew, you are laughing your way to the bank, is it? Then you say, Pauline, still got more case studies? Not got. But before we do that, some of you say video very blur and what? Okay, so because this time round, all right, it's the first time that we are going on virtual, there are certain things I've got to brief you. First, the communication channel. Now, we do have an official communication channel in our V app. So for those who have the V app, okay, you can go over to the V Summit 2021 bubble. Okay, go to V Summit 2021 bubble. All the communications will be there. In fact, the V Summit notebook will be there as well. And some of you are asking, what's the agenda for the 2 days? Yes, it is going to be posted there for you, okay? So just go over to the V Summit 2021 bubble. You will be able to see it. Download the slides even for our speakers. So for those who have not gotten your V app, this is what you need to do. Quickly have 2 devices, okay? So if you can, one device to watch us, maybe via your laptop, your table, desktop, and so on, from your monitor screen. The other one, what you do is have your phone with you where you can access to the V app, because straight away later on, the first speaker is going to share with you case studies. You won't want to miss all this analysis in the V app, all right? So get it registered. If you have not, go to www.vi.app. If you need to register for an account, a username, a password, do it right now, okay? If you didn't get access to the bubble, you can always put in the Q&A, the chat. Our room IC and moderators will be there to support you, okay? Now, for best viewing, yes, this is what you need to do if you want to have the best viewing. Go to settings, okay, and then click share screen. And over there, you should see on the right hand of the slide, okay, it is actually a print screen, a sample for you to get the best view, okay, so that you have the full screen. You do not need the panel, because we have done it in such a way that you can see the full screen, you can see both the slides as well as the speakers, okay? And if you can, uncheck the side by side mode, okay? So you can take a picture of that screen. So later on, if you think that, oh, I want to do it into a full screen, you can click on the respective buttons, all right? Now, if you face a lag, okay, this is something that you got to do. What you could do is to check out your speed. Go to speedtest.net and click on the go. If you have your speed the network speed at like less than 100 Mbps, probably you might want to think how to actually increase the speed, okay? What you can do is you can connect it to a LAN cable if you want to, all right? Or maybe go nearer to your Wi-Fi router and so on. And for best experience, go to the settings, okay? And then statistics. Go to the settings and statistics. Your Zoom video hopefully is at 1280 times 720p. Okay, so with that, you have actually the best view. Sometimes you see the resolution actually drop. Okay, you can let us know, because what will happen is over at Zoom end, sometimes the resolution might drop. So you might face with different resolution at certain time. The best is actually at 720p, okay? Yeah, right. Thank you for actually checking in terms of your Zoom statistics. And also, if you have not updated your Zoom, okay, not now, later on, probably you might want to, during the break or the lunchtime break, to install the latest version if you can, okay, so that you can have the best viewing and learning experience. And also for better Wi-Fi speed, internet browsers or any apps running behind, you might want to close it off, okay? And also probably won't have any form of a notification that actually pops up, right? Now, this is more the technical aspect, but of course, sometimes touch wood, let's say if the Zoom or the Wi-Fi over at our end is down, okay, what will happen is a new link will be sent to you via email within 15 minutes, okay, within 15 minutes. For whatever communication channel, it will still be on via 2 channels. One would be in the V Summit 2021 bubble in the V app. The other one will be via your SMS. Okay, so this is in the event that the Wi-Fi is down over at our end. We will send you the link via email within 15 minutes. Okay, so check out on that. All right, so the other part, how can you get the most out of this V Summit? I know many of you know the drill. You are all our graduates. Hey, I want to ask you this question. How many of you have been around with us, okay, for the past 10 years? All right, okay, so probably write down the number of years you have joined the V Summit. Okay, so 10 years one, put down a 10. If you have joined for like the past 5 years, or this is the 5th time, write a 5. If this is the 3rd time, write down a 3, okay? So we will know, wow. Okay, some of you first, oh, there's someone really 10 times. Okay, because I'm seeing the chat right now. Okay, so this is how you respond to the chat, okay? Yeah, so you respond to the chat, it will be to the panelists. Some of you say, but I cannot see how? Yeah, because we have like 3,000 over people. But what you do is when you respond, we can see your responses. Okay. Yeah. Oh, some of you 6. Okay. Who's Jacob? Hi. Wow, 6 times. Oh. And if you want to ask questions, you can see there's a Q&A part. You can ask questions anytime if you hear from some speakers. Okay. So we will do our best to answer the questions. But you have to understand, due to the time limit, our speakers won't be able to answer probably all the questions. Okay. On stage right now. So what we will do is they might pick 1 or 2 questions to answer, and for the rest, either we will reply you by our moderators, or we would actually pick those questions and put it up in the next few days in the V Summit bubble. So you can still continue to learn in the V Summit bubble, because some of the questions we find that probably they are quite good. Our speakers, our trainers, the experts might want to reply them online to you as well in the next few days. Isn't it great? Now with technology, learning doesn't stop, right? Yeah. And if you want to raise hand, there's a raise hand button. Sometimes the speakers might ask you, you want to raise your hand? So you can do the raise hand, right? Yeah. Okay. As I mentioned, celebrate the summit. And this V Summit is a 10th year anniversary. 10 year is really a milestone. How do we celebrate it? I'm not sure about the rest of the countries. We do have people from Singapore, right? Okay, those in Singapore. We do have people from Malaysia. We have our graduates and participants from China. Yes. Hello, 大家好。Yeah, 欢迎来到我们的价值投资峰会。Taiwan as well, yeah. And some of you from Malaysia Chinese programs, if you think that probably you have maybe some, you need some help in terms of English, okay, what you can do is this. Over here, because some of it are live, all right, because it's a live like sharing, we won't be able to put in the Chinese subtitles. But for those who have the all access, okay, when you watch the playback, there will be Chinese subtitles. So you can actually watch it again. That's the good thing, right, about the all access pass, and you can learn it again. So grasp whatever that you can from our speakers, because some of our speakers, they are from various countries. Sometimes there might be accent as well that you might not be able to catch it up front. It's okay. We would have subtitles for the playback. Okay. Yeah. So how do we celebrate the 10th year anniversary? Apart from it going virtual, we have this thing. Yeah, because in Singapore, Malaysia, in Asia, ASEAN countries, we love this thing called lucky draw. Yes. And our grand prize, 3888 cash. Yes, 3888. Right. How many of you want to win the $3,888 cash? If you yes, I saw a me. Everybody type in a me. Yeah. Okay, what can you do with the 3,888? So this is what you need to do, okay? When will we draw? I don't know. Sorry, I don't know. And I'm not going to tell you why. This is the reason why. You have to stay throughout these 2 days. No reason for you not to be here. Why do I say so? First, you stand a chance to win the lucky draw prizes, okay? So at which time we will draw, I'm not going to tell you now, okay? So don't miss that. Second, we have a lot of case studies. And when will the case studies be? Anytime. Yes, in over these 2 days, there will be lots of case studies, and these are money-making opportunities. So you won't want to miss that, which means if you ask Pauline, which is the part that you can miss, I'm sorry, I'm going to tell you, no parts that you should be missing, because you are here today to know how to expedite your wealth, okay, and having the exponential growth in 2021. And so right now, we are going to give you the first case study. So fast, yes, it is that fast. I'm going to invite the first speaker up on stage, okay? Yeah, to share with you case studies. He said he wants to give you 3 ang pao. You know, Chinese New Year is coming for those who knows about Chinese New Year, yeah? Okay, so he wants to give you 3 ang paos. And what are the 3 ang paos? We are going to invite our first speaker up on stage, Mr. Ken Chi, CEO and co-founder of 8V Holdings Limited. He is going to share with you about investing in a new decade. A warm welcome for Mr. Ken Chi.
Hello, everyone. Welcome to Value Investing Summit 2021. My name is Ken. I'm the co-founder and CEO of 8V. Very happy to be here to share with you my investment experience today. In fact, today is a 10-year anniversary of this event. I still remember 10 years ago, this idea was actually born in a small, tiny room in my father-in-law house in KL. One of the key reasons for this summit is because we couldn't find quality event back then in Asia. So instead of flying all the way to US, spending money and time and resources to attend event in US, we decided to create an event, especially focusing on fundamental investing and sustainable investing, okay, for the Asian market and for the community. The event was started 10 years ago in the auditorium, attracted about 500 people, and over years we've grown, okay, renting space in expos, catering to thousands, and today we're evolved in broadcasting here globally, okay, using our own studio. So we're very grateful and very blessed that we're able to actually share this journey with you. But all this is not possible without your continuous support, okay, in our mission and vision. And as a token of our deep appreciation, today I have prepared 3 ang pao for you, just for my segment alone. So are you ready to receive ang pao? If you are ready to receive ang pao, can you type in the yes, I want ang pao? Okay, by the way, in case you are not aware, ang pao in Asia or Chinese, okay, is a red packet. Usually we give out during the Chinese New Year period. Now, without further ado, okay, since some of you are new, okay, to this event, I think it will be appropriate for me, okay, to actually highlight on 2 things. First thing here is to give you a disclaimer. All the companies that I cover in my segment is not a recommendation to buy and sell of any financial security. You still have to do your own due diligence, okay, and seek professional advice. I'm merely here to share with you my perspective, and my view and opinion can be very biased. Now, the second thing is, okay, some of you might not know 8V, this company is actually a FinEduTech company itself, which I'll explain a bit more. Now, our vision is to empower growth and transform life. And our mission is to empower everyone, including yourself, sitting in front of the monitor screen right now, towards sustainable wealth. And this drives us the passion every single morning. Okay, 100 of us every morning when we wake up to think how to invest smarter, faster, and easier together with our community. So, okay, so what's the problem in the market? What are we solving here for our company? Now, there's a research done and show for the new generation, they realize that one of our top financial goals is about retirement. So with so-called stagnant wage rise and inflation, okay, and very low interest, so therefore the new generation and the current generation is looking at ways to make their money work harder, much harder for them. Now, we do also know that in the market, there are few asset class in the area of like real estate, stock, okay, and maybe bond for proper investment. Now, the challenge here is, okay, knowing the different channel to invest is not good enough, okay, because a lot of people do not know how to invest well and how to analyze them well. So that's where, okay, the market also know that technology can help them to actually simplify the whole process. So that's where we come in, okay, because in the market right now, there's a lot of fragmented provider giving different solution, and therefore, okay, as a customer yourself, you could be so-called confused which one to listen to and which one to actually to channel your money into. So therefore, our V ecosystem come to play, okay, and bridging a solution for you as a retail investor. Now, the whole idea here is to generating alpha for investor. What is alpha? Alpha, in a nutshell, meaning to say to generate a higher return from normal investment class or asset class that you are investing in. Example, fixed deposit rate, or what we call a CPF rate, okay, or a risk-free rate of a bond. So we want to generate even higher than that, okay, to outbeat inflation and to grow our money, to make money work harder for us. So how do we do that? We do that mainly by 3 main approach. The first one is called a Learn, where we have a V College, where since 2008, 12 years ago, okay, we started our education route because we believe education can empower and change life. The moment we have knowledge, our risk will become lower. I learned that risk comes from what you know and what you do not know. The more you know, the less risky you are. Okay, so therefore, by actually having the proper education system that we provide, okay, and the knowledge think tank, our mentees itself and the participant, okay, now have actually independent thinking and have more option, okay, in choosing where to put their money. Now, over the years, we also actually developed a V app where we Notice that because there are 70,000 listed companies around the world, okay? And which one to choose? So in the past, we had to actually go through tons of annual reports, okay? And it's a very painful process. Therefore, we come up with a technology platform called the V-App to crunch a lot of data into simple form so that you can understand which one to actually look at in less than 3 clicks on a button. And of course, okay, having the so-called knowledge and the tool, okay, is not enough. What if you can have a community that support one another, okay, and continue to build a friendship, okay, and also have the insight because of our different experiences and knowledge that we can form a think tank together and grow constantly, okay, in this journey together, okay? So, and does our business make economic sense? The answer is yes. Why? Because a lot of fintech companies out there, they are actually in the catchment model. And one of the key reasons here is because they spend a lot of money acquiring user or customer to use their product. So one of the fastest way they can do it is to give free, right? But I learned that in business, free is the most expensive thing. So therefore for us, it's very different because our upfront product, okay, the lowest product price range have already covered our initial, okay, customer acquisition cost already. So anything above that, okay, flow into the margin. So it makes economic sense for our business. And we have this actually what we call a flywheel ecosystem, where you can see that first, okay, let me just put my, okay. Yeah, good. Okay, you can see a laser pointer up. Okay, so now we have first established being an established platform and brand, been around market for 12 years. Okay, and we actually use our know-how to build into a platform to serve our customer, the user itself. And because of that, okay, we are able to actually to create recurring revenue. Okay, as our user believe in our product, they saw the result they use after using our product. Okay, and that give the growth of actually the V-App user base itself and the growth of community. Okay, to form the bonding, okay, effect. And from the intelligence that we gather from our actually community itself, it actually we built a network effect and eventually expand our so-called economics. And from there, we can actually create more unique services and products to actually serve our community better. And this will lead on to become a stronger platform and continue to funnel customer leads into the so-called ecosystem itself. So you can see this flywheel, okay, the more people we onboard, okay, the whole business itself it become more and more valuable. Now, who do we address to? Okay, now we see the market into 3 main tier. The first tier is, okay, the do it myself. That means, okay, usually they are very sophisticated investor. They have their own Excel spreadsheet. They might even use their own computer, okay, or algorithm they program to analyze. Okay, this segment is not our main focus. Our main focus is the second segment is do it with me, right? Do it with me is typically in you have a stable job. Okay, you do know the importance of investment. However, you also want to learn how to invest yourself, okay, but you want the knowledge and the tool and the community to actually support you. So therefore, this segment that we identify, the total addressable market, TAM in short we call, okay, in a market that we're operating in Singapore, Malaysia, Taiwan alone, okay, there are already potentially 5 million, okay, target audience, direct targets related audience. And when we actually combine with Indonesia, Vietnam, and China, which is untapped market at the moment, okay, we see a further extension of 35 million potential customer. So, and we barely scratch the surface of it because I think currently we're only reaching about 40,000 to about 45,000, okay, of the customer. So there's a huge so-called market runway for us to actually explore and go into. Now, the last segment that you see that do it for me, okay, is people who say, yes, I know the importance of investing, okay. However, I want you to do it for me. Yeah. So we identify this as a huge segment, and we are evaluating, okay, ways to actually to cater to this need in the future. But just from a do it with me segment alone is really very huge. Okay. So now let's take a look at actually our company, the FinErotech business. Does it make sense? Just from our gross margin, you can see that you have actually increased, okay, dramatically from actually 2 years ago, from 55% to actually 82%. This signifies a very good so-called operating leverage. That means, okay, we have a very strong competitive advantage in the market to serve the needs of our customer. Okay, and our operating income margin have actually improved, okay, from a negative 11%, okay, all the way to actually 35%. So once again, it proves, okay, our business itself, okay, is growing very well. Now, we also recently just reported our third quarter, okay, result, Okay, this is hot from the oven. You can see that just from the cash receipt from customer, okay, from the last 8 quarters itself, from 1.652 million, okay, you have grown to actually to 8.1 million. That is a 400% increase, 4 times increase. Okay, and from the revenue point of view, okay, unaudited figure, the last 9 months we have achieved about 17.7 million revenue as compared to the corresponding 9-month period last year. Okay, this increased by 153%. So you can see our model, our so-called business, the flywheel, okay, using digitization, artificial intelligence, and data analytics, and the community, okay, is actually proving, okay, by the financial result itself. And the cash, the latest cash position in the organization is about 16.4 million. So rest assured, this company is not a fly-by-night company, okay? It's growing very well. And the company has very little debt. In fact, I will say that no debt, okay? Now, so from a VApp perspective, okay, we can see that one thing I want to highlight to here, the effect of actually using technology. How do we scale? If you look at the first 9 months alone, okay, our financial year, we have really touched about close to 18,000 graduates. That means 18,000 people across Singapore, Malaysia, Taiwan, okay, and a bit of China have actually went through our program and start to use VApp. Now, as compared to actually exactly the corresponding period of a year ago for 9-month period, the whole year, okay, or last year, or 2020, okay, only about 4,700 people. So that is, I would say that it's about 3.5 times grown, okay, from here, okay. To me, I feel that this again is a testament to show, okay, even during COVID period, the most severe time, our business model stand out. Okay, in fact, the COVID is a catalyst to demonstrate our transformation, our business, okay, start to pull away from actually our peers and become a very attractive proposition in the market. So now, why do I say so? We can take a look because figure don't lie, right? So if we get all the fintech company listed in Australia, by the way, 8V itself is listed in Australia itself. So we pick up the main fintech company like PushPay, Afterpay, Xero, and actually WiseTech Global. First thing you realize here is, okay, the gross margin, okay, we are actually on the near to 80%. So already in the top mark range. Now the net profit margin with the highest, okay, is about 15.4% across the board. The ROE, return on equity, demonstrating how well, okay, a company can generate return from a shareholder, okay, is stand at an amazing, actually close to 49%. Once again, you can see this is top, okay, among the rest of fintech. Now, the earning per share in net earning before interest and tax margin itself, okay, is about 33%. Once again, we actually rank the top. Okay, free cash flow margin is actually stand close to 60%. Again, once you are top. So if you compare all the key 5 metrics, right? Okay, we have 4 metrics out of 5 is ranking the top among the fintech. Now, and what about our own valuation then? Okay, you see something very interesting. Now, you see that all the rest of fintech company, they are actually valued at much higher valuation than us. Okay, in fact, it's between 2 to actually 20 times difference. So in a nutshell, I think 8VI, okay, is a very interesting proposition. Okay, you might want to consider in your portfolio. Okay, why? So I say again, digitization. Okay, we have a unique ecosystem. The ratio makes sense. Okay, the financial metric makes sense. Valuation wise, as compared to the some other peers, okay, I don't think we are too actually premium. In fact, okay, I say again, we are 2 to 20 times, okay, different from our peers itself. Okay, yes, the number don't lie. Yeah. Okay, so now, and we also have just launched our website, okay, product website. For those who are keen to find out more about VApp, you can go to www.v.app. So these are the new site that we actually to share with you on each different part, okay, on how to analyze, learn, and connect. So this is the first ang pao for you. So how many are ready for your second ang pao? If you are ready for second ang pao, can you just type in ready in your chat? Thank you. Okay, come on, let me see. Okay. So the second ang pao for you is another case study. Now, some graduate will know, okay, over 6 months, the V community have actually highlighted company like highlighted like Lemonade, okay, Illumina, okay, CRISPR Therapeutics, okay. So and if you have invested in this company like our graduate, okay, in our V community itself, we have generated easily between 40 to 200% return. Wow. Okay, but I also have feedback from some of the graduate and actually my friends who said that, I missed the boat. Don't worry, okay, today the second about, okay, I think, okay, you might be interested to know about it. By the way, before I share, I have a vested interest in the company, the coming company I'm going to share, so I'm biased, okay? So now the question is this: have you ever fallen sick before? Okay, if your answer is no, then you must share me your secret, okay? Or your DNA is special. Now, most of us have fallen sick before, and what happened here is when you've fallen sick, okay, what happened? Usually you will do what? You go and see a doctor. Thank you. And after a doctor diagnose you, examine you, the doctor will give you a what? Okay, a prescription, and you take the prescription and will give you a medication, right? Now, this business, ladies and gentlemen, okay, is a very interesting business because, okay, I think, okay, somebody have thought of a very effective way to solve a very big problem, and that is what? This is the case study of Good RX Holding. Recently just IPO in NASDAQ in US itself. Now, what is the mission and vision? Their mission, stating very simple, is to help Americans to get the healthcare they need at a price they can afford. So keyword is this, okay, healthcare at a price they can afford, and to help Americans. And their vision is to build the leading consumer-focused digital healthcare platform, okay, in the United States. So therefore, we are very clear on actually their mission and vision, what they are doing. They're in the healthcare, okay, and they want to build, okay, at a digital healthcare platform to help the customer, okay, to get the healthcare they need at a price they can afford. So very clear, okay, direction they are heading. So now, but before we actually talk about the direction, okay, what is the problem in the US healthcare? Simply put, developed country yet, okay, have the lowest healthcare quality, okay, paying the highest cost. How come? Okay. Why do I say so? Because the data show that about 20 to 30% of prescription in US are not filled. Not filled mean what does it mean? It means that, let's say the Americans they go and see a doctor, right? Okay, the doctor say diagnose you and know there was an issue, right? Then they give a prescription for the drugs, right? Okay, 20 to 30% of this patient, right? They did not get the drugs. Just example, let's say some drugs you need to take it regularly, like let's say high blood pressure, right? So, but if you don't take it, resulted in what? Okay, resulted you will die, okay, because you didn't take the drugs to control your condition, right? So now, and they state that someone die every 4 minutes in US for not taking prescription medication as directed or at all. Now, and Good RX actually estimated they actually help 18 million of their customers afford to fill a prescription otherwise have gone unfulfilled. So I think in this case, very meaningful. And Good RX also help insured and uninsured customer to do that. Now, how to do that then? Before we show you the solution, let's take a look at how big is this market, okay, they are in. Now, the US healthcare market itself is 4 trillion alone, okay? And yet the total offering they can offer, they are actually directing about 800 billion. Think about it, 800 billion market size, okay, they can actually service. And currently they are scratching belly, I believe it's like less than 1% of it. Okay, I like it, okay, I like it. Okay, big, the market size is big enough. So why did this problem happen, okay, in the healthcare industry itself? Okay, let's get ourselves familiar with actually who are playing in the healthcare industry. First, you have the drug manufacturer, like who? Pfizer. Okay, you know what they do, right? Recently, the COVID vaccine by them, right? The Singapore government also bought from them. So now, and we have the Johnson & Johnson. Then next, we have the insurance payer. So these are the insurance company that represent their client, that who actually pay them premium, okay, to buy a policy to cover them, okay, and actually do a co-pay, okay, to look for doctors and actually to pay for medication itself. And next we have, okay, very interesting. There's this party that this is the first time I know. Before after I actually look at this company, it's actually called PBM, Pharmacy Benefit Managers. What do? They actually negotiate on the behalf of the insurance company with the drug manufacturer, okay, to actually get the discount, right? Okay, and they also work with actually wholesaler to bring down the price itself. So it's a very interesting relationship over, and of course we have the pharmacy chain like CVS, or Walgreens, right? So now, and the problem happened because it's super complex. I'm not going to go into details, okay? Because it really, you can studied tons of information on this, but I'm going to summarize this. Okay, there's a distortion of actually pricing for drugs in US because of the inefficiency of actually different party and who they represent, right? So because of that, okay, therefore the Group RX came in. They saw the issue. The founder actually have a problem. The founder many years ago, okay, diagnosed with a health issue, went to using a prescription, went to a pharmacy, discovered a drug very expensive, decided to go to actually across the street, another pharmacy, discovered the same drug is cheaper, okay, and went to another pharmacy and discovered the drug also the price is different. He was surprised. Different pharmacy at different location, the price is different, and he asked himself why. Okay, and the more he delved into this issue, right, he discovered there's a mega problem. And you know, right, in business, when there's a mega problem, there's a huge opportunity. So therefore, how did Good RX solve the mega problem itself? First, they come as a single access point, okay, with greater transparency and help the customer to save more money and create convenience for the customer. So how do they do that? Let's take a look. So first and foremost, okay, Good RX, okay, first target and the end consumer. That means the people with a prescription that see a doctor and need to buy medication. So now, able to actually help them to save money. That's very important because that's the first window where you can attract a lot of end customer into the platform. They also help the physician to do a better job because the physician, the doctor, right, they are more concerned about the patient well-being. So they want the patient to take medication, okay, on a regular basis to ensure that the health issue actually get better, right? So therefore, a lot of doctors actually recommend Good RX app to their patient to find the lowest so-called lower drug cost, right? And they also have the insurance company because when they found a lower cost itself, okay, these costs sometimes are even lower than the co-pay cost. That means co-pay means customer and the insurance company pay a certain portion, and the price is even way lower than the co-pay price. And therefore, help the insurance company to save money because some customers don't even use the insurance and use cash to pay themselves, right? Without using their insurance. So, and also help to actually drive footfall traffic into the pharmacy chain, okay? Help the PBM to actually tap on the new market they never knew that they can tap onto, which is an uninsured, okay, customer, which is a good portion of them. So now, and of course, help the drug manufacturer to actually target their product more accurately to the right user itself. So it's an all-win situation. So now, how do they do that? They do it by a very simple, elegant app. But I'm going to show you an example. Okay. So nothing beat by showing you a video how this whole thing works. So now let's go to a video segment.
Hi, Linda. Looks like you've got a prescription to fill. Any idea how much that's going to cost in there?
I'm really not sure.
Well, you're probably going to pay 2 or 3 times more than you should in there.
What?
Let me show you how I know. Most people have no idea that drug prices vary. The exact same drug that's $10 at this pharmacy is $150 at this one.
I had no idea.
It's crazy. But here's how to fix that. GoodRx finds prices and discount coupons on every prescription. Just go to GoodRx and put the drug name and instantly find savings at virtually every pharmacy in America. Best of all, it's free.
Look how cheap it is there.
It is. You should swing by and I'll just... Okay, great. By the way, GoodRx can save you money even if you have insurance. And it works for every member of your family, even pets.
Next. What can I do for you?
Hi, here's my prescription, and I have a coupon from GoodRx.
Nice price.
Thanks.
You're welcome.
Stop paying too much for your prescriptions. Yay. Find the lowest prices at local pharmacies with GoodRx.
So now you have a good understanding how it works, right? Simple, right? An app, search the drug, they tell you the lowest cost, create a coupon, go to the pharmacy chain, and that's it. You don't even need to actually have a security account number, right? So now, and the best part is because they are using the prescription way, okay, they're able to channel a lot of huge leads, okay, and user into the platform, and that lead on to an extended service like subscription. So now you can actually subscribe, become a member, okay, and you get even lower drug price itself, okay, and they can help the drug manufacturing company, okay, to identify, okay, what are some of the popular drugs that could actually lower the cost, okay, to actually reach out to more people, more affordable, and of course they bought a company actually providing telehealth. okay, which I think this is really a no-brainer itself. So you can see a series of things, okay, they extended their service to actually increase their revenue and actually the cash flow itself. Now, and how do they make money then? Okay, called GoodRx. You just need to know one thing. They take about 14 to 15%, okay, transaction fee every time they actually direct a customer into a pharmacy to actually pay for the drugs. Okay, that's it, right? Haven't even count the rest of the services. So about 80 to 90% come from this transaction fee itself. So now, and the good thing about this here is because currently they have about 4.3 million and it's growing, okay, at a close to 60% CAGR growth of monthly active user, okay, and because they take a cut, okay, with a repeat purchase, because you know drug is a repeat things, right? Most of it, okay, you don't buy, you know, don't even eat only once, but some of the drugs you need to take on a long-term basis. So therefore, okay, with the growing of the active user and the GMV stands for gross merchandise value, okay, you can see that it resulted their actually revenue growing by a CAGR of 57%. Wow, I have to tell you, this is really quite amazing. And they're actually the EBITDA, okay, which is earning before interest, tax, and depreciation and amortization, growing about 75%. Okay, pretty amazing, really. And just summary at one glance. Number one, okay, ad itself estimated help the consumer over the years save about 20 billion in drug costs. Okay, 15 monthly visitor, which out of which $4.2 million is active user. Okay, tie up with 70,000 pharmacy. Okay, and 2 million prescriber have a patient who have used the so-called GoodRx. So these are the doctors. Okay, we are talking about, I mean, pharmacists and doctors. Okay, yeah. So wide usage itself, 80% repeat customer. Okay, repeat activity. The latest one revenue is about $472 million. Okay, and 53% year-on-year revenue growth. Okay, and one amazing thing, ladies and gentlemen, I want to actually give a 2-star here, a 3-star in fact. Okay, 96% gross margin. Can you type in the WOW? Okay, I've never seen such a, I mean, seldom companies have such a good high gross margin. That means they are purely using their data to serve. Okay, now, but you ask me, so good, what's the risk, right? Yes, there are two main risks. The first risk is this. Okay, Amazon recently, about 2-3 months ago, announced they are going into the pharmacy business itself. So it's called the Amazon Pharmacy. Now, but if you ask me, I think you must actually acknowledge that Amazon, yes, is indeed a formidable competitors because they have more than 90 million, 100 million Prime members. Now, however, the business model is slightly different from actually GoodRx. GoodRx is actually a pharmacy marketplace, right? But Amazon itself is what we call a pharmacy company. So that is a different model altogether. But I'm not discussing that this also will pose a risk to them. Now, next is concentration risk. So they work very closely with PBM. Okay, that's how I mentioned one of the party, right? About 48% of their revenue actually come from actually 3 main PBM. So if you ask me, is if one of PBM stop the relationship with them, you affect their revenue actually growth quite significantly. But what's the possibility of that happening? Okay, is there, but is it high? I don't think so. Simple reason. Why? Because GoodRx have been actually bringing good actually revenue source for the PBM. They're able to tap to the uninsured case segment itself. Why would you want to kill a cash cow channel that bring business for you, right? So now, so next, the management. Let's take a look. Now, there are two co-CEO, Doug itself. Very interesting thing to note is formerly from Facebook and Google, Yahoo. Therefore, he's very social media marketing savvy. And GoodRx is very strong in the social media side. That's the reason why they're able to craft out a niche very fast over the last 8 to 10 years, okay, and actually captured a lot of users, okay, using a social media. Now, but what is their valuation and the price right now? Let's take a look. So now let's go to actually the V app. Okay, and I'm going to show you something quite cool. Okay, so for some new user I've not seen before, this is the V app itself. So I'm going to key in GoodRx. Okay, oops, sorry, wait, GoodRx. Okay, yep. So here we just tap. So look here. So first thing here is, okay, we tap on the risk rating. Wait, hold on. Okay, we know that, okay, GoodRx itself is medium risk. Now, take note that the V app itself is licensed regulated by MAS itself. So now we have actually analyzed many data points. Okay, so to come out with a conclusion here is this GoodRx at the moment is medium risk. Okay, and see the way they grow. Okay, their animal characteristic. This is a rhino. Rhino means they are They're strong, they're big, okay, but still able to grow and run. Okay. Now, in the past, it used to be gorilla. Now, I tell you, I know why recently it turned to rhino lah. Because recently they got listed ma. So they spend a bit actually on listing cost lah, and actually on compensation cost also. Okay. So, but one of the new feature here you will discover, okay, coming soon, you can track back at one glance to see how the company evolved over time, over the last 10 years. Pretty cool, okay. So, and next part is this. Let's go to actually the key ratio. Okay, like I said, look at actually their gross margin is at 95% here. Okay, 95% here. Okay, so and the balance sheet itself. Okay, one thing to actually take note, okay, is the balance sheet. Okay, which they do have borrowings about $700 million itself, but they have a cash of actually 1 billion. The 1 billion cash on the book. So can they pay off the debt? The answer is yes. Now, but I'm not too concerned about this because what I see, if you look at scroll down, right? Okay, their cash flow itself. You see the cash flow for operation. This part, right? The cash flow for operation have been growing from 45 million. You still see double up and nearly double to 133 million. This is a very good sign. Okay, and they have good free cash flow. So therefore, if you ask me, solid company with good gross margin, revenue is growing well, cash flow is actually generating, not burning cash, okay? And based on the valuation, let's take a look. Voila, okay? VF is telling me that actually they are currently slightly undervalued, about 6%, okay? For such a good growth company, I think this is worth considering, lah. Okay, for me, lah. By the way, I have vested interest, I'm biased, right? But I want to show you something even more cool, right? So, how many want to see that, you know, what is the latest thing that we're coming up, okay, for the V-app user? Okay, the latest feature. So I'm going to take this opportunity to show you. So let me actually now go into the V-app and let me log into the beta version itself, okay? Okay, done. Okay, now you see something very interesting here. When I click on actually the valuation, you see something that totally different from earlier on, right? Okay, some of you say, how come your valuation 2 is different from mine? That is the enhanced version. Let me explain. Okay, look here. Is this. So in the first VI line, you still see the normal valuation that we have, okay, for some graduate user, but we have add on something called a relative valuation approach. So for a relative valuation approach, right? Okay, you can track this company over the 3 years period, okay, but they don't have a listing 3-year period record. So maybe I will use Amazon better, okay, or Facebook. Facebook. Let's take a look at Facebook. Facebook, you will see it very clear. So Facebook, because Facebook recently the share price came down, correct? Okay, see. So if I go to actually relative valuation, you will see already something very interesting. So here, okay, the new version of V-app, okay, on the valuation is able to tell me, okay, at this current price over the course of actually the 3 years, okay, how did it perform? Is it overvalued? I can even okay, drag out, okay, and actually open up and see clearer. Say now, it will help us to see that, okay, at the current price is about $270, right? It hover between the medium valuation and actually high valuation range, right? So, and if we look carefully, right, on this juncture in the March last year, you can see that price 156, right, is even way below so-called the low valuation range. Okay, therefore, okay, no brainer for me to go in. So therefore, it gives you an even clearer perspective, okay, and help us to allocate how we invest in. Example, okay, maybe I want to buy at $245, okay, range, because it's a medium valuation over the last 3 years, right? But I want to place more order to buy more when it's $205. So that is the whole idea, okay? How many find this cool? You find this cool, can time cool now. And here we can adjust, we can adjust 5 years. If we want to look at 5 years track record, okay, we can even see it clearer, right? And okay, and that's not done yet, because we have different valuation method here. Okay, you can actually adjust to see, okay, what you want to see yourself, right? So now, but there's one more here is something called absolute. So just like I told you, relative is doing valuation over a span of time, right? Absolute means we want to look at the valuation at this point in time. So here I tap absolute, right? You see something even more cool. For those who like to actually do your own analysis and actually do your own assumption, right? Okay, more advanced one, okay? So you can do this. So now I want to see that maybe I want to analyze Facebook based on earning. Okay, based on earning, you can see based on earning, right? Okay, so now, so I want to actually adjust based on earning per share. Straight away, the VF able to come out with all the last 5 latest quarter, year to date, year to month, okay, earning per share figure itself. So you can choose. So if let's say I'm more aggressive one, I choose 6.25, right? So then straight away input. The discount rate, you can also change, but the current discount rate, we're using a default of US Treasury bond rate. And very soon, we actually will customize this to local country, your risk-free rate itself. And you can put in the predictable growth rate for the first 5 years, next 5 years. You can say that, oh, I think more aggressive. I think they still can continue to grow at, maybe example, okay, 29% on the revenue growth, right? Based on revenue growth, right? So for 5 years. Then on the terminal value for next 10 years, they grow by inflation, 2% growth, example. Okay, then you look, okay, the valuation straight away will change to 273. Okay, so now then you can save this. Okay, and the best part is you can go back to your history and take a look at, okay, you can create a series of history in the future, okay, to track back what valuation we have done, okay, by tracking this company every quarter or every 6 months or every year. Okay, you will find this is awesome. Can you tell me awesome? Okay, and then one more thing here is not only you can do this, and one more thing I want to show you is for those people who like dividend. I give one example, okay, let's say, okay, Viacom, okay, some of the Singapore investor like to look at Viacom, right? Personally, I invested in Viacom, so you type on Viacom, right? So Viacom, we go to valuation. Okay, look here. Let's say I choose based on dividend, right? So the new feature straight away will highlight all the dividend information, okay, that Viacom will give out at least for the last, I think, 8 to 10 years, right? And you can choose it based on including special dividend. You click in, so the special dividend, everything will also show. So you can check very, very clear, right? Okay, now, I like this feature a lot, really a lot. Okay, it helped me to understand the business valuation clearly, okay, so that I can actually make sure that I buy at a fair or undervalue, right? Okay, and you can do your analytics if you want. Don't worry, for the existing VApp user itself, okay, you'll be given a tutorial to learn we'll guide you how to use this new feature. And I know some of you have been asking already, when is this feature coming? When? Okay, so unfair, you're using it, you have an unfair advantage. Ladies and gentlemen, good news here is this. Okay, we are launching this on the 1st of February. Okay, you don't have to do anything, you just need to update your VApp, you will see this new feature. And the next good news is this. Okay, the price will not increase. It will still stay the same. Can clap or not? So that means you know that, okay, we are constantly making effort to ensure that we add more value to enhance the feature to make you help you to invest smarter, faster, easier. Okay, so let's go back to my slide. So since I'm already touching on the VApp, the new feature itself, I will now move on to actually the VApp technology development. And this is the part I'll give you the third ang pao. So are you ready? So if you're ready, just type in third ang pao, okay? So now just to show you in the coming year of this year, 2021, going forward, what are we actually rolling out apart from the new valuation tool, right? Now, the first thing is the V analysis and the screener notification. Now we have received a lot of feedback say that, Ken, I want to know, okay, quickly, okay, the moment in my company, in my watch list changes, okay? Now, I don't want to actually passively go in. I want to be actively informed. That is where our VApp right now able to send you notification actively to notice you and actually to warn you the moment the company you're looking for, okay, changes in terms of actually the characteristic. Now, that change can be positive or negative, so you can take action, okay, more immediate, right? The second one is, now the screener parameter that you set in, okay, that you want to screen out those good company. Now, a lot of you also say that, Ken, I want to set it once and I want to be notified the moment you can find, the VApp can find new opportunity, okay, without me actively going to search, right? This will also be launched. That means that you only need to set a screener parameter once, then the VApp will go out and inform you the moment new company to fulfill this parameter, okay, you'll get to notice first, okay? That will save a lot of time, right? And capitalize on opportunity even faster. Way faster than your peers out there, okay? So very powerful tool. Now, but this one, I feel is one of the killer feature that we have been working this for 1.5 years already, right? Now, some of you actually mentioned, say, Ken, the V risk rating, very good, right? The star chart, very good. The evaluation tool, also very good. But I want something even simpler, cannot? We thought about it. The answer is yes. And how do you make it simpler? How about we combine, okay, the V's rating and the star chart, okay, together as one score called a V score. So what this means here is, in a nutshell, okay, next time you just need to know, let's say example, say I want to know the top 3 or top 4 company in a sector. Like example, let's say technology, communication in technology one. Okay, so now I want to know the top 3 companies in this sector. So V-score will rank them accordingly, and you will straight away know which are the top 2 companies to look at, and the rest don't need to waste time. That itself really save a lot of time. The V app will do all the peers comparison for you without even you doing all the labor work. Okay, you find this awesome, because I love this feature a lot, really a lot. Okay, and of course we also will incorporate so-called your risk profile. Okay, understand whether are you what kind of risk, what kind of investor you are. So from there you're able to actually look at certain company that suit, okay, your risk profile itself. Okay, and of course compare with the sector. Are they overperforming, overvalue, or undervalue against the whole sector itself? Say coming very soon, right? Now, so in a nutshell, okay, so what is V itself is, first thing, okay, it's an investment idea, okay, is where every week, okay, our community itself will be coached. That means it's tutorial once a week, right? So now, if you ask me how much is it value, right, I'll say easily 5,002. Why? Every week, one session is about $100. Think about it. Getting new ideas, you know. Q&A, question and answer live, you know, from our coaches and actually the trainer. No? So on this aspect, right, I really want to give acknowledgement to all the coaches and the trainer, okay, for actually serving the community itself. And next, okay, having a community to support one another to go in the path of actually this journey of investing, okay, bonding, I think this one priceless, really priceless, right? And the beautiful part about having a community here is because we have different experiences and knowledge from different industry, we're able to come together and actually share our knowledge, and that gives more insight to most of the things people are not aware of, right? And some industry, example, let's say the EV market, let's say the electric vehicle, right? I really learned a lot, okay, from our community. So some of you really, you know, you are passionate in cars, you work in the industry, you're in the battery sector, you know, wow, you can offer so much insight that outsider might not know one, okay? So, and that will help us to actually choose better company and generate better returns. And of course, not forgetting, okay, not forgetting the so-called the financial data and the AI tool, okay, that we have to crunch all the numbers and turn the data into intelligence, investment intelligence. I think that is the key, okay, to give ourselves and yourself, okay, an unfair advantage. Think about it. Okay, no longer you need to spend months, okay, to actually do the very in-depth and very brain-cracking kind of research work. The machine can help us to simplify all this. Cool? So now, and of course, we also have programs. It's optional. Okay, if you think that they are good, we welcome you to actually attend to learn more, okay, in the area of actually investing. And all this, right, okay, the investment idea, so-called the weekly coaching, the community, okay, and financial data and the tool, okay, it's only what? Okay, if you go for the V Pro plan, okay, which is our most popular plan itself, it's only $1.50 a day. It's like equivalent to a cup of coffee to get all this. Think about it, $1.50 a day for you to actually get investment idea every week, to be a part of a community, to actually have a very powerful tool to help you to make investment decisions smarter, faster, easier. Okay, I think it's super undervalued. If you can, help me type in undervalued, cannot. Really. So now, so I promise you to give you ang pao, right? So what's ang pao? Now, the ang pao, very special. Now, for those actually new subscriber, okay, or extension of, that means if you're current V subscriber itself, if you extend, okay, your subscription, now we'll give you 4 reports. The first report is the top 100 software as a service company, US company, okay, worth $1,000. Now you might ask, what's the big deal, right? I thought it was a big deal because last year during the VIS 2020, where we actually gave this report, capturing about the top 80 SaaS company, okay, before the COVID happened, if you invest equally into them, you have generated easily about 87% as a portfolio. And one of them, okay, I remember one of you actually wrote to me, a few of you wrote to me, say, thank you, because of this report, right? Okay, you all invested in Zoom even before the price take off. Very happy for you, really, very happy for you. So imagine this year, we're going to give you, okay, 100 companies. On top of that, okay, we screen out 50 more outside of US. Hey, clap lah. Okay, now having a report to choose the investment idea so that can make your 2021, okay, a good one, okay, going forward is important. However, this year I'm going to do something even extra special for you. Now, I asked the team specially, okay, to find out companies you should be aware and cautious of. You know why? Because last year the COVID have exposed two type of company. First type is companies that are able to use COVID, okay, as a catalyst to grow because of the business model and the technology they have, okay, to serve a real pain in the market. The second type of company here is they are impacted by the COVID. They are not prepared for the pandemic, and therefore you need to be cautious because the pandemic can happen again, right? So therefore, we have listed out 50 companies, US company itself, okay, that you need to be wary of, that most of you commonly follow in the V app. On top of that, we also screen out 150 extra company outside of US, which is in Singapore, Malaysia, and Hong Kong, especially, right? Please use these two reports, right? Okay, to make sure to look at your own portfolio. If you have this company, right, not asking to sell, but just take note. You might want to consider to actually do some rebalancing, okay, and be careful of it. So now, therefore, 4 reports. 2 reports help you to grow your wealth. 2 reports help you to minimize the risk. You will find this is awesome. Okay, can you type in just awesome? Okay, so now, how do you get this report? I say again, this for the new V app subscriber, and for existing subscriber, you want to extend your V app. Okay, but before this summit finish, okay, which is this weekend. And right now, the team will, in your own chat itself, the team will actually put in the so-called link, okay, that you can currently click to actually either sign up or extend. And you need to put in the promo code called V Summit 2021 so that we know that you are entitled to this 4 report. Okay, so now, yeah, quickly, team right now can put in the link right now. Okay, so click on the respective link, depend on whether you are new, okay, user or you're existing V-app user. If you're existing one, you need to extend your usage. If you're a new user, you need to sign up, okay, so become an active user. So, and put in the promo code VSummit 2021. Okay, so while you're doing your so-called click the link, right, I also noticed that the team have given us feedback that, you know, you find that the resolution is blurry. Okay, we are aware of that. So now, 3 things we're going to do right now, okay, we'll just tell you, so we know that this blurry itself. So we have conducted Zoom while resolving this issue. First thing is we're going to close off the chat, okay, to the so-called open public chat, so that to minimize the so-called the latency itself, right? That's number 1. So therefore, you can only type the message to the panelists, not to the public. So hope you understand at this moment, okay, this to actually to reduce the issue. Okay, now second thing is we definitely will forward, okay, the slide, okay, into the chat link so they can download the slide straight away without going to the bubble. So especially going forward later on for the next 2 speakers, you will find that the slide resolution is still low. Use the so-called extra slide that giving to a link you can download, okay, for your convenience to watch. Okay, now the third thing here is this: by the time lunchtime, is the resolution still not resolved? Okay, still not resolved. Don't worry, we will kick in our next plan. Okay, we will tell you exactly what to do to go into actually our plan B, where we'll host you another room. Okay, where I think the resolution will be much better itself. Okay, so be aware that we know what's going on. Okay, we are doing improvement by lunch. During lunch and after lunch when you come back, it will definitely improve. Okay, so now if you understand, so right now some of you also asked me how to apply the promo code, things like this, right? So now I'm going to do a demonstration. So Tim, can you actually share my iPad? Thank you so much. So if you can see in front of you, right? Okay, you can blow it up, can blow it up so that for them for clearer in case the resolution is lower. Now, if you want to actually sign up for V app or extend the subscription to get the 4 report, okay, and the new feature that's coming up in 2021, okay. Now, first thing you need to do here is just take note, please do not subscribe. Please do not actually sign up and actually extend in your using a mobile app. You don't, okay. You must open up your browser. So browser, be it by Safari or Chrome. Okay, in this case, I open a Safari. You can see, just type in v.app. It's like normally how you type in the internet domain. Okay, then I put in my username and put in my password. I now click login. Okay, so therefore you see that this is my account. So now what happened here is you will see on the logo, right, top left-hand corner of the logo, next to it, there's 3 bar, right? If you're, I'm using my iPad by the way, okay, so if you click, okay, you can click down, you will see the menu bar will scroll down, right? You see a series thing. Then one of the things below the home is called subscription. You click on subscription, okay, then you will see, you scroll down, you see something called upgrade plan, extend subscription, or auto renewal. So now, this is for the scenario of those existing user. That means you extend, okay, your V app. So here, you just need to click extend. So this is the part where you actually, there's a box will pop up to actually ask you to input the extend subscription. Here I put in V. Okay, wait, just let me. Okay, V. Sorry, V. Oops. Okay, V submit 2021. Okay, once you key in, you click apply. Once you click apply already, then you would the thing will show you right now. Depending on what is your subscription plan. So if yours is a V starter, which is a 3 market one, you should know if you're a current user, V app user, how many market can you access, right? So if you can only access 3 market, you are a V starter. But if the most popular one is actually V Pro sell market. So let's say in my case, it's sell market itself. I'm assisting V Pro subscriber, sell market one. I want to extend the V Pro. I press extend. Okay, I press here, then I press subscribe. Okay, then you will see here, okay, very clear, okay, exactly on the right-hand corner here is when your start date. Okay, that means that my subscription actually about to end in about a few days time. So now I decided to extend, right? Okay, so now this is actually what if I apply, if I actually extend it, I will actually extend it to 1 more year to the 6th of January 2021. Okay, so V Pro 7 market, I fill in my details, everything actually be automatically fill in really, like since you're the existing user. So with my credit card, everything, check the detail correct. Importantly, okay, I agree to the term and condition, then I click subscribe. So when you click subscribe, right, you will receive an OTP. Okay, you will receive the OTP, okay. So now the OTP, once you actually receive, then you actually key in the OTP itself, the number. Okay, then that's it. You extend already. Then from there, just from the V submit report, the promo code, we'll know that we will send you the full report. Okay, so now very simple. So let's come back, okay, to stop share here. Thank you. Yes. So now I will like to actually bring up the next speaker. But before I bring the next speaker, right, I will actually highlight this is without this speaker, right, this company won't be around also. And without this speaker, because he's my good friend and co-founder of the company, okay, Mr. Clive Tan. So now I will actually like to actually bring up Mr. Clive Tan, okay, and in a while where he share his case study, I can't even wait, his case study itself. Okay, so now, to wrap up itself, my case study earlier on, okay, is good RX, okay, yeah. Yo, we are back again, bro. How are you, man?
Hi. Good to see everyone here.
So how do you feel this new environment, this new value investing summit?
Well, I think it's definitely very different because every year I look forward to seeing a lot of people, physically, right? But this time round, although I can't see every one of you in front of your screen, I know that there are thousands of you right in front there looking at what we have to share.
Okay, cool. And by the way, guys, you really must actually give Clive the acknowledgement because I tell you why. One simple reason is this. Because if Clive don't approve the budget, right, this event won't be around. This studio won't be around. So yeah, we can actually have the idea, but if Clive don't actually sign the check, okay, nothing get pushed on, right? So he's a real boss. Okay. So, but Clive, I want to actually ask you, I take this opportunity since we are now live. Okay. So now, we've been cycling for a couple of years, right?
Yes.
I noticed
yeah.
Recently, I cannot catch you, your tail light get further and further away. What's the reason? You're doing secret training, right? That I don't know, right?
No, I think you're pretty fast too. You're actually very, very, your place is not that off, like it's very close. Okay, but I think the secret to it, if you ask me, is to put in the right process.
Oh,
Yeah, the right training, because I think recently, when we got our own indoor trainer, we follow a training program,
Yeah.
we do it with consistency.
yeah.
I think that helps really. I mean,
So that means must do it with the right knowledge lah.
yes, exactly. Right.
Okay.
Apply that right knowledge and actually take action. Right. Keep doing it consistently.
And in fact, if you do, if I realize that if I don't apply the right knowledge, especially in my sports, I get injured very easily.
Yeah, I think that's when the risk is lah.
Yeah.
When you want to actually stretch yourself, you want to make sure that you take care of the downside.
Yeah, and of course, apart from the right knowledge itself, because also must have the right equipment, because we also got the right equipment to actually to do the cycling well, right?
Yes, exactly, the right tool. And
right tool,
also
right?
one important thing,
Yeah,
the right team.
Oh yeah, because because I don't like to ride alone. Okay, I mean also for safety reason. But also, but you're right, totally right, because it's when we go cycling together as a team, okay, we can actually support one another, look out for one another, okay, and the bonding and the friendship actually develop over time, right?
Yes, that's
Yeah.
right.
So therefore, just like in the investment space, same thing. If you can find the right mentor with the right knowledge, okay, then with the right community and using the right tool, then your result will be compounding. You will see that really it will grow at a compounding rate. So without further ado, so I really look forward to actually your case study sharing. Okay, so let's welcome Clive. Okay, thank you so much. Hand it to you, Clive.
Okay, thank you. Hi, as usual, thank you to Ken for the very flattering introduction. And I welcome all of you once again to V Summit 2021. Now, the theme for this year's summit is gearing up for exponential growth. Now, I want to congratulate all of you who are at V Summit this year, and especially as you start or even just continue your investment journey going forward. Why? Because we are living in the best of times in human history so far. More and more people are getting wealthier, faster, and easier. And we live in an age where literally any question you have can have an answer at your fingertips. And we can communicate with people miles apart without even leaving our homes. So this is something that ancients can only imagine, that probably only gods can do it, right? So what has made this possible? That's right, it's technology. And yet we always hear of people who are left behind. Why? The difference is the knowledge that you have, and this knowledge is made available to more and more people. And there's literally no reason why people should be left behind in this age of widespread knowledge. So the next step is really to apply that knowledge. So my presentation will be focused on divided into these four segments. All right. I shall be actually sharing this concept of super trends. All right. And we will use this when actually screening out for potential companies, of which I will share two of them. All right, which we can consider investing in. Now, before we start, as usual, all right, I must put down the usual disclaimer. Now, I know some of you treat this as just legal jargon that don't mean anything, but this is really important. Whatever we share here is not a recommendation to buy or sell any of the securities discussed, all right? Now, it's very important for us to practice sound portfolio management, as whatever stock selection that we can do are just high probability options, all right, that we can consider investing in, okay? So now a brief introduction about myself. I think I'll just state down my roles here. Okay, I'm one of the co-founders and executive director of 8i Holdings. All right, and together with my current role, I'm also running the HCCM, Hidden Champions Capital Management, which is a registered fund management company with the Monetary Authority of Singapore. And I also chair the board of 8i Holdings. But enough about me. All right, let's move on. Now, in fact, last year, all right, we actually shared this particular company called Sunny Optical at V Summit 2021 or 2020, all right? Now, during that time, for those of you who are not aware, this company is actually a leading company manufacturing camera lens and modules, especially for smartphone cameras. Now, I also highlighted that the one catalyst to look out for is the vehicle lens segment, where Sunny Optical has the largest market share in the world, right? Now, not long after V Summit 2020, I think you know what happened, COVID-19, right? And it hit many companies, including Sunny Optical. So you can see in terms from a stock price perspective, many of them went down, including Sunny Optical as well. But do you think that at a point in time I was concerned? Frankly, of course I am, right? But we always look back to their fundamentals. Are they still having their sales, right? What is their monthly sales figure like? We compare it against, the market information that we have, the financial data, and looking at the fundamentals, we still have a very big position in the company, all right? Although at this stage, maybe, I will caution against entering too much at this stage, right? But we do see that their vehicle lens segment has actually grown extremely rapidly, and our assessment is turning true in this case. So what happened after that? So despite the correction, the price has more than went back up, all right? In fact, if you just based it from that period, all right, from then to now, okay, our compounded annualized growth rate is actually at 35% for this particular company, which is pretty decent, all right? So I think this company, first of all, we don't just want to look at the fundamentals and the track record, all right? But also very importantly, why I want to bring you to that next point, all right, is on this thing called super trends. Now, what are super trends? Okay, so it's very important when investing to take a look into the future and really understand and discover what are the trends that's shaping our world, right? When you invest in alignment with the right super trends, despite the volatility, you will still be able to generate sizable return, all right? And also invest, all right, in the future of humanity. Now, of course, if you are very pessimistic about the future of humanity, I wouldn't recommend, okay, that you invest. You might as well put all your money into your, bury it somewhere, right? But if you're optimistic about how, all right, the future of humanity is shaping out, okay, I think you must invest and look into the future and invest in alignment with the super trends, okay? So as far as I'm concerned, humanity's future has never been brighter. Sure, there are issues that we need to overcome, right? But this has always been part and parcel of human civilization. Now, so how do we actually look at these various trends, okay? So one of the things that we look at is, of course, some of the recurring social patterns. We look at companies, all right? And of course, from there, those companies that's in alignment with those trends, all right? We actually learned and envisioned how they would turn out. Now, of course, many people call this growth investing, but to me, growth and value are joined at the hips. So to me, it's very important for us to look forward and always remember that investing is about investing in the future. Now, let's take an example here, all right? Now, in 1925, all right, the TV was born, right? Now, in 1953, color TV came about. Then we had, of course, in 1982, the invention of CDs. Now, all these various breakthroughs in technology enable us, all right, to actually watch a lot of, I call it video, all right? But of course, along the way, we also have the World Wide Web, all right, which enable online streaming. And of course, from all this, you have YouTube. Now, just highlighting YouTube itself, for YouTube to happen, all right, it has to go through all these, it has to have all these breakthroughs first before YouTube can happen. And the same applies, all right, to this company called Netflix, all right? Now, how does it work, all right? In fact, when Netflix have initially started, it was just, renting videos and stuff like that. But Netflix and YouTube are literally replacing cable TV stations. Now, if you are at that stage where you're considering investing in a cable TV station, of course, I think you're not making a very wise decision. You're not investing in alignment with the trend, right? But from my perspective, okay, you want to invest, as I mentioned, always in the future. So the chances are not high you're going to make any profit from them. So don't invest in those kind of company where the chances of being a value trap is very high. Now, this sort of companies like Netflix, all right, is what we know as disruptors, all right? And many of them have gained massively in terms of their share price performance. Now, underlying all these disruptors, technology is often the bedrock in which all these gains are made. Now, some of you may be wondering why that is the case. Technology is what enables massive scalability of businesses, right? Now, if you look at the traditional brick and mortar business, the difference is based on the concept of addition. It's pure arithmetic here we are talking about. brick and mortar business based on addition, all right? So they add on, they scale up, they add branch by branch, store by store, whereas the current crop of new businesses are working on the basis of multiplication. This is why, you know, if you observe, many of the new billionaires, all right, are getting younger and younger, all right? Because you're, instead of doing addition, they do multiplication, all right? So that being the case, okay, why is it that, you know, Netflix has actually grown so well? All right, you look at the number of users that they are actually getting in terms of the runway that they have. They are not talking about, you know, any, like, unlike cable TV, for example, which is restricted to certain geographical places, they serve the world. All right, and of course, you know, their model wise, you know, it's also in terms of subscription, it's cheaper than your typical cable TV station. All right, and because of rising internet speed, which is an important point here, all right, that enables them, many people, to switch from cable TV to online streaming. Now, let's take a look at some of the super trends that's going on. All right. So, of course, if you look at all these super trends, okay, from AI, deep learning, robotics, cashless society, e-commerce, all sorts, many of which, okay, that many of us have heard of before, but may not be familiar with them. But one thing's for sure that I'm quite confident that all of us will know, right? In fact, if you look at them, what you want to do is, when you look at the various super trends, all right, you want to learn more and more about each of these super trends so that you can have insights into this. Now, take note, many of these super trends actually link up to each other. They are the necessary breakthrough for other trends to happen. All right, they are what we call the enablers. Now, when I look at, let's say, for example, you know, the various super trends, all right, we also want to assess what's the impact to individuals, how much reach they have. Of course, this particular chart here is based on our own assessment, okay, it's our own opinion. We are still working on this, all right? But if I look at all these trends that's going on, we want to select trends that is very obviously going to happen. So let me take an example that is definitely going to happen, okay? We take this, okay, we call it the graying population, okay? Now, if you ask yourself here, any one of you, if you're not aging every day, okay, if you're not growing older every day, okay, please do let us know, all right? I think you are definitely, you know, one of a kind. And in fact, I think you have the opportunity to basically, you know, enable human civilization to be more immortal, right? But of course, that's something that, you know, is also in the works. But the thing is this, graying population, all right, is definitely going to happen, all right? In fact, you can see happening, all right? And in terms of the number of actually people who are, in terms of population graying, it is very obvious. Why? Because generally, when the populations gets highly educated, all right, the birth rate drops. And when the birth rate drops, all right, over time, you will see, all right, basically who is growing older, all right, basically, so you will create that population that will actually gray, all right, and grow older. Now, if you look at, okay, worldwide, what's going on, all right, for the population here, all right? Now, in terms of percentage of population aged 60 and above, okay, North America and Europe, all right, has the highest percentage, right? And of course, catching up behind or following very closely, Latin America, Asia, and the world. Of course, the continent that is actually not really aging that fast, in fact, it's probably, you know, it's actually Africa. And of course, Africa is a different story altogether, all right? But if you look at the top few countries, okay, actually the most interesting is in Asia. Why? Because we are set to be the region with the most elderly. The reason for that, of course, although America and Europe has the largest percentage of elderly people, all right, or graying population, all right, in terms of the population base is not as big as Asia, right? So in Asia, we'll actually account for 62% of the world population, all right? In fact, by the year 2050. So let us look at one of the major issue of aging. When a person age, I would say generally, all right, most people will have healthcare needs increasingly, all right? You tend to get less healthy, all right, when you get older, all right? Of course, there's always exception to the case, but we are talking about, as a percentage or based on statistics, right? So there's increasing healthcare needs. That's something definitely that's going to happen. I think everybody knows that the healthcare cost has been rising rapidly. On top of that, all right, we also have more and more chronic diseases. Now, chronic diseases need a lot of recurring care, all right, to be actually given to the patients, all right? And all this costs a lot of money, all right? And all this actually are potential for investment into those areas that actually serve these needs. Now, of course, there's also the rural population where they face a lack of healthcare coverage as well as a shortage of skilled personnel, because most of the healthcare coverage and skilled personnel tend to go into the urban areas. Now, how do we actually solve this? All right. Now, many a times we have to look at and ask, how do we embrace technology to solve these issues? And there are already companies that is doing that. Okay, this concept called telemedicine. All right. So let's take a look at what are some of the trends that's going on, all right, that's supporting this trend of telemedicine. Now, we know about digitalization, all right, as I said, all right, in order for, let's say, Netflix to happen, the online streaming has to be in place. The same applies here, all right? So you can see in terms of the digitalization, business are moving to the cloud, right? More and more, all right, you can see many of them, the cloud adoption has been increasing. On top of that, all right, your internet speed, your 5G speed, all right, is going to pave the way, all right, for all this connected future, so that, in the future, we'll have higher speed, all right, lower latency, and this will enable telemedicine to work the way that it's supposed to work. And of course, on top of that, all right, we have various IoT devices like fitness watches, all right, even, telecommunication, virtual reality that will enable doctor in surgery to do their work virtually. So if you also look at the other trend that I mentioned, okay, the rise of e-commerce. Now, if you go 2 decades back, probably many people will say, you know what, e-commerce is something that they cannot even fathom, right? What is the internet? But in the year 2020, and especially when COVID-19 happened, everybody is kind of forced to adopt some of these e-commerce habits. And you can see, if you look at Google Trends, that this word delivery came up, spike up, right? Because everybody is looking for delivery, all stuck at home, right? So in this case, all right, this sort of driver actually does encourage, okay, telemedicine, what I call the seeds to enable telemedicine to happen. And of course, when I look at the transaction value as well as the penetration rate of e-commerce, that already tell you that this is getting more and more common. Everybody is adopting it. I think we all know it from personal experience. And of course, what are some of the advantages? I think these advantages will also, translate over to telemedicine, where they have, 24/7 availability. You can compare your products very easily. There's delivery, all right, and generally, because there's so much competition, you get cheaper products and services as well. So, as I mentioned, okay, we look at this particular sector called pharmaceutical e-commerce. So 2 companies that I'll share here. Okay, the first, all right, is Ali Health, all right, listed on the Hong Kong Stock Exchange. Actually, interestingly, this company, all right, is through a RTO, a reverse takeover in 2014. At that point in time, people were speculating this was supposed to be the vehicle that Alibaba will actually reverse into, but it turned out true, but not exactly true, because it's actually Ali Health, right? Now, of course, currently the market cap is almost 38 billion as of 15th of January, okay? More than 1,000 employees, but if you consider that 1,000 employees are building a company that's that big in terms of market cap, I think you can see the potential here. The other company, which is the very, very close equivalent, is JD Health, right? Their market cap is 59 billion, all right, also at about 1,400 employees. Now, these 2 companies, very interestingly, all right, in fact, JD Health was just listed on 8th December 2020. That means just a new listing. Now, personally, actually, most of the time, I wouldn't recommend, investing in a new IPO company. But this company is particularly attractive because it is a spin-off from a very established company called JD.com, right? So at this juncture, maybe to give you a sense of what they do, all right, I'm going to play a video, in fact, 2 videos, all right? Let's take a look and so that you have an idea. These videos are in Mandarin, all right? But if you don't understand, it's okay. After the video, I'll explain, okay? Can we have the first video?
都说城里套路深，我真的不想出农村。
你也别急，不出门照样看北少管名医。
咦，京东健康汇聚三甲名医，找名医无需全国跑。京东健康双11，三甲名医医院义诊限时抢。京东。
Okay, so just now that the video that was played, all right, for Ali Health, okay, you talk about the actually this gentleman, right, who is actually attempting to find out more, right, about where to get the medicine, where to find the particular pharmacy. But instead of doing that, they could actually use your app online to diagnose, all right, the person's health so that they can get the right medication. All right. So maybe the next one, I'll show it for the next one for JD Health. All right. So we take a look and see whether there's a difference.
大爷，您知道这附近哪有药店吗？
嗨，你啊顺这条胡同一直往东走，往前有个小卖部，然后呢，然后再一抹弯你就到了。
跟我走。
哎，
给谁买药啊？
啊，我女朋友她有点拉肚子。
哦，那她是急性肠胃炎呢，还是慢性腹泻呀？嘿，不知道病因瞎买药。问路要问清楚，用药更得问清楚。买药先问执业药师，在线解答用药问题，快人一步用对药。
Okay, so I think if you have looked at the 2 videos, all right, for Ali Health and JD Health, you will find that their models are actually very similar. All right, they serve this particular population, this particular need about people needing medical care, right? But of course, in a digital manner. So as I mentioned, these 3 trends, okay, the digitalization and e-commerce are the enablers, but the trend that's going on is the graying population, right? So let's take a look at China itself, because these 2 companies are based in China, all right? So if you look at the trend in China, all right, the share of people age 60 and above are actually going to go up at a very quick rate. In fact, all right, in 2020, their aging population, which is the number of people, 17.4% already, all right? In 2050, it's expected to hit 34.6%. You can see the spike, okay, in terms of these 3 decades. And it's something that you can foresee is going to happen, all right? So we know that this is going to double, right, in the next 30 years, all right? This is a trend that's inevitable. But of course, you may ask yourself, hey, 30 years double is not that interesting, right? Okay, but wait till you look at the other trends. The other thing that's also, of course, happening, as I mentioned earlier on, with regard to digitalization, right? So more and more people are adopting it, all right? Cloud computing is a proxy that we use to determine, how this trend is moving. It's growing at a compounded rate of 42%, all right? And it's expected, okay, within just 2 years, it already doubled, okay? So this is actually another enabler that's driving this, huh? Now, the number of online buyers, all right, who is actually familiar with e-commerce, all right, is actually also growing, all right, compounding at a rate of 19%, all right, and still continuing to grow, all right. It's an increasing trend that seems unstoppable. Now, health expenditure, all right, healthcare expenditure compounding at a rate of 14%, okay. Now, this is something that long-term wise, I mean, this has been happening for the past many years. And in fact, you can see the curve at, seems to be suggesting that it's going up in a very exponential manner. And actually, that's not too surprising. As I mentioned, generally, the older a person gets, the more health expenditure is needed. And of course, this is the most interesting portion, all right? If you look at the trend over the past, in fact, 9 years, okay, the compounded annualized growth rate of sales revenue of medication or medicine in general through online retail pharmacies, online means, has been growing at a rate of 69%. Now, of course, this has happened in the past, all right? But does it mean it's going to happen in the future? Of course, based on what you have actually, what I've shared earlier on, okay, we believe the trend will still continue to carry on. And this is actually the most interesting part, that where Ali Health and JD Health, they are operating in. Now, in fact, COVID-19, while it has impacted many businesses negatively, all right, in terms of purchases of healthcare products, it has actually paid a lot more attention. A lot more people are paying more attention to it. In fact, if anything, I don't know about you, but most people and myself, all right, pay a lot more attention to health nowadays, and will actually be open to buying health-related products online delivered to my home. All right. And this is something that is very interesting because it also indicates the very long runway that this potential industry have, okay? So if I look at it, all right, just now I mentioned that the compounded annualized growth rate is at 69%. But if you look at the online pharmaceutical retail penetration rate, it is still at a very low rate at 0.8% of the total pharmacy sales. Now think about it. If you, at current stage, even though it is growing that fast, all right, and it's still at only 0.8% and is compounding at a rate of 69%, you definitely have a very long runway going forward. And even if online doesn't take over that sales, which is impossible, it won't take 100%, I acknowledge that. But let's say it takes 10%. Okay, that's already more than 10 times, all right? You take 20% of the total pharmacy sales, okay, you're talking about another 20 to 30 times already. And because of all this, all right, I think there is a lot of growth potential, all right, for these two companies, particularly when you consider, let's say their revenue were to just grow 20 to 30 times easily, all right, they will have a lot of operating leverage because of the way they deliver their service. So their profits will be phenomenal in future. So let's take a look at some of the forecast numbers that we were able to actually find out, all right? Of course, this is based on UBS research. Now, in the next 5 years, this is what they estimate, base case, all right, at a 3.9% penetration rate, all right, expected sales is renminbi $100 billion. Now, we are talking about the base case, meaning to say the compounded annualized growth rate for this market is at 39%. Now, that's the base case, okay, with conservative assumption. Of course, if it really go to the worst case scenario, as far as, of course, based on the forecast, all right, maybe the penetration rate will just go to 1.8% at 22%, but you still get a 22% compounded growth rate, all right? So I think no matter how I look at it, I think the potential for this particular segment is very high. But let's also take a look at their business model. Now, this particular image is actually extracted from JD Health's prospectus, okay? So if you look at their business model, right, they are explaining their business model here. Basically, why do they have all these online healthcare services? Actually, if you look at the grand scheme of things, this portion of it is relatively small at this stage. But what it does is when they have online healthcare services, it enables the retail pharmacy, the online retail pharmacy, to be able to sell more products. Okay, so this is a very good way of reinforcing their cycles. And of course, if you look at Ali Health, actually, it is very, very similar. Okay, in fact, if you look at the various numbers, all right, their business model, it is so similar. You wonder, which one start first? Probably they just, copy and look at each other. They look at each other and copy from each other. All right. So if I look at, let's say, Ali Health business model itself, all right, most of their sales came from their pharmaceutical business, all right, direct sales, all right, 85%. And most of this B2B, B2C, online and offline, okay? Of course, they sell various products from prescription to over-the-counter drugs, health products, services, medical devices. And of course, they also provide, okay, various, other merchants, all right, third-party merchants, all right, where they actually provide to their Tianmao. Tianmao is their Alibaba's, of course, sales platform. All right. They also provide to their merchants some of these value-added services to them and earn commissions from there. But this is only like 12%. So the major part of it is still the direct sales that they do. So just imagine on the cloud, there's this giant on the cloud kind of pharmacy selling a lot of pharmaceutical product online. Okay. So there are others from their medical and healthcare services business where it comprises 3 or less than 1%. This is like what I mentioned. All right, the consultation, the health screening, all right, or even tracking in terms of the pharmaceutical products, how they track. All these are negligible at this stage, but they help in encouraging the sales of their pharmaceutical products. So this is a screen capture, all right, of their website itself. If you look at the website, all right, they have various products that's being sold. They categorize it ranging from general nutrition, right, to nutrition for pregnant mothers, all right, maybe even for men, for weight loss, all right, stuff like that. Okay, so you go to the various category and you can find various products from there. And of course, in China, okay, while website is an important way, you can actually purchase your stuff. The more important thing is through your mobile, all right? So on their app itself, all right, you can see they have medical and health services that's being provided, okay, that actually enable these services to be, you can actually literally look at their phone, all right, and actually have this consultation, all right, book your consultation time, do online consultation with them, and even make, at this current moment, the vaccine appointments, right, which they are also doing. And they are literally also like an encyclopedia, right? They have all sorts of disease information, all right? Also, even severe disease guide. So if you want to find out more about the various diseases, all right, it's all there, all right? So that you can make a better choice. And they even have, a smart health management system, all right? This enables, a person to be able to track their health. When I look at this, this one, I think about it, I said, wow, this one sounds like portfolio management, except they apply it to health, right, to an individual, right? So imagine you have the knowledge, you have the education, you have the consultation services, right? All these things come together, all right, to serve the customer's needs. Now, JD Health also very similar. In fact, if you look at their segmental breakdown, all right, pharmaceutical and healthcare products comprises 87% of their sales. All right, this is still pretty. Is in fact very similar to Ali Health. All right, and they have others from their marketplace and their digital marketing. They categorize it a little bit differently. All right, but these companies, all right, in fact, in terms of their percentages, actually their segmental breakdown is very similar. So, of course, in terms of products, also by categories, I think very similar to Ali Health, right? Okay, I will run through this. You can, of course, based on your product information, you can select. You can look at their instructions, how it's used. All right, all this information are available online. You can, of course, also, check out the various online hospital services that they actually provide, okay? And in fact, there's one interesting feature, you even get to rate the doctors, all right? So imagine that you can rate you can look at the doctor's ratings, okay? Look at how many patients they meet, all right? Then before you decide to consult them or not, I tell you, this to me actually quite stressful for the doctor. But on the other hand, okay, it is also a way to make sure that, consumers make the best choice for themselves, all right? And the different ways of consultation is there. You can do it through a phone call, all right, through video calls, even personal consultation. All the different rates are actually given there. Now, what's the moat that I see in these two businesses? Of course, I think, in my opinion, they have this network effect, okay? And this actually a lot of times is because of their synergy with the parent company, all right? Ali Health, of course, the parent company we all know is Alibaba.com, right? They are the largest retail commerce business in the world in terms of their gross merchandise value, all right? With 726 million active customers. I don't know about you, but I think it's hard, all right, to imagine 726 million customers every year, okay? So of course, they focus on their innovation, and various machine learning technology to be able to serve their customer better, all right, through using their platform. And because of this, all right, you can see that Ali Health is actually leveraging on that, okay, to create the synergistic effect. Something like what you see of Grab and Uber. They have more users, they get more doctors. So this creates the platform for the users and practitioner to actually interact with each other. All right. And from there, they will be able to, at the end of the day, if they need any products, they will actually go onto the platform and buy their products. Of course, they also work with various pharmaceutical company, all right, to actually, roll out certain programs, all right, so that they can, various partnerships so that they can serve their customers better. Now for JD Health, it's very similar, all right. They also have e-commerce, they have their own logistic network, and also they leverage on technology. You can see that that platform, all right, is actually very similar to Ali Health as well. So also the same, all right, in the sense, also increasing the number of active users, increasing the doctors there, and having partnership with various pharmaceutical companies. So let's take a look at their management. Now the CEO in charge of Ali Health is this gentleman called Zhu Sun Yan, all right. Now his focus, based on what we have, based on the interviews that he has given, his focus is on innovation and digitalization. Now, of course, when we compare, so-called compare it and benchmark it to the other person from JD Health, right? His name is Sing Li Jin, all right. He's actually focused more on services, but I think in terms of the overall feel and experience, it's actually very similar, all right. But of course, JD Health CEO has a personal story. He was just relating that he was actually looking for medical care, all right, in the traditional way, all right, for his father. But even he, as a CEO of JD Health, has challenged looking for proper medical care. I mean, he went through a lot of hurdles in order to get the right medical care for his parents, all right. So imagine if a person like him have so much issues, what more for the general population? Okay, so we think Ali Health is a bit more innovation driven. JD Health wants to focus more on service, but I would say generally they are very, very similar. Now, the other thing that, of course, when we also looked at is also in terms of the shareholding structure. All right, their parent companies still have a high ownership, all right, in them. Ali Health is 57% owned by their parent company, whereas JD Health is 67%. All right. So of course, if you look at the historical segmental sales, you can see that they have been growing. In fact, many of the other segments in Ali Health, you can see some even, for example, the tracking and digital health has been declining, right? But the main bulk of it, the important part of it is the pharmaceutical direct sales. In fact, that's what they have been doing. They've been injecting these businesses to the Ali Health platform, and that's why you see these numbers increasing. And as I said, when you look at the breakdown of their various segments, all right, it is very, very similar, all right? I mean, 85% to 87%. That's the main bulk of their sales, all right? Active users wise, you compare them side by side. I think both of them are growing at a very quick clip, all right? So I think it's just like, if you were to ask me which one has a slight advantage here, personally, I can't tell, all right? But if you ask me, I said, what's wrong with investing in, let's say 30 to 40 years ago, Coca-Cola and Pepsi-Cola, you probably get very good results as well, okay? So if you go to VApp and you take a look at some of the basic numbers, now, I know some of you may not be able to see this, all right, but what I want to just highlight to you is this, all right? You will notice that their EBITDA margins, all right, are very thin, relatively thinner. And in fact, you can see that in terms of the absolute numbers, all right, JD Health has a higher absolute EBITDA amount, all right, compared to Ali Health. But when you look at the next portion, all right, which is in terms of their net profits, okay, you see a very interesting trend, all right, or interesting outcome, all right, where Ali Health has turned profitable, all right, in the most recent financial year, all right, as well as the last 12 months, all right, whereas JD Health has a very, very big negative profits there or loss, all right. And if you dig further, you will notice and realize that it's actually due to the increase in fair value of Series A preference shares. Now this one I will explain a little bit more. Basically, there was some pre-IPO activities going on. All right, that accounts for the negative profits. All right. So in terms of the inventory turnover days, this is also a pain point of the offline pharmacy in general. China, when you compare it with the United States, in terms of their offline pharmacies, is less efficient. It's highly fragmented with high operating costs. All right, they store their goods. All right, they don't move their products so efficiently as in the United States. So of course, if you look at also some of the medical resources, all right, available, generally resources are concentrated in the hospitals itself, all right, in terms of the pharmaceutical products, all right, and in the more affluent cities. So those people living in the western area, the central area, in terms of the hospitals and also the pharmaceutical products that they can reach out, they have access to will be lesser. Now, other relevant factors would include, of course, some of the pain points, lack of medical knowledge and stuff. But with, of course, an app like Ali Health, you can actually find out, okay, all this information at your fingertips. Now, if I look at the whole system here, we are talking about the benefits of combining internet with healthcare. All right. So with better medical knowledge, you have all the knowledge inside. You can seek consultation through the app. All right, book appointments if necessary. All right, do the transaction by the relevant products that you need. All right, I think that really makes a lot of sense. All right, from a healthcare perspective. Now, some of the this serves as a tailwind, all right, to this industry. If you ask me, COVID-19 has been the catalyst, all right, for this particular industry segment. Of course, in fact, for this particular industry, the regulatory policies has been positive as well. During the time when COVID-19 happened, China, you can't visit your normal pharmacies, at least not on a very, when they actually locked down a city, right? So actually a lot of companies like Ali Health and JD Health, they actually are able to serve their customers. In fact, they serve more customers during this time, all right? So these are the growth drivers. As I mentioned, I think there's favorable policies, there's large market size. COVID-19 has given it a boost, but it's a matter of time. And with more internet penetration, more people being able to know how to make use of e-commerce, all right, to buy their pharmaceutical products, I think this is set to grow very favorably. So if you look at the 5 forces, all right, by portal, all right, in terms of barriers to entry, I think there's low barriers to entry, but not many people will probably go in because of the giants already there. Now the high threat of substitutes. Now actually they are the disruptors themselves. All right, they are attempting to take over the physical stores. So in this case, they are fighting with the physical stores. So I would say that they are the substitutes. All right. Suppliers and their customers have relatively low power. In terms of the competition, all right, there's only a few of them, but actually they face the competition is, in terms of number, is very few, but actually they do have competition among them. But the main competition is not from them, it's from the physical stores. Okay. So we also have take a look at their government regulation. Of course, I think recently Alibaba, their Ali Health's parent company, faced a lot of investigation into their practices in terms of their monopoly status, so-called, right? So there's a lot of uncertainty and complexity, but to me, it's a trend that can't be stopped, all right? And of course, many people may still have questions about the quality and safety of the medication, but as you know, I think from time to time, once I think these are just hurdles and challenges that the various businesses will overcome sooner or later. Now, this portion here is very important because JD Health, all right, is a new listing. So I just want to highlight the risk of investing in new listing, all right? First of all, with these 2 businesses, particularly, let's say with JD Health in this case, all right, there is overlapping businesses. Take, for example, protective equipment is sold by JD.com, all right? If you think about it, the protective equipment shouldn't be sold by JD Health, right? In fact, it's more than, but the good thing is in their prospectus, they did state that if, let's say, this particular segment, if it increased to 10%, right, of their revenue, they will actually transfer it to JD Health. But of course, the question is always at what price at that point in time. But never mind, these are all the potential risks I'm talking about. I think as much as it has a lot of potential there, all right? The other thing is because it's a new IPO, and you will notice a lot of IPO companies, when they at first listed, how come the stock prices generally go up? Because many companies, all right, they have what we call a price stabilizer behind it, all right, and the exchange allow for it, all right. In fact, in Hong Kong Stock Exchange, it allow up to a month, all right, for a party to actually just make sure that stabilize the price, so that the price doesn't crash, okay, during IPO days on the initial period, all right. But of course, in this case, it's not necessary for JD Health. But the biggest issue that I see for this particular company, all right, is their pre-IPO activities, all right. In November 2019, all right, of course, as institutional investors, they invested at $2.50 at a 72.5% discount, all right, to the listing price of $9.11, all right, US. For Series B, all right, it is at $7, all right, 23% discount. Now, the thing is this, all these are investors, and this tranche is very big. It's equivalent to what they have actually listed, roughly there. So what's going to happen is this. In 6 months' time, all right, after their listing, their lockup period will be over. So the question would be, what are these investors going to do? Now, of course, they will not go and slap themselves in their face to, they dump the shares and whatnot. But because there's more than 10 over funds involved here, I can't be sure, right? I think if you were to ask me at this juncture, all right, you can consider getting, and if you think that this company makes sense, what I share with you makes sense, do your own due diligence. You can consider investing in some of these in these two companies. But watch out for the opportunity for JD Health after June, all right? So to summarize, this is actually the whole process that I'm talking about. In fact, at Hidden Champions, all right, capital management, what we focus on from the insights portion, we went through all these various process from the super trends to the business model. We look at their mode, we look at the pain points and the growth potential, and also, of course, the risk before we decide whether the company is worth investing in. So just a very quick share about our asset management arm, because from time to time people ask, hey, how does 8i Holdings, what's the difference between 8i Holdings and let's say 8VI, right? But the difference is in the asset management portion, all right? So now in Hidden Champions Capital Management, we have two strategies, all right? One is what I call quantitative aided insights. So this is where we make use of various quantitative data, even platforms like CapIQ, to screen out certain companies. But from there, we actually look into those companies in detail, in depth, to get insights. Why is it so important? All right. To me, if you get insights, all right, you will be able to tell when and where and what's the potential opportunity there in those investments. Now, the other part that we are also working on, all right, which actually one of my investment manager, Joshua, will be sharing, all right, is on the quantitative aspect. So these two are the two strategies, broadly speaking, that we employ. So this is the team, all right, that actually manages the fund. And also, so we have Richard, Joshua, Joyce, and Jing Liang. And if you want to actually know more, want to get the latest update, please go to your V app, search for HCCM, okay, and click follow us, all right? And I know some of you say, hey, you know what, how can I invest in your fund? Now, as much as I want to, all right, I can't serve everybody. In fact, because we are a regulated entity by the MAS, all right, we can only serve accredited investors. Accredited investors is defined as the following: net personal asset exceeding 2 million, or financial asset exceeding 1 million or equivalent, or income in the preceding 12 months more than 300,000. So if you satisfy this criteria, I'll be more than happy to speak to you, to share with you about our philosophy and our fund further, all right? So for those of you, all right, who are keen to find out more, okay, please take out your camera, scan this QR code to register yourselves. Remember, this is for accredited investor only, okay? So thank you so much for listening in. I hope you enjoy the sharing. Thank you.
Thank you, Clive. Wow, I learned so much because I learned from Clive just now, if you remember, which are the 3 sectors you should be focusing on, right? Yes. First one, graying population. Not only in China, I think Singapore, Taiwan, Korea, many countries are facing with this, where the baby boomers are looking at healthcare issue. So if we are looking at the normal hospitals, healthcare, may not be only that. How about looking into digitalization? Now, digitalization is not just about putting things online. We talk about e-commerce as well. So now we are looking at even healthcare plus digitalization together. This is where you can see the value of coming to V Summit. We get to know what's upcoming, because when we invest for the future. Now, during the presentation, I know some of you have certain concerns. For example, I'm going to address one by one right now. First is regarding the slides, yeah? So the slides, we have sent you the link. Okay, if you find that certain presentation, because we have to actually, when the analysts and also the presenters, when they do up the slides, okay, they have to actually take the picture form, all right? So from like JD or from Ali. So it's difficult for them to change the font sizes. If you find that it's a little bit blurry or it's very blurred, not to worry. You can always download the slides via 2 ways. Okay, so first way is we have sent the link in the chat. But if you miss the link in the chat, and for whatever reasons, sometimes some people can open the link, some cannot. Okay, so what you can also do is to go over to the V Summit 2021 bubble in the V app, where we upload the PDF version. Okay, so the PDF version, definitely you should be able to download it. Now, some of you said you might not be able to go to the V app. If you forgot your password, there's always this part called forget password in the V app. Okay, the slides will still be there, so don't worry. I think even if you can't download the slides now, what you can do is to listen to the case studies, and for those with all access pass, you can watch it again and get yourself familiarized. But at least I think you got away 2 case studies. One is Ali Health, the other one is JD Health. Not difficult for you to forget, because we know about Ali and we know about JD. And some of you are already investors of their parent companies as well, right? And you do have questions. Please remember to post your questions in the Q&A, okay? Once again, please remember to post the questions in Q&A, all right? So that our moderators can reply to you one by one. For example, some of you are asking, let's say, I've seen a chat coming in that talks about how about the accredited investors, the QR code, the link. If you request for it in the Q&A, we will be sending the link directly to you, okay? Yeah, if you missed that. So regarding the resolution issue, not to worry, we are resolving that. So in the meantime, what you can do is to download the slides. If you can't download the slides yet, just listen first. Okay, take down the notes, because get yourself familiarized. Let's say at least you get away 3 points in terms of Clive about growing population, about the digitalization, and also about e-commerce. And the next thing we get to know from Clive's segment is 2 companies, 2 stocks that you might be wanting to look at apart from the parent company of Alibaba and JD, is to look into Ali Health and also JD Health. So ladies and gentlemen, I know many of you are very eager right now to go over to V app to take a look at the risk, take a look at the star chart, take a look at their valuation. Okay, I'll give you some time. We are going to go for a break. Yes, now it's 11:08. We'll go for a 15 minutes break, okay? So ladies and gentlemen, all right, we will put the break start time to be about 11:10. Okay, so please be back at 11:25. Okay, the next segment will start at 11:25, and our next speaker up on stage will be our investment manager, Mr. Joshua Zhang, has going to share with you something about sabotaging your portfolio. What is that? Come back on time, 11:25. We'll share with you more. See you. because the next part is a very important part where Joshua, our investment analyst from Hidden Champion Fund, is going to share with you investing behaviors that will sabotage your portfolio. So make sure you listen carefully to Joshua. So Joshua, please.
Thanks, Pauline, for the introduction. Hi, everyone. My name is Joshua. I'm one of the investment managers from Hidden Champions Capital. And today I'll be sharing with you all on something that is a topic that's really close to my heart, as well as something which I find that is not talked very often out there. And every time we go out on investing courses, we always learn strategies on how to invest, but very few people actually touch on this topic on behavioral investing. So today I'll be sharing with you all how behaviors can sabotage our portfolio and in fact eat into a lot of our returns. And before we start, I would like to just do some disclaimer and that some of the stocks that I share about in these slides are for discussion only. They are not a buy-sell recommendation. So nothing that I share today can be constituted as investment advice because I don't know your personal situation. Okay. And I may also share certain performance of certain stocks and just need to know that the performance is not guaranteed, okay? Because they're based on historical. So some of the stories that I share today, they're actually leveraging off things that I have read in the past, books, internets, chats we have met with people. And so these are some of the big ideas out there that you all can actually go out and pick out a copy and read for yourselves. Really highly recommend these books that can help you to change the way you think about investing. Okay, before we start on the lesson proper, there are 3 stories that I want to bring out to you all. Sometimes throughout our investment journey, we may tend to overlook how hard investing actually is. And with that, there's this first story, and it's the story of bad luck. Many people do not know that Apple actually had 3 co-founders. Okay, of course, Steve Jobs and Steve Wozniak, everyone knows them. But the third co-founder was actually this guy by the name of Ronald Wayne. And he was the guy that actually drew the first Apple logo. And in fact, the first computer called Apple I, he was the one that did up the manual. But more important than those, he was the guy that actually drafted this co-founders agreement that you see here at the bottom. So, but the very sad thing about this guy is that within 2 weeks after Apple company started up in the garage, right, he sold off his 10% stake of the company at a price of $800 back then. So $800 in those days in 1970s was about 4,000 USD, 3,700 USD in today's value. And when he sold off his stake, Steve Jobs in the coming months actually went and pursued him further, even offering him even more equity in order for him to come back. But he blatantly refused. In fact, his excuse was that he didn't want to have the volatility that was associated with startups. And he was the closest actually to the long-term vision of Apple. And when he was interviewed like years later, after Apple was very successful, this was the thing that he had to say. I made the best decisions with the information available to me at that time. And as a final kick to the face, that was not the only ill fortune that besetted him lah. Not only did his 10% stake now is worth $200 billion, and he forgot that, but you remember this original founders agreement? He actually kept a copy, and in the early 90s, he actually sold it for $500. Then in 2011, it was auctioned off at over $1 million, about $1.6 million. So sometimes in investing, it doesn't really matter how close you are to the story. Investing is hard. The next story is a story of good luck. And this person called Masayoshi Son, I'm sure most of you all would have seen his face before. Back in those days, he was known as the Bill Gates of Japan. In fact, many of you all would know him through SoftBank, this company that started, or the $100 billion SoftBank Vision Fund, where he invested in a lot of tech startups. So many of you all do not may not know his background story. Okay, so I would just like to briefly bring you all through. As a kid, he was actually born into Japan, Osaka, in this migrant family. So his family was originally from Korea. They migrated to Japan and he was born in Osaka, and they were very poor. So they were living in among like the slum areas, okay, in shacks. And they were so poor that the pigs that they reared actually lived in together with them in the same place, right? So as a young kid, he would actually be seen sitting at the corner of the shack, up the lower half of the body full of mud, and then he'll be reading. Somehow, reading was his escape. Escape from that poverty, escape from that situation, escape from all the bullying that he was facing just because he was an immigrant. Okay, but somehow he was successful in his studies. He made it and he will manage to go to US to study. So while in the midst of being in college, he started up a company. And with that company, he sold it off for 5 million. And with that 5 million original capital, he brought it back to Japan. And then he started up this company, it's called SoftBank. So that was how SoftBank started. And in the mid 1990s, okay, Masayoshi Son actually set up SoftBank Technology Ventures. And this was actually the predecessor of this SoftBank Vision Fund. Okay, so over a span of 3 years, he actually invested over $2 billion across 100 over internet companies. And at the peak of the internet bubble in 2000, SoftBank roughly owned, it was estimated that he roughly owned 10% of all publicly traded companies that has to do with internet company startups. So, but then when the tech bubble burst in 2001, SoftBank lost 99% of their value. It was an almost total wipeout. In fact, the losses that Masayoshi Son suffered was actually recorded as one of the greatest in history. Okay, his net worth declined from $76 billion to just $1 billion within a span of 3 years. But thankfully, before this dot-com bubble crash, he made one very, very important decision. And that was to invest in this company called Alibaba. So back then in the in the 1990, around 1999, through SoftBank, he actually made a $20 million investment into Alibaba. And that investment was actually considered one of the most successful in the history of mankind. So that $20 million, guess today how much it is worth? He managed to turn it to about $150 billion today. And that in one investment actually saved him. Out of all the 100 over investments that he made, this was the only one stock that saved him. There were probably a few other smaller ones, but this was the main one that saved him. 7,500% returns. Investing is hard. And the third story that I have to share with you all is how investments sometimes don't make any sense. It can be totally disconnected from its fundamentals. In US, it used to be a high percentage of the population were smoking. Okay, so about 1960s, about 45% of the population were actually smokers. And in about 1964, the Surgeon General, or similar to the head of health in US, actually published a report on the negative effects of smoking. Okay, and because of that, in 1970, they banned cigarette commercials, advertising. I think because the kids were watching, they didn't want people to be influenced to cigarettes, so they banned the commercials. After that, they doubled the taxes on cigarettes, and then they doubled it again. And then in 1986, they issued a second report saying the ill effects of secondhand smokes, and then they started to limit the people who can smoke on the streets, right? So when looking at this chart, you might have been thinking, wow, the market share of this industry is shrinking all the time. The industries there must have been decimated. But that was the very funny thing that happened to this company, this particular company called Atria Group. They're actually the second largest cigarette manufacturer in the world. And in 2017, Morgan Housel actually tweeted this comment that US cigarettes consumption dropped 44% since 1981, but yet the stock is up 71,000%. Okay, I went to Google, managed to drag it out. I didn't manage to drag the lowest point, so I didn't get 71,000%, but I managed to get 18,000%, which is still a lot. And in case some of you are thinking that, oh, because cigarette is addictive, it's hooked, the overall base of the number of people smoking actually more than half since that time. So it's actually more than that. And investing can be hard. So the reason for this is when you look throughout our investment journey, actually you realize that successful investing is actually counterintuitive to our human nature. And it's always a long-term process of retraining our minds, long-term learning. And that's how we get better and think differently. Okay, so today's topic, I want to share with you 4 lessons on how behaviors can sabotage your portfolio. And these lessons will actually draw from these stories. Okay, the first one. When I first started out as an investor about 8-9 years ago, I still remember that, wow, after learning from VIB, or back in the time it's called Millionaire Investor Program, MIP, right? So, wow, I could actually potentially time the market. I could potentially, after learning a few technical indicators, know when to invest, save up my money, and only invest in the bottom, right? And so that's what I thought. And I saw this experiment being done, and I also replicated it myself on Excel. And I like to tell this through 3 friends, okay? Brittany, Priscilla, and Stephanie. So all these 3 friends, they save $300 a month. And of course, like you and me, we love promotions. So the promotion also translated to a 5% increase in their savings every year. It was estimated that they invested in S&P 500 index, okay? So they did not do their own stock picking. They just invested in the index, plain and simple, over a period of 35 years, okay? 1980s all the way up to 2020. But each of them had different strategies, and this is the real interesting part. Okay, so S&P 500, as you know it, since this period of time, 35 years, there were 4 major crashes: the Black Friday, dot-com bubble, global financial crisis, and of course the most recent COVID. So Brittany, our first friend, she believed in timing the market. She held cash. So she would save. And whenever she heard of major crisis that was going to happen, then she will put in all her money. But somehow, as luck would have it, she had bad timing. Okay? Somehow she found herself, the indicators all gone haywire somehow, and then she found herself investing only right at the peak of that market time. And because of that, she's called Bad Luck Brittany. But there's a really important thing here, is that even though she invested at the wrong timing, she held on. Okay? Our second friend is this girl called Priscilla. She also held cash and saved. And then once the market was right, she believed that the market crashed, she went in. But this time, she was having great timing. So she managed to pick up all the bottoms of the S&P 500 index. Let's call her Precise Priscilla. And our third friend, Stephanie. She thinks timing is too complex. Despite learning all that she has learned, she thinks timing is too complex. Nobody can perfectly time the market. So what does she do? Every month, the $300 savings that came in, she just deployed it. She bought a bit. Market up, she bought. Market down, she bought. Steady Stephanie. So out of these 3 friends that we see here, they would have saved about $361,000 over the 35 years periods. Bad luck Brittany, despite timing the market wrongly, she still turned out pretty okay, almost managing to double her money. Precise Priscilla, because her timing was impeccable, she got out with $1.1 million. And Steady Stephanie, she came out at $1.3 million. Okay, some of us, I know what y'all might be thinking. I'm not as, my luck is not so sway, right? Not as bad luck as Brittany. But maybe I'm also not as precise as Priscilla. So maybe I'm in between. Okay, so that would be the in between, about 900 over 1,000. But you realize here the difference is how much? Over $400,000 difference. And what was the reason for that? For putting in a lot more effort to time the market, to read the charts, as compared to Stephanie, who just dollar cost average. So this is Peter Lynch. He ran a very famous medallion fund, Fidelity Medallion Fund. And for a period of 13 years, his fund actually performed to a compounded growth rate of about 30%. And this is what he had to say. Far more money has been lost by investors preparing or anticipating for the markets rather than being lost in the correction themselves. And why did he say this? Because very interestingly, in his fund, despite being one of the best performing funds out there at that time, he realized that more than half of the unit holders of his fund actually lost money. And so he was scratching his head. Why did the best performing basket that he's picked, why did investors even lost money? And you realize is that people were like Britney. They invested at an all-time high, but then when the stock plunged, they pulled out and they never came back in again. So the difference is actually that Britney held on and continued plowing in. And of course, so we don't need to go through the example of another character called Panic Polly, I guess. So I'm sure that all of us having attended various investment courses by now, we know this thing called emotional stability. And that is actually one of the key lessons, is that we can outsource stock picking, but we cannot outsource emotional stability. And emotional stability, whether it's through a money manager or doing it yourself, is actually the key to compounding your wealth over time. Okay, so bad luck Brittany would say, wait for a crash, I better hold cash. And Steady Stephanie would say, don't mismanage dollar cost average. So it's not the time in the market that counts, but it's not timing the market that counts, but it's time in the market. The second behavioral downfall of investors is when they attempt to when they attempt to think that the stock market ran out of steam, right? Okay, so this example is one of Amazon. Back in these early days, by the way, this chart here is stated not in share price, it's stated in market cap in USD. So Amazon's market cap was around $430 million when it first started out, right? And an IPO investor, you know how like now SaaS companies are really hot now? A lot of people are actually flipping the IPO. Back then, internet companies were the hot thing. And people were actually flipping internet companies day in, day out. And for example, Amazon, if they had bought it at around 430 million market cap, 5 months later, they just held it for 5 months, it became a 200 bagger. And so many investors will be thinking, boy, am I a genius? But then sometimes people think, hey, if it's run up 200% within 5 months, has it ran out of steam? Should I take some profits out? Until you see what happens to the stock, of course, with hindsight bias, over the next 1.5 years later, if you had held on, the stock will be worth 6,000% returns. And then, of course, some of y'all would say, I've been to investing courses. Of course, I know price versus value, right? Price is what you pay, value is what you get. Where's the IV line? Where's the intrinsic value line that we see on VApp? So, okay, here's the intrinsic value line. True enough, it was right at the peak of a dot-com bubble. But even then, what you realize is that within that dot-com, within that period, the share price just keeps going up. Even 14 years later, become 18,000%. The sales, as you can see in the back and the bar charts, the sales is actually in the gray bars. Sales keep growing and growing and growing. And one of the fallacies of taking profits too early, especially when a company is performing perfectly, like Amazon, year on year, the revenues were just growing and growing and growing, is that sometimes when we sell it off, we can forget to buy back into the stock. And this will be one very painful stock to miss out on, especially if we have done our homework, we have read about the company, and we think it's a great company. Fundamentally, nothing wrong, but yet we want to, I better take profits because it's ran out of steam. Right. So if you have a look at S&P 500, why is it that even bad luck Britney could perform so well? Is that throughout the 35 years, or in fact, throughout the life of a stock market, what you realize is that most of the time, they will be spent in the bull segments. Only a certain period of time, there will be a bear market. So actually, when there's more percentage in a bull market than a bear market, do we think that we can go and time that very small sliver of a time where we can say sell off at the highest point and buy at the lowest point? We only need to be wrong a few times and it would totally wipe out our portfolio. Okay, so the key thing is always stay invested, and especially when we start to look at super stocks, okay, stocks that are just creating great value, solving key problems for the market. super stocks tend to stay overvalued for a prolonged period of time. Okay, so some of the strategies that I personally employ is that I will always stay invested no matter how overvalued the company is, because I'll never know when they might remain overvalued for the next 1 year, and then just drop back a little bit during a market crash. So what some of y'all might do is that y'all can go and buy a put, buy an insurance on the overvalued companies, but that one will be a more advanced topic, and that one probably will be covered in VIOS Plus. Okay, so Bad Luck Brittany says the stocks ran too high, time to say goodbye. Steady Stephanie says you can't time the market, always stay vested. Okay, and with that, we are probably likely to forget to buy in, and always our mind, actually this is one of the more important points, our mind is always stuck at the previously sold price. So imagine you buy a stock at 100 and it ran up to 150, you think it's overvalued, you sell it, and let's say it stays overvalued for a period of 1 year, and because of that, the intrinsic value suddenly jumps to $300, right? Do you think you can buy $300 fair value when you sold it off at 150? Most of the time, probably not. Our mind is still stuck at that 150 price point, but the company has already moved on and continue compounding. Okay, so the third point is about numbers. What happens when we see that the fundamentals go a bit off? Okay, one of the most misused quote of Warren Buffett is actually that the holding, he always says my favorite holding period is forever. But what we realize is that the holding period is forever only when the management executes forever. So it's not always that we have to hold on to the company. And with that, I'd like to share with you all this interesting book called The Art of Execution. Okay, this author, Lee Freeman Shaw, he was actually a wealth manager, managing billions of dollars. And Lee Freeman Shaw, he actually he managed a high net worth individuals' portfolio, right? And he will actually allocate them to equities, to stocks, to bonds, to properties, to gold and whatnot, and diversify. And so with the equities portion, he actually selected 45 external investment managers to manage a concentrated portfolio for him. And between 2006 to 2013 was this period that he recorded this study. And what he would do is he will instruct all these portfolio managers, and some of them are actually legendary investors that will actually read from books, right? Excuse me. So he will instruct them to invest in their 10 best ideas. And what he got not surprisingly, was that he got very divergent results. Okay, he observed that each one of them employed different methods. Not all of them had very good stock picks. Very good as in when the fundamentals are good, but the share price do not appreciate, you do not make money, that's considered as not good. So in order for investment to be good, you need to pick the right company, and the price, of course, needs to appreciate over a period of time. And what he found out is that only 50% of the stocks that were picked by these legendary managers were profitable. But yet, some of these, a small sliver of these companies, right, actually outperformed and in fact performed very well. And it was actually boiled down to their execution strategy, how they execute on this. And he actually categorized these investors into 3 groups called the rabbits, the hunters, and the assassins. Okay, so the assassins are the groups that promptly deals with failure. So those that did not run up, or those that the fundamentals suddenly took a turn for the worse, they will actually be very quick, unemotional. They'll cut the position and they'll move on. They'll probably redeploy. The second group are called the hunters. They will watch, they will wait for the right timing, and then they will average down. And because they did that, they actually reduce losses, and then, even if they did not reduce losses, they will actually bounce back a lot faster if they were holding on to that position. And the rabbit was that group of investors that just did not do anything. They just think that, I'm investing for the long term, I'll just hold and I'll do nothing. And not surprisingly, they are actually the worst performers. Okay, so there were 2 situations, right? One is the fundamentals, one was the price movements. So a right fundamentals, wrong price movement is considered the wrong stock because we timed it wrong. Okay, and then of course there's the wrong fundamentals. That means the fundamentals took a turn for the worse and the price also dive. Of course, it's a wrong stock. Wrong fundamentals, right price, it's a time bomb. Okay, so out of these 2 assassins and hunters, between chopping and redeploying and averaging down, this was documented to be the better movement. So if the company, there's nothing wrong with it, but the price move against you, maybe it dropped for some particular news, or maybe it did the growth, maybe instead of 45% growth year on year, it become 30% and investors panic sell. So hunters and assassins, both methods can be deployed. But if it's wrong fundamentals, we will want to chop it off immediately. We don't want to be doubling down on a company that's potentially bad. Okay, same for the time bomb. No matter what the price moves, it's always a bad idea to be doubling down on a bad company. So let me take you all through this in terms of an example. And the example here is JD.com. So in May 2018, we see that, in January 2018, we saw that JD.com was actually at the all-time high, $49. And 1 year later, in December, it actually plunged to an all-time low, $20. Investors who bought an all-time high would have seen their portfolio or this particular position at a negative 50-60%. Okay, of course, it bounced back up further. But let's look at the rabbits, how they would have performed through this scenario. Okay, so if they had held on from the all-time high purchase all the way to till when they make money again, it will be about a 2.5 years wait, about 2 years wait. Okay, when they break even again and they outperform, it's about 2 years wait. The hunters, on the other hand, at every 25%, okay, let's say every time the stock price drops 25% from their position, they would add on more and add on more. And if it drop again, I'll add on more again. And so you can see from the average price, the hunters will actually lower their average pricing from 49 to 42 to 35, finally is $30. And even though it dropped to a low of 20 at December, when was the next time the price came back up to 30 for them to break even? It's actually just 1 year later. So instead of having to wait 2 years for their portfolio to see green, because they doubled down, their portfolio actually turned green within 1 year. And actually, this is very important during crisis. And then the last is the assassins. The assassins will just set a certain price target. The moment the price drops from their certain position, they will just chop it off and find another stock which the right finances and the right price momentum, and you just continue to repair that position from there. So different assassins would set different stop loss measures to go and redeploy. But we realize why the assassins do that is that the more we allow a stock position to drop further, the harder it takes, the harder the slope it must climb to get back up to that same position. So if the stock dropped 5%, it only takes 5.3% to come back up to that same price. If the stocks drop, say 25%, it takes 33% stock increase, whether it's in another stock or that same stock, to come back up to that same position. But what is shocking is that if you let it drop 50%, it needs to come back up 100%. If you go and take it out, redeploy, or decide to go and cut loss, you need to double your money elsewhere to go and make back on this original investment. So of course, you won't even want to go further. So normally, my personal ideal is around 20 to 25%. Yeah. So bad luck Brittany would say, the number's slightly wrong. Should I stay long? And Steady Stephanie would say, when the stocks don't fit, be quick to quit. Okay, so it's always buying slow. We want to buy and dollar cost average over time. But the moment where we notice something is off, we want to chop it and fast. Okay, so this is why sometimes what I've seen is that even some of my mistakes last time is that we would like to build long-term portfolios, right? We will buy portfolios based on speculation, based on what our friends told us. We don't know the fundamentals. And so when the stock goes up, we want to cut and take profit, right? We want to keep the money in the pocket, so to speak. But when the stocks go down, then the price goes down, what we realize is that we want to hold on, right? Hold on until it breaks even. And what we are left with is a basket of companies, which we call long-term portfolio. We want to let it, hopefully, that it will break even, right? And this basket of long-term companies, you know the quality and the condition. All of them probably had something not that right with it, and then we are just holding it. Okay. So, and Peter Lynch called this plucking the flowers and watering the weeds. Okay, the last lesson that we have is on conviction and position sizing. And this is one of the lessons that we at Hidden Champions Capital learned. And it's actually one of the lessons that is one of the most important as well. So here you can see, sometimes we are taught to have a few companies in our portfolio, right? So here I did an example of 10 companies, right? And let's just say the first two positions, and out of $1 million that I have to invest, the first two positions, I think I have high conviction. I really did a lot of research on it. I read up about the company. It took about half a year for me to read it up. I think I can size it up to 30%. So the other two, maybe I think I just briefly browsed through. Maybe I spent a week on it. I was just 10% or 15%. And the others are just, I heard from friends, looks interesting. I'll just quickly allocate a investigative stake. So 100% deployed into these 10 positions. And if it actually does well, what we realize is that it is all good. Okay, so if the top two positions or top three positions or top four positions does well, it's actually all well and fine. But then what happens if is the inverse? Is that you find that it will underperform. And these are the two examples. Okay, one from position sizing, one from equal gains. And these both sizing and equal gain and equal positions are actually based on the same gains. So from the equal side of things, actually it's just 100,000 on each company. I didn't play with the weightage. And look at the difference in terms of gains. And why this happens is that sometimes the companies that you pick, you have the highest conviction on, they might drop for no particular reason, and they might drop for no fundamental reason at all. It could be, say, trade war, and the company happens to be in that zone and is performing really well, growing really well, fair value to undervalue, and it just tanked. And so then this would be the difference in position. And sometimes those small companies that you would not expect, but because you pick them through a very stringent criteria, they came up. So how is it like in real life? Is that sizing, when you size a position, it's almost like you're putting different target boards. Imagine a field, right? You're playing archery. In a field, there are different target boards. Some of the target boards, you put it very far away. That's a 1% stake. Some of the target boards, you put it very near. That's your high conviction bets. But then the scores on the boards are randomly assigned by a judge, right? And so you have to shoot. You imagine then on the other side of the field, you imagine another same thing, target boards. But these 5 target boards, you put them at equal distance, same distance to you. And also the scores will be randomly assigned. So which of these two do you think you will have a better chance in scoring? Well, when every month the score changes, right? Is that when you're able to shoot consistently, you realize is that the one with the equal weighted positions will tend to perform better. So instead of sizing up based on convictions, we should strengthen our selection criteria. So things like sales growth, flow gearing, earnings quality, investing into visionary management, these are the things that you all would have learned through courses or reading books, right? But the thing is that we need to strengthen our basket of companies. So bad luck Brittany would say, I have strong conviction, size up position. And steady Stephanie would say, strengthen your basket, equally planted. So sometimes stocks drop for no fundamental reasons at all. Okay, so with that, these 4 lessons that we have learned today, we actually summarize them, and of course more lessons than that, and we actually automate them into this fund that we have been starting. So I've been working on this fund for the past 1 year or so with a test position. And what this quant fund does is we actually automate all of these investment principles that we've just shared today. So much so that we want to weed out all the human emotions with regards to investment decisions, whether it be too heavily invested, don't want to cut loss, or the share price went too high, market timing thing. Yeah, so all of it, we lay down the rules when we are still sane and our emotions are still steady, and then we set it to run automatically. And this is the track record of this portfolio that we have done. Since March up to January, which was updated just a few days back, the S&P 500 was up about 47%, NAV about 147. Our fund, this test fund, is up about 147%. Okay, almost 100% difference. And I know that this period of time is a very unique period, right? A lot of people will say, oh, you close 2 eyes, you throw a dart, you probably get a stock that earns money. So that's why we have the bottom chart. What we want to see is actually that this basket of portfolio companies perform higher than the index. When the index rises, we rise higher than the index. When it drops in September, October, it drops lower than the index. Okay, so this is how we see if this strategy is working out. And of course, there's a very important disclaimer, is that 2020 was a rather unique performance, and we actually do not expect similar returns to repeat. If it does good, we're very happy, but we are not expecting this kind of 150% returns year on year for the years to come. But we actually aim to increase more than the index and drop less than the index, as well as to automate the whole investment process. So with this, I'd like to maybe just take three lessons from some of these experiences that I've had with this portfolio company. So actually, all these lessons that I've shared with you today are my personal learning experiences through my 8 years of investing. And even though I've invested for about 8 years plus, I still somehow is susceptible to this kind of emotions. Like for example, in the March drop, how many of y'all were buying more when the stock price dropped in March? Okay, I was, but I made one very interesting error, which was that I thought, whoa, after 10 years, finally, from the global financial crisis, right, this is the crisis that I've been waiting for. It crashed, it picked back up a bit, and I sold off, and I was waiting for a bigger crash for that one particular position, thankfully. The rest of the portfolio was not that itchy fingers, but this one I had trade desk in particular. I had a high conviction on it. I sold off after it rallied, thinking that it was overvalued. Okay, so even for the fund, okay, so this was where I bought this company for the fund at about $170 or 19 billion market cap. It ran up 76%, thinking that I'm a genius, right? And I sold it off. It must be overvalued. Some more the crash is coming, the COVID is coming, economies are suffering, right? And now I sold it, despite me selling it off, it's up about 300%, over 300%. And who is to say, and now I can't get back into this position because it's up 300%, way overvalued. And who is to say it won't stay overvalued for the next 1 year, because 1.5 years. And by then, I don't know, it might be overvalued for the next 1 year, and that 1 year it will have increased a lot, and I still can't buy in because it's overvalued, right? So probably dollar cost average, but this is one of the really painful lessons that I've made. Selling an overvalued stock because I think I can time the market. Okay, the next one is buy slow and chop the losers. This particular company called PaySign. Okay, so this company, we bought into this company and it gave us about 84% gains. But then the fundamentals were weak. Okay, the numbers were weak. And because of our equal position sizing, it had less than 5% AUM of the company. But the good thing was, because we coded out all our investment criteria, everything that we intended to do while we were in stable emotions is coded down. The program sort of said, okay, chop PaySign at this period of time. So instead, and from that peak to the bottom, it was about a 71% loss, even up to today. So instead of taking a 71% drop in this company, we had an 84% gains for this particular position. And of course, holding and adding on to your winners over time. Again, this stock, Celsius, we were actually invested in this stock way back since in April. Fundamentals wise, we saw that it was perfect. It was growing, quarter on quarter it was growing, but it had one flaw. When you actually go and Google the news, it was actually one of the stocks that was heavily shorted. Okay, apparently one bear fund actually wrote a negative thesis on it. So, but like a Tesla story, they managed to increase their revenue despite that bear story. And what happened was a short squeeze, which shot this stock up. So this was actually one of our best performers in the fund. So that's why when in investing, we want to be strengthening our basket. Okay, so this is a sample of top 30 companies that we are holding in this fund that we have. Celsius has given us about 680% returns, and the top 30 is all above 30 to 40%. So it's not a recommendation to buy, sell, but then these companies are very dynamic, right? 1 month later, if the fundamentals drop, we may chop it, or we may add to other positions as well. So it's a very dynamic list. Doesn't mean that when we hold it, it's a good company to be holding forever, right? Okay, so but what we did was each company less than we equally distribute the companies, equally distribute the funds to each companies, right? And then they are adjusted monthly. So every month, as the companies release their earnings result, we will just have a look at the report. We'll crunch it through the computer, and then you just churn out a list. Oh, these are the companies to put away. These are the companies to add on, and we rebalance the stake in the company every year. So what you can see when you strengthen the basket, what you realize is that we want to shift companies from this zone, shift it all the way up to be in this zone as much as possible. So our ideal scenario is to have more companies over a period of 1 year or more to be in the better zone. So we want to always strengthen our screening criteria. Okay, so this quant fund that we have, we are planning for about, okay, this is a bit of a shameless plug here, because our fund is actually planning to be launched in the second quarter of this year, between March to June 2021. Okay, so it is planned to be about 50 to 100 positions. Currently, it has about 60 stocks. Okay, oh yeah. So it has about 60 stocks currently in the portfolio holdings as seen here. The companies that have been transacted, that means that we have chopped up, is chopped off is about 30 over companies throughout that 1 year period. That means because this is an unusual year, right? A lot of the companies that do not make it, that show signs of weakening, we chop it off really quick. So we have went through about 95 over companies in the portfolio. But we plan to hold about 50 to 100 stock positions, equally weighted. We want to code our investment strategies into an intelligent yet emotionless, repeatable process so that we can chop the losers fast. And yet, to strengthen the basket, this is where we employ statistical machine learning to support the research criteria for the stocks, as well as the portfolio allocation. So this was how I was able to draw the various lessons that I was sharing today. And of course, we backtest our strategies over 15 to 20 years period, including financial crises. And this was how we know to always stay vested. Okay, so with that, that comes to the end of my presentation today. Thank you very much for listening in and giving me your attention. I hope that today's lesson, you all will be able to bring back to use it in your own portfolio, and may you compound your portfolio in many years to come. For those who are interested in the Growth Quant Fund launch, you can take the QR code link. So when we launch it in March, we can contact you guys if you are interested. Okay, so it's for accredited investors only. For those who love efficiency, love automation, and wants less risk in their portfolio. And with that, I'd like to wish you all a happy early Chinese New Year. Thank you.
Now, let's do a recap of what we have learned just now. Okay, in terms of the morning where Ken gave you the ang pao. All right, I'll give you the 3 ang paos of course, sharing with you about V College. Remember, 8V Holdings itself is a listed company. Okay, and for some of you, let's say if you want to also take a look at what is the upcoming trends, you would see that we talk a lot about these few topics, which probably time and again, you will be hearing from the next few speakers as well. Like, for example, Clive mentioned regarding the grain population, especially in the Asia. Yeah, Southeast Asia or even Asia, some of the, in fact, many developed countries, you are seeing in terms of grain population. Big countries like, for example, China, Japan, Taiwan, Korea, all these are really something that we need to look at. Where are the opportunities in the future? Then the next part would be about digitalization and also, you know, e-commerce. Now, e-commerce in itself is not just for the young people. I think the COVID has also trained many of our more senior population to go over to e-commerce. And now with digitalization plus healthcare, this is something that you can work on to find opportunities as well. In fact, JD and Ali, they are not the only ones that's in so-called the e-healthcare. There are others as well. Like, for example, I personally have gone into this Ping An Healthcare as well, where the consultation of the healthcare of those doctors is actually online. This is the big wave that is going into, especially with the COVID situation. More people are more comfortable right now to go on to medical consultation online. But of course, buying shares is one thing. Holding, selling is another. So this is where just now, Joshua, I find it really useful. He has addressed some issues, or in fact, the key issues that many of us, not just you, us are facing. In fact, our analysts, I tell you, even Ken Clive themselves, we will always have this dilemma. For example, we can never really influence the share prices. As much as we have done our fundamentals, we have done all our research. For example, okay, you can see that in terms of the research, just now, Joshua has mentioned about trade desk, let's say, or maybe even LMND, or even Fastly. It can shoot up, then after that it drop. When it shoots up, of course, your mental will be thinking, yeah, I buy too little already lah. Then when it shoots up to 200%, 300%, you might be saying, wow, these 300% returns, should I sell them away? Or should I do this thing called capital recycling? So once you sell it off, if it drops, wow, you kind of like have a good timing. But sometimes you say you sell it off and then after it shoots up even more. What to do? So it's always the case. And I believe you would have questions on that. So what to do, huh? This is what Singaporeans and Malaysians, we like to say, right? So what you can do is this. I think the best is straight away go and ask them questions. Why not like that? I will invite Clive and Joshua to come on board. I believe you have questions, so think through that questions, okay? So if you have your questions for Ken and Clive, how to buy shares, how to sell shares, just now Joshua is mentioning regarding, in terms of what time in the market or timing in the market, some of you are very blur. You can ask these questions now. I'm going to invite Clive and Joshua up on stage. Type your questions in the Q&A. Your room IC, your moderators are going to consolidate all these questions, and we will ask Clive and Joshua to answer on the spot. Joshua and Clive, please.
Hi, good afternoon, everyone. I hope you had a great lunch. Thank you for sticking with us throughout this when we're solving some of these issues. Okay, I just want to bring up the QR code for the last segment. Don't worry, they'll be playing back the recording of just now the presentation earlier. But I want to bring up the QR code earlier. So I think, as I mentioned earlier, is that we are planning to launch this fund from March to about June this year. So I think we've really come a long way with where we started out for Hidden Champions Capital. And we are actually planning quite a lot of solutions for you guys. So one of which, for accredited investors, there's this Hidden Champions Growth Quant Fund. And then for the non-accredited investors, we are actually thinking of a data-driven solution for you guys as well. So please do let us know if we should continue working on these projects. You can scan the QR code and let us know your interest. And by the way, Clive, we really have come a long way with what we have with the Quant Fund, haven't we?
Oh yeah, I think when I look back at our own journey, especially our own investment journey to reach at this stage, all right, to be at the Quant Fund, all right, it was very interesting because when I look back at my how we started, all right, looking at quantitative numbers, financial numbers, assessing companies, right, and looking into some of the details, let's say in the annual reports, prospectus, and developing that into VApp, translating all our investment process inside. I think it has been quite a journey, and I realized that actually the investment process has actually evolved over time because of also business evolution itself.
Right. And I still remember back in the days when I joined the company about 6 years ago, we were manually looking through the annual reports, taking the numbers, keying into Excel, and then with that, we have the standard template ratios. And actually, in solving our own problem, we incidentally created a product. I mean, with the help of everyone else, we created a really interesting product for everyone. So I think going forward, that's where the Quant Fund is as well. I mean, even in simplifying the analysis, we want to simplify further with the emotional part of it being taken out. And I think that's where this Quant Fund came about. And I think in this world and age today, with technologies abound, if we do not disrupt ourselves, I think we are bound to be disrupted by others as well. So why not do it, right? Yeah.
Yeah, I also realized that actually investing it's not just an intellectual game, it's an emotional game, right? I mean, when you buy the stock, you did your research, you buy a stock, a lot of conviction, and when the price come down, it's like, wow, it may not work out the way it does, right? I mean,
I realize is that when we are calm, we can actually have a plan.
Yes.
But then when things hit the fan, right, everything just blows up, and then we're like, wow, kalang kabut. So actually, we need a system and process to really calm our minds and think through. Say, okay, before this thing happened, this was my plan, so I just follow, and that makes things way easier.
Yeah, this is, exactly when the tire hits the road, that's when you know what will happen. Huh?
Yeah.
But maybe let's address some of the questions that was arising, during our segments. I think there was one thought, that there was some inquiry, whether the quant fund would be like an ETF or something along that line.
Right. We definitely have plans to use that similar strategy to build other products for the moment. But for now, it's going to be more like a hedge fund that we are planning for the launch in March.
Yeah.
I think one of the question here is also, okay, Irene was asking just now, what is the meaning of time in the market? Okay, so when I was like mentioning timing the market versus time in the market, that means your allocated capital is invested in stocks and stay vested. So the time that the portfolio of your assets stay invested in these companies is time in the market. Yeah.
Yeah. And I think also there were some specific questions. In fact, I thought this was quite interesting. During my segment, I was sharing about Ali Health and JD Health. Then obviously there was this question that came up that says, you know what, have I looked at Ping An Hao Yi Sen, right? Good doctor, right? Now the thing is, I have actually, but I think between the few, all this business itself, the Ping An Hao Yi Sen, in my opinion, show a bit less promise than Ali Health and JD Health. And there's a very fundamental reason why. Of course, this is my opinion only, and that's why I only share those two. Now, the Ping An Hao Yi Sen, the issue with the model is that they actually attempt to scale via the service, which actually, in order to scale successfully online, we always have to productize the service.
Right.
So it's a matter of, if it's always scaling through a service kind of approach, it may be harder, right, to grow compared to, let's say, Ali Health or JD Health. That's why I feel I have more optimism for those two companies. But that's not to say that Ping An Hao Yi Sen may not be a stock that you can consider, right? But it's just something that, I think it's a very good question, right? I think definitely we look at all the peers for all the companies that we looked at.
Right. And okay, the next question was asking regarding the three friends, right? Steady Stephanie, why is she earning more than Precise Priscilla?
do they even remember the context?
I hope they know the slides are there. Okay, the reason why Steady Stephanie was earning more, so this was an experiment that I repeated and on Excel myself. And what I found was that when you expose your capital to more upside, you remember the chart where I was showing throughout a 35 years period, and there were more bullish periods than bearish periods. So actually, when you expose most of your capital time in the market to those bull periods, that's why Steady Stephanie performs better than Precise Priscilla. Well, for Precise Priscilla, most of her capital was actually held in cash. It was not growing. In fact, it was being eaten up by inflation. So, and the difference is that one had to do a lot of work timing the market, and the other one is just don't need to think, just every month the saving, put it into a basket of portfolio, which is in this case was the S&P 500. Yeah, I hope that answers the question.
Maybe you answer most of the questions related to your segment first before I do mine.
Okay. So the next one is, how does setting up a stop loss gel with the advice of a dollar cost averaging and holding on to the position? Okay, so the assumption here is that if the company has good fundamentals, okay, what do you do? Do you do a stop loss versus dollar cost average, or do you double down? I feel is that both from the book, The Art of Execution, his research, Lee Freeman Shaw's research shows that both works, both is better than doing nothing at all. But when comparing the two, one of it is actually having to wait for that period where the stock actually plummet and then come back up again. But then because your dollar cost averaging brings lowers your price point, you can come back into the green a lot faster. But there's still that waiting time. So that's for the hunters. Okay, those who wait for a good price to double down and then they double down. Then the other one is the assassins, which the moment they reach their certain trigger points, say 25%, 30%, no question asked, they'll just chop first, and then they'll redeploy that capital into another stock, which is actually running up and performing well and maybe fairly valued and so on. So you realize that there is no downtime at all, no waiting. Because normally for stocks that, let's say something is wrong, there's something wrong with the news or fundamentals is fine, but let's say there's a new scare, it'll take some time before the investors actually get their confidence back up again on the stock. And that time that the money is sitting on that stock is actually time loss compounding. So the assassins, what they do is just chop, redeploy, I'll come back and revisit later. And I guess a lot of us, right, we are emotionally vested into a stock that we research. And that's why we can find it really hard to chop sometimes. And that's why we have the quant fund to really just tell us, chop this, redeploy.
Yeah, okay. Maybe I will address some of those questions relating to my presentation on my segment. Yeah, actually, I think there were quite a number of questions on the pre-IPO activities for, let's say, especially JD Health in this case. Maybe just to emphasize, what is price stabilization, which is one of the questions asked. Now, many companies, when they go listing, they actually engage brokers, and it is legal in most exchanges. I think ASX doesn't allow, but Hong Kong Stock Exchange, which is where they are listed, they do allow for a price. That means they can engage a broker, all right, financial institutions to actually stabilize the price so that the stock price doesn't crash on the first day, which can be very very bad for the company, right? So they would actually disclose that, let's say within the first month, all right. Basically, the stock price should not go below the IPO, all right, IPO price itself. Right. But of course, after 1 month, usually this sort of, I call it price stabilization action, all right. In most exchanges, they will stop very quickly. I mean, within a month or a pretty short period of time. Now, the other thing, of course, relates to how actually the pre-IPO investor came into JD Health. Now, if you look at the JD Health prospectus, you will know that, or you'll be able to see that there are quite a number of funds. If I don't recall wrongly, I counted about 13 of them. 13 of these funds have actually invested almost a year before that. Some of them, just a few months before the IPO, right? And those at the Series A, which is almost a year before the IPO, have invested at a 71%, I think 70% discount, all right? And because of that, I would imagine, of course, when for pre-IPO investors, the exchange has always make sure that there's always a lock-in period, especially when the discount that they get is substantial, right? So in this case, for most lock-up period is in Hong Kong is 6 months, and basically, when JD Health got listed on 8th of December, all right, by the time they finished, all right, their lockup period, which is, of course, is after listing. So by right, it should be 8th of June, all right? But I wouldn't put it to so close that date. But 8th of June, after that, you will be fine, all right? That means these funds will be able to sell. And I think about it, if you have 13 funds, are they going to say, look, I'm not going to sell? Right. Some of them, I think, because they got so much profits on hand, some of them will be selling. So there may be some selling pressures at a point in time. Right. Yeah. But this is, of course, purely my take. Yeah.
Okay, the next question I'm seeing here by KP Leo is, when then should we be a hunter or assassin? Okay, so in one of my slides, if you all have gotten the slides earlier, there's a chart to show like whether the fundamentals are good or bad, or whether the price movement is good or bad. When should you be which? Most of the time, if the fundamentals are good, either is fine. A hunter, if you have a high conviction on the company and to double down, that's fine. If you want to be assassin, chop and come back and look later, it's fine as well. But the thing with being an assassin kind of investor to chop quick is that you need really a list of companies, of a list of target bought companies to be ready at the site, so that whenever there is an undervalued opportunity, you just swap them out. And that's why in generating that list and keeping it updated, automate it as much as possible. And that's actually what we do with the quant fund. And so that in order to shorten that lag time where, let's say a particular stock is not doing well, we have a whole list of other companies ready to go, and we can just switch it out. Okay, so that's the assassin and hunter question.
Okay. So I think maybe what I will do is, I think that's the last questions that we will handle here.
Yeah.
All right. I think we will need to go on to the next segment. So maybe what I will do is this, I will get Pauline, all right, to come back on stage, all right, to share with you what the next segment will entail. Pauline, please.
And right now, we are going up to go for the next segment. Just now, I keep highlighting and emphasizing on this part about decision making. Yes, these 2 days, we will be giving you quite a number of case studies, and you need to make your own decision. We can't make it for you. Okay, you have to do it yourself. But how are you going to make a decision whether to buy, whether to sell, when it goes up, what you do? You know, a lot of times it is not just based on emotions. There's a lot of things called like emotions, you know, biasness. You need to know how to make that decisions, okay? And make sure we have a basis and a framework to do that. So we are going to invite the next speaker up on stage, Mr. Melvin So. He is an expert in this area. He will facilitate your decision making process on how to reprogram your mind for your wealth and smarter decision making in the upcoming years. He's the co-founder of X Factor Method, and he will be here to share more about reprogramming your mind for wealth and smarter decision making. Melvin, please.
It's Melvin. Hope you're having a wonderful day at Value Investing Summit right here. Fantastic day. So today I'm going to share in the next 25 minutes, a very short presentation on how you can make better decisions. You see, we're spending a whole day today learning about different companies, different opportunities. But at the end of these 2 days, your life will be defined by whatever decision you choose to make. Whether it's a good decision, a bad decision, or no decision. You see, these 3 options are always available every single time to every single one of us. You see, we're here today talking about how we can make more money, how we can change our lives, how we can have more wealth, how we can grow our businesses and our finances. But all of that comes down to the decisions we choose to make. Every single decision we choose to make in our lives. If we make good decisions, our lives become prosperous. Make bad decisions, our lives are affected and we live to regret those decisions. However, here's a simple truth, and you need to understand why are we doing this presentation today? Very simple reason. It's because we're never ever taught in our lives how to make proper decisions. You see, every single day, we are being influenced, manipulated by people, marketers, media, etc. Every single one of these people have an agenda for us. You must understand that. Every news media you read, somebody's behind trying to influence you to make a certain decision. Now, when you grow up, your parents are the ones that influence your decision. Your boss is the one that influences your decision. We're never ever taught a heuristic, a system, a framework to make proper decisions. And because we don't have that framework, we often look to other people, we look to news media, we look to authorities and say, what should I do? Is it a good idea? We have no idea. And then all of these people tend to have an agenda sometimes. So today we're going to speak a little bit about how you can make proper decisions so that you can succeed. And then I have spent a very long time studying with some of the world's top entrepreneurs, coaching a lot of them, really hanging out with these multimillionaires and billionaires. And I watch as they make decisions, especially in this day and age, in split-second time. And I've come up with some things I think are very useful for you. The first and most important concept I have to mention today is all good decisions come when you are detached. I want you to write that down right now. Come when you're detached. See, there's a Chinese saying that says, 当局者迷，旁观者清. What does that mean? That means that you're unable to tap any of your intelligence and resources if you're very attached to the decision. If you're very close and upfront, you're very invested emotionally to whatever decision you have, you're unlikely to make a good call because you want desperately for that to happen. You see, desperation, fear, FOMO, these things affect our emotions and they affect our ability to make proper decisions. no matter how intelligent you are, this is why in all the investing stuff you see, sometimes some of the smartest investors in the world, smartest people in the world, they make really poor decisions. Why? Because they're hooked. I want you to write that down. They're hooked. They're hooked in the moment, their emotions. They're hooked by their ego. They're hooked by the desire to be correct. And when they're hooked, the emotions take over. They have no attachment. And then they are inevitably headed down the wrong path. But when you're detached, when the decision is not as important, when you put some distance between yourself and the decision, that's when you can activate your intelligence, your rational mind. And you can look at it and you can let the numbers, the facts, the figures do the talking. So you write that down. The whole idea behind making good decisions is detachment. However, we all know that we are all emotional people. We are all biased people. And detachment is not as easy, which is why I'm going to cover a whole bunch of things on how you can put a little bit of distance between yourself and the decision you're about to make so that you can make proper, intelligent, rational ones. So the first key we have to mention today is very simple. It's in the area of wealth. We are all here today because we want to make more money. However, the irony is this. I want you to all listen very carefully. The irony is if we chase the money and we are very attached, I must make this amount of money this year, you're going to fall prey to a lot of bad decisions. There's something you need to know. If it's very important to you, if you're overly invested, you see, you got to be invested in your goals, but if you're overly invested, emotionally hooked, you're going to chase the pie in the sky. You're going to chase the opportunity that turns out to be a bad one. So how can we put that distance? Very nice. Let's take a look at the first one. Number one is before you begin even investing, right? I want you to take a little bit of time. End of today, I want you to ask yourself, what is your definition of wealth and success? You see, if we do not have a grounded clarity of what our decision for wealth and success is, we're going to be influenced by all the things we see on social media. You're going to feel insignificant. You go on social media, you made 200K this year. You go online, someone made 2 million. And you're like, oh man, I suck. I'm not doing well. Right? You make 2 million, you go online, someone buys a new jet. You're like, oh my God, this is not good. You see, then you're emotionally affected. Then the next day, someone comes up to you with an opportunity. You're like, I feel insignificant. I'm going to jump on that. Bad decision. But if you have a very clear understanding of what your definition of wealth and success is, that is the most important. First key. What is your definition? Write it down. Maybe it's paying the bills. Maybe it's financial freedom. How much money do you need in order to be wealthy and successful? First key. Number two, you want to have a powerful reason why you want to succeed. Very important. Why are you doing this at the end of the day? You see, if we don't have a grounded reason why, we're going to fall prey to what? Emotions, ego, those things are going to hook us, and we forget why we even started on this path in the first place. But if I know my reason why, I know what my definition is, then I'm going to tune the noise out, and I'm going to be focused on exactly what I want. It doesn't matter whether this guy made a whole bunch of money in Bitcoin. It doesn't matter whether this guy made a whole bunch of money doing this. I'm on my path. I know this is what I want. I know why I'm doing this, and I'm going to get there. You see, that is clear. Very, very important. The next thing, you want to ask yourself, what else do you have in your life right now that's important to you apart from making money? You see, we all want to make money, but I'm going to tell you this right now. Money, at the end of the day, as a person who used to make $800 a month, eat one meal a day, right now to a person that has a lot of digits in a bank account, I can tell you fundamentally, money is just digits on the screen. Money is just, if I withdrew all my money right now from all the banks that I have, and I power it out right now, it's just pieces of paper right here. You see, I put forth to you that today, you don't want just money. You see, just pieces of paper, numbers on the screen. You want what money can bring for you. Ask yourself, why do you want more money? If you really think about it, you want more money for freedom, for family. Maybe you want to retire your parents, take care of your kids. You want more money to enjoy the things that you want to do. You want more money so that you don't have to work so hard and you can go and do things that you enjoy. You see, if you look at all these things, fundamentally we go one big round and we come back to what? Relationships. We come back to what? Freedom. And the moment you have all of these things in your mind and you understand that right now you have some of these things already, you have a family, you have all of these, you have health, you have all of these wonderful things, you can put a little bit of distance between yourself and the wealth. And what that means, right, is yes, we want to achieve it, but we are not coming from a place of lack, not coming from a place of fear, not coming from a place of scarcity. Very, very important. Because when we come from those things, we are emotionally hooked and we cannot make smart decisions. So please understand that there are a lot of things going on in your life right now that are good, especially if you're able to watch this presentation today, apart from just wealth. Very important. The next thing you want to ask yourself and really set in your mind is an inevitable mindset. What is an inevitable mindset? Very simple. You set in your mind fundamentally that I am going to reach there. You see, if you set in your mind ultimately that you are ultimately always going to reach your goal in a matter of 10 to 12 years, maybe even 5 to 7 years. You know you're going to reach there. There's going to be less fear. There's going to be less anxiety. There's going to be like, oh my God, I'm not going to reach it. What happens this? I need this opportunity. But if you realize, wait a minute, if I continue down this path, I learn value investing, I learn how to do options, I set myself on this path, I'm going to reach my goal inevitably 5 years, 7 years, 10 years. I can really see the end point. I can really see success. When that happens, notice how you feel. You feel a bit more calm, feel a bit more relaxed. You know it's inevitable. You know it is going to happen. That is very important, because when that happens, you relax. You start to activate your rational mind, your logical mind. It's you're being hooked emotionally. Very important. Next one. It's very important to understand at the end of the day, after you make all of this money, you see right now, you're here because you want to make more. And you have this idea in your mind that after you make a whole bunch of money, your life is going to dramatically change. To a certain degree, that is true. You're going to be able to buy a few things. You might be able to change your house, change your car, or pay off a few bills, or pay off a little bit of debt. You might be able to change some clothes, eat a little bit nicer food, go on some nice holidays. But after you do all of those things, you're going to have the realization I had after I went from $800 to quite a bit of money. I had a realization that life improves by a little bit, but then life is pretty much still the same. When you wake up, you still need to take care of all the things you need to take care of. You need to do all the things you have to do. You see, life improves, but not much else changes. It's just elevated by just a little bit. So if you understand that we're not chasing this dream where somehow we don't have something right now, and we need to chase that where we eventually have that something, and that is a promised land. Yes, your life is going to improve, but just by a bit. And you need to understand that. When you understand that, then you start to realize, okay, cool. So how can I make smart decisions, reach my goals, but ultimately bring myself to a higher quality of life? But it's not going to be like I don't have something, and that is the ultimate dream. Very important to understand. Always remember at the end of the day, the idea is what? Detachment. You see, when you do all of the things I mentioned just now, the one thing that sets in place for you is you have a clear understanding of what your reason why is. You have a clear understanding of what exactly you define by success. You have a clear understanding that you're going to eventually hit your goal no matter what. It's just going to be a matter of what? Time. It's no anxiety. Chill. You realize that you already have a lot of the wonderful things you have always wanted money to bring you, like health and relationships and all these things. You already have that right now. And you realize that money is just going to elevate that by a little bit, improving a little bit about your life. But it's not going to dramatically change it. And then you suddenly realize, wait, I'm okay right now. I'm okay. I don't have to chase that thing. I'm okay. And then what smart decision can I make so that I elevate the quality of my life? So that's the first key in the area of money. Now let's talk a little bit about decision making. Now, the one thing you may need to understand about decision making is I want to share with you this idea. It's called the Dunning-Kruger effect. What is the definition of true wisdom? You see, there are two professors, Dunning and Kruger, and they did a little bit of an experiment, social experiment. And they went out there to start interviewing different people, and they found that majority of people, despite having very little knowledge about their field of study, very little knowledge, they were very confident. And they suddenly realized that the definition of wisdom, in fact, some of the smartest people, they knew how much they didn't know. So it was very interesting. It was almost as if the people who knew the least were very confident in their ignorance, and the people who were very wise and smart and had a lot of experience were less confident because they not only knew what they knew, but more importantly, they knew what they didn't know. Isn't that interesting? So what does this mean? How do you apply this? Very simple. You need to understand fundamentally when you're about to make a decision, a few things are true. Number one, you are an emotional person. I don't care whether you are just a numbers person, you are an emotional person. You have emotions. And if you deny it, then you're falling exactly in the Dunning-Kruger effect. You're an emotional person, you are a biased person. You need to understand that right now. You have things that you like irrationally more than other things. Number three, you need to understand, apart from being an emotional and biased person, you have made mistakes before. You must understand your mind always deletes all of these mistakes, all the times where you messed up. And they tell you, hey, you know what? You're correct. But you understand, wait a minute. I'm biased. I'm emotional. I've made mistakes before. I've changed my mind before. And when you realize that about yourself, you understand that you are a little bit flawed in the way you think. Now, you see, the moment you understand you're a little bit flawed, you fall into what Dunning-Kruger called wisdom. Because you start to realize, wait a minute, I might make a mistake. And you're not foolishly confident. The moment you realize you might make a mistake, you realize, wait a minute, before I make this decision, please write this down, I need to counter my bias. That's very important. Counter my bias, where I start to realize, Okay, if I'm a biased person, I'm an emotional person, I've made mistakes before, then there's high chance that right now I could be doing exactly that. I need to counter it. You need to counter your bias. And here are a few ways you can counter your bias. Number one is you want to have what we call a devil's advocate, which means you must have people around you whose goal, or you must do research so that you extract information that runs counter to whatever you believe. You see, most people surround themselves. See, I coach a lot of top entrepreneurs. A lot of people surround themselves with yes men. You know, you have a boss right there, he's got an entire team of people, or his right-hand man, left-hand man, everybody's there to say what? Yes, boss, you are the smartest boss. You never make a mistake, boss. Yes, 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 yes. And we see a lot of companies where everyone surrounds and all just goes, yes, boss. Eventually, nobody wants to counter what the boss says. Eventually, the boss makes a bad decision, the company is headed down south. However, if there's never advocate, someone that goes, I disagree. I have a different viewpoint on this. The moment you have that, please write down, you have a balanced view. That is what balance is. Balance means not only just one side, you have the other side. See, one of the classes I do with Ken is called Rewealth. And there Ken talks about the idea of confirmation bias. How do you know something is correct? Well, if I take a look at all the things that oppose it, and if no such thing opposes it, or I'm able to counter all the things that oppose what my viewpoint, and I don't find that, then maybe this thing is correct. You see, the great Sherlock Holmes said what? I know something is true if I can find no other things that counter whatever it is, then inevitably this must be true. That's what we realize. So we must counter our bias. Take a look. So before you invest in the stock, you must go and take a look. What are some of the reasons not to do this? If I can find those reasons, I start to have a more balanced view. I start to decide, this is such a good idea. Number two, you must ask yourself, where do you get your certainty from? See, a lot of people are certain, but where do you get your certainty from? You see, you got your certainty because you read some websites. You went to Google and you went to search out some annual reports, or you went to search out some news articles, and you're like, oh my God, I read 5 news articles. It must be true. But always remember, as a person that owns a marketing organization, I can tell you right now that most news articles are little disguised marketing pieces. Behind that is a person. And that person is writing it less about informing these days, usually about putting forth a viewpoint, whether it is a political viewpoint or a business viewpoint. You need to understand that. So you need to understand where you're getting your certainty from. What is the intention behind the information that you're reading? Are you very certain that this is an unbiased thing? Very important to counter that. So when you take a look at this, you're going to study a little bit about the news media. And you start to realize, perhaps the news media too, behind them, because they're organizations that own the news media, behind them are people with intentions. And you got to ask yourself, are you consuming the right information? Are you consuming a balanced source of information? That is very important. Now, the third one is you must ask yourself, how long and how far is your perspective? You see, decisions, is it a good decision or bad decision? Sometimes we need to ask ourselves, how far are we considering? You see, there are some decisions that look like a very good idea in the next 10 minutes, but look like a very bad idea in the next 10 months, and look like a horrible idea in the next 10 years. So the moment you stretch your perspective out, what is the definition of maturity? Very simple. It's to look at a single decision or a single event from a wider perspective. You see, a child sees only right now. A teenager might see only next week. But an adult, and a mature adult, sees long in the future. He realizes, wait, when I do this thing, it's going to have repercussion and consequences. The ability to see far into the future is the hallmark of maturity. So right now, before you make the decision, think to yourself, what's it going to look like in the next 10 minutes? What's it going to look like in the next 10 months? What's it going to look like in the next 10 years? Then you start to think, this is a good decision. Very important. Ask yourself, number 4, what happens if this decision doesn't go well? Am I ready? Am I prepared to deal with the repercussions? You see, the brain, when it comes with bias, there's an optimism bias. What does optimism bias mean? It means you only see the upside and we never ever see the downside. The great Richard Branson, Virgin, billionaire, he mentioned what? Well, when I dive into a business, I always take a look at the downside. I make sure I can handle the downside before I look at the upside. Very, very important. There's a reason why boats learn from the Titanic and they put lifeboats around a cruise ship, because that is to deal with the downside. If I can deal with the downside, then the upside take care of itself. Very important. Are you prepared to handle if things don't go right? Very important. Next one, let's take a look. How invested am I to be correct in this decision? Now, you need to take a look sometimes, because a lot of folks have a lot of certainty. They want to make this correct. But you need to ask yourself, at the end of the day, am I here making this decision because I want to make money and therefore take care of my family? Or do I want to make this decision because I want to be correct? It's very important. Very, very important. Critical. You need to ask yourself, why are you so invested? Is it coming from an egotistical place? Is it coming from an emotional place? Why exactly do you want this decision to be correct? The moment you identify it, then maybe you can unhook yourself. You see, at the end of the day, one of the mentors I studied from, he said, at the end of the day, you can be right or you can be rich. There's some people who are very committed to being correct. You know, they have a certain viewpoint and they want to preserve that viewpoint from an ego standpoint. However, that used to be me. I used to be foolishly certain. Until I realized, wait a minute, we are right here and we want to be rich, we want to be successful. And sometimes that involves changing my mind from a lower level filter to a higher level filter. And I'm prepared to do that. I don't have to be overly invested from an ego standpoint to be correct. So I think that's really important. Why are you so invested in making sure that this works out? Are you coming from a place of balance view, balance facts, or are you coming from a place of bias and ego? Very important. Now, number 6, what are my assumptions? See, sometimes when we make decisions, we assume a whole bunch of things here, and then we reach an end point. Do I have any assumptions over here that might come back to bite me in the butt? Very important. What are my assumptions? And the final thing we need to understand is very simple. Knowing all that I know. Have a balanced view. Realizing also that not making a decision is also an option. Do I still want to do this? You see, what we do when we have the ideas of wealth that I mentioned just now is we put detachment between ourselves and the decision. What we do in all the elements that I just gave you is we start to have a balanced viewpoint. And you see, when we do all of these things, we are not only not attached, we are detached. And not only are we detached, now we are holistically looking at the situation. When we are holistically looking at the situation, we activate our rational mind, our logical mind, we can make a sensible decision. And when we stretch it out long into the future, we start to realize and ask ourselves, is this a smart decision? Is this a mature decision? And will this get us to where we want to be? I promise you this, guys, that right now there are a lot of people who are very invested to manipulate the way you make decisions. However, if you retain and take back that control by not being attached, because you see, marketers, their goal is to hook your emotions. But the moment you are able to detach, take a few steps back, the moment you look at it not just from the viewpoint you're being sold, but from the entirety of the viewpoint, you start to look at it the holistic fashion, then you start to retain that control. You start to retain your intelligence and your logical, rational ability, and you start to make better decisions, the kind of decisions that you will live and thank yourself for doing, the kind of decisions you won't regret, the kind of decisions that will take you to a place of financial freedom where you can take care of yourself and your family. Wish you the very best. Hope this was useful for you. I wish you a life of making quality decisions, because I know that the decisions we make define the quality of our lives. Love you guys. Thank you very much. Chair. All right, folks, if you have any questions, please list it inside the chat. I'll be happy to answer some of the questions for you guys in the area of decision making. Okay, so it's very important. Life of quality decisions, indeed. Someone asked, would there be slides? Quite sure the team might be able to help with that. Yes, okay. Man Fong mentioned the idea of detachment. You know, just as you guys are typing any questions, if you have any, I just want to elaborate on some of these components. You know, a long time ago, I see in school we never taught exactly how to make decisions. I think that's one of the most critical things we need to understand. And so we are trained from a young age to either do one or two things. We are always looking for people around us who seem to have more confidence, not always more wisdom or more intelligence. They seem to look like they know what they're doing, and we're like, all right, cool. If this person goes, then we shall just follow, right? Have you realized that if you're living in Singapore, you realize that, right? We have no idea what this store sells, but we see a whole bunch of people standing outside. So let's go. Do you understand? So that's what we're trained to do. And you must understand that not only are we trained from a young age to do that, marketers and entrepreneurs and business people, and that's what they do. It's one of the things, right? Herd instinct, someone mentioned, right? Herd instinct, exactly. And that is being manipulated every single day. You think that happens in the in the financial markets? Of course it does. Of course it does. These guys hire psychologists all over the place to make sure there is social proof, make sure there is scarcity, urgency. These are things that, guys, I run a marketing organization. I know every single one of these triggers. But what am I doing here today? I'm revealing the secret so that you can make more balanced, rational decisions. So you need to understand that. How to untrain our minds? Well, I'll do exactly everything that I mentioned just now. The way you untrain your mind is to realize, first of all, a few things. So realize, first of all, that you are right now not a very rational person. I think that's the first thing. You need to understand your rationality is not very high. You are easily attached. Okay, you are very easily attached. You need to understand that. The moment you understand you're easily attached, that's when you can detach yourself. Now, if you think you are right now a very rational, realistic person, then it's not going to go very well. Okay, so the moment you are detached, the next thing you can do is, therefore, you can start to understand, okay, cool, I might not be making the right decision. Can I get a more balanced view? I think that one is very, very important. So someone asked a question here, handed me a card here. If the decision doesn't go well, what is your backup plan? What is your assumption behind the decision making? Well, it's very, very simple. Okay, so that goes back to what I mentioned just now. How do you know you make a good decision? Very simple. It's when you're prepared either way. I think there's one thing that I like to do within the business, right? Because I run my own business. And every single decision I have realized is, if I'm counting on something, you know what gambling is? Gambling is, if I put everything into one thing and I realize I'm unprepared for the repercussions. I need this to work or else I'm screwed. That right there is gambling. However, if I'm prepared for this to work and I'm also not going to die if it doesn't work, then at least that right there ensures that my business, my team, my family, my finances stays afloat. I think it's very important. So you need to ask yourself, are you very invested towards making something happen and you're not prepared at all if it doesn't go well? If that happens, then this is not a very good decision. That is gambling. You understand? That is gambling. I'm praying. See, you ask yourself, what is your strategy for this decision? If your strategy is prayer and you're just like, I really hope this works out, that's not a good decision. Yes, it might work a few times, but that is fundamentally gambling. You need to understand that. That right there is gambling. I am not prepared if it doesn't work. I really, really need this to work. Then you are gambling. And here's the thing about gambling and casinos. I've been to Vegas before. And in Vegas, they don't really care how much money you make. Do you know why? Because they have done the probability and the odds. They know that eventually, the longer you play, sooner or later you lose. You might win once, might win twice, but the house usually always wins. You need to understand that. Okay, so that would be that. What is your assumption behind the decision making? I like to break it down because as people, we always are very certain, or we are invested towards making a decision happen, and we're very certain, and we need to pause for a while, right? Let's say you look at this company, right? A few of these speakers mentioned this particular company. You need to ask yourself, what are you assuming right here? Are there any things that I'm not looking at that makes me so certain in this decision? Very, very, very important. And that would be help you identify some of your assumptions. Next one, where do you get the certainty from? There's a lot of personal view behind the article. Okay, very good. Where do you get certainty from? Very, very simple. You get certainty from, number one, a balanced view. It's when you have seen the holistic, right? You have things that go with and things that go against. Let's say I want to invest in this company. Let's say we lose Zoom, for example, right? We are now on Zoom. Should I invest in Zoom? Very simple. Here are all the reasons to invest in Zoom. Here are all the reasons not to invest in Zoom. You need this because most people, when they do research, all they do is what we call confirmation bias, which means we already believe in something and we only look at all the articles that give us exactly what we already believe. That is most people's way of research. Reading more things to further support what they already believe. But if you go and look at things that counter against that, and then now you have a balanced view. I think that is really, really important. And you need to ask yourself, what if it goes wrong? What if it goes right? Have I done my holistic research? Have I looked long into the future? What is my time perspective? 10, 10, 10, right? 10 minutes, 10 months, 10 years. What's my time perspective with this decision? Am I prepared to deal with the repercussions if this doesn't go well? When you consider all of these things, you're going to make a decision at the end of the day that you will not regret. I think it's very, very, very important. Okay. Is there a lot of personal view behind news articles? You need to do a little bit of research into the news media. Okay. A long time ago, I don't want to go down too much of the rabbit hole of this, but a long time ago, journalists were people that were supposed to report the news. Now, with a lot of big corporations owning the news and really shifting that to fit their agenda, you need to understand you're reading part news and part marketing messages. There's usually an agenda behind that, and the way the news media works these days is with syndication. Syndication means what? Syndication means one person writes a piece of news article, and all the other people right now, they jump on exactly this article and they just copy and paste and put it on their website. You've seen that before. As a marketer, I can tell you that sometimes some of the news articles are created. There have been parodies about this. A guy writes a fake news article, and within just about under a day, this fake news article is reported on every single major news channel. Why? Because they don't verify. They just take it and they spread it, because that's fast food news we have these days. So make sure when you get, I'm so certain I saw it on CNN, it must be correct. Make sure you do a little bit of research. You need to understand, are they just syndicating that? Because this is my trade and my business. And I can tell you that news media is very easily manipulated. Okay. So next one, how long and how far are your perspectives? Well, it goes back to this question. How long do you want to be rich? I think it's very, very important, as an entrepreneur or as an investor also. It is, so someone mentioned, you do your own due diligence. I want to mention a perspective there. Do your own balanced diligence. So due diligence, most of the time, like I mentioned just now, leads people to read more things to confirm what they already know. And they think, I just read 10 articles. They all say I'm correct. That's not always due diligence, and most of the time we need to confront the unpleasantness of listening to countering ideas and viewpoints than the one that we are invested to. Okay, so I want to mention here, how long are my perspectives? My perspectives, the more mature I get, my perspectives get longer and longer and further, because I tend to realize that, let's say we use entrepreneurship, because that's a game I play every single day. There's some decisions that make very much sense if I only want to be in business for the next 1 to 2 years. In some industries, right, folks like to overpromise, underdeliver, and like to do that, but that makes perfect sense to do if you want to be in business 1 or 2 years, because you're not been in business very long. But if you're going to be in business for the next 20, 30, 40, 50 years, then all of a sudden it changes the way you do business. So you must understand at the end of the day, so when it comes to how far are your perspectives, very simple. How long do you want to get rich? If you want to get rich for the long term, you don't just want to make $1 billion next year and then lose a million next year and go in debt. Some people say, I made $5 million in this particular company, or $3 million in this company, and I invested all my life savings inside there, and it 10x. Okay, it's a good idea, but it goes one up one way, can go the other way. So are you prepared for that? So if you're not, then might not be such a good idea. Okay, next one. What is the best decision you have ever made in my life? Best decision I've ever made in my life is finding a mentor. I mentioned this, and it's very important. I want all of you to write it down. We sometimes don't know what we don't know. The whole process of maturity, we don't know what we don't know. Wisdom, we don't know what we don't know. There are times when we are headed down a certain path, because why are we headed down a certain path? Why do we make decisions? Because that's all the knowledge that we have. However, not all of us can consume all the knowledge in the world. So we have this amount of time, right? And we have this amount of knowledge and this amount of time. But the moment we meet someone who's wiser, what is the meaning of wiser? That means they have had a little bit more experience and hence a little bit more knowledge. And when our limited knowledge meets a person with far greater knowledge, all of a sudden it extends and we start to realize our decision might not be very accurate. And so some of the best things I've done, the best decision I've made is to find a mentor whose knowledge and experience far exceeded mine. And all of a sudden, with his perspective and viewpoint, I realized that whatever I was headed was not the correct one, and I readjusted it. Okay, so that was the best decision I had ever made. I'll answer a few more here. Guys, please keep the questions coming. Next one, let's take a look over here. Okay, cool. Even when my loved ones are against my decision, get upset, what do you do? I think it's very important to balance, right? Because when I was much younger and impulsive, I'll just say, well, just do what you want to do. Who cares what they think? But that's not very balanced and mature. The real concept of wisdom, the real concept of maturity usually comes when a decision is balanced. It's kind of interesting, right? You see in the States right now, people are very invested to say, I'm a conservative, I'm a Democrat. Usually the answer is somewhere in the middle. So here's a balanced answer for you. Sometimes when you do all the research, you might have to do what you have to do, but at the same time, you might have to see how you can preserve the relationship with them. You must understand also and accept people, right? I think it's kind of interesting. A long time ago, my mom told me that business was very risky and one should never ever start business. And I believe her, because when I was young, you tend to believe everything a parent say. Now I've made millions of dollars via my business, and I continue to coach some of the greatest people to rise up in their business. But when I go home, I tell you the funniest thing. This is really, really funny. My mom still thinks I'm broke. And my mom still thinks that business is very, very risky. She keeps asking every once in a while, how are your sales doing? Are you okay? Do you have enough food to eat? And I suddenly realized, wait a minute, she might never ever change her mind. So I keep telling her, I'm not the same person you met years ago. But she's like, but no, you're not listening to me. Is business okay? Then I realized this. I realized I cannot change her mind. I realized all I can do is accept her. She probably was born in a time and she had her own filters and stories and thoughts about these kind of things. And well, I can go ahead and make my decisions, but also love and accept her. And I think that's what we can do. Okay. So next one, we have a few more. So we have here the decisions that always are all that make it so easy to get influenced by the environment. Well, it's very, very simple. How do you make better decisions? It's really critical. One of the things that Ken and I do is a mentoring program known as Infinite Wealth. And one of the things why people in our mentoring program get such extreme results, right? We want to sit here and say, because Ken and I are such great mentors. It is true. We are pretty good mentors. But the one reason that people get results is because they start to surround themselves with a different quality of people. You see, right now, you either have around you people that are supportive to your dreams. People that say, hey, man, you can do it. I believe in you. They are investing. They are pursuing greater things in life. Or maybe the answer is no, you're not surrounded by those people. We're not surrounded by those people. You take in their thoughts, their beliefs. That's not very good. So one of the things we create in our mentoring program is to surround our people with amazing, wonderful people with progressive thoughts. And very quickly, like a seed in the right environment, these people start to germinate, they start to grow. So how do you make better decisions? Well, change the people you surround yourself with. It's very simple. What makes you stay focused and not get distracted by greed? Very simple. I love this question. You see, greed implies that at the end of the day, I want a lot of money. But you ask yourself, why do you want all that money? You see, it's really interesting. I want to share this idea with you about having more money. So a long time ago, when I was broke, I always thought to myself, if I had $100,000, if I had $1 million, my life would be so amazing. Then I actually had that amount of money. And then I realized, yes, it's true. I can buy a few things. I can buy a few nice clothes. I can eat nice meals. But I also had a sudden realization about the limitation of consumption. I want to share this perspective with you. The limitation of consumption means what? It means at the end of the day, you can only put one thing in your mouth at one time. You can only sit on one toilet bowl at one time. You can only drive one car at one time. You can only sleep on one bed at one time. You start to realize, cool, you can buy all of these things, but then you can only do one of these at one time. You can have a wardrobe of 1,000 clothing, but you can only wear one shirt at one time. In fact, the 999, you end up wearing about 10, and 990, you never wear. Eventually, you get old, you have to throw them away. You even have to hire people to wash them, and you start to realize, wait a minute, I can buy all of these things, but I can only consume one at one time. My ability to consume is unlimited, but my consumption capacity is very limited. Your stomach can only handle so much food at one time. You start to realize, okay, cool, I make all this money. Then where does it go? Right? Some of you say, oh, I'll invest it to make more money. But why? Why now? You start to realize, wait a minute, this money is just numbers on a screen. It's just pieces of paper. You start to realize, wait, I make all of this money because I want the feeling. I want the feeling of security. I want the feeling of freedom. I want the feeling of taking care of my family and relationships, because money in it on itself is numbers on a screen and pieces of paper, and it's, I don't know, is it, you really just want that? Well, you want what money can bring. What if you already have that right now? Very, very important. If you're happy right now, money makes you happier. But if your belief right now is you're not happy with your life, and you think that making a bit of money will make you happy, it will for a short time. And then you're back to life. And then after a while, you think, oh, more money. No. As a person that has had both, I can tell you that. So therefore, I'm very clear about why I want to make money. And therefore, I'm not really influenced by greed, because, you see, having made a bit of money around, I realize it's going to enhance my life by just a little bit. More money will help. But at the end of the day, do I need to have this pursuit? Okay, it's very important. Let's take a look. Any other questions that folks have? So we have a last batch of questions here. Okay, that's great. Incomplete knowledge about a topic might lead to wrong decision making without. Okay. Someone asked me, is it better to have incomplete knowledge and a correct mindset, or wrong mindset with adequate knowledge? So it's a kind of a weird, strange question. I would say you're never going to find adequate knowledge if you have the wrong mindset. It's very important to have fundamentally the right mindset, and then afterwards to have the right knowledge. So everything we mentioned just now was the right mindset that will set you down a path towards finding balance in information. I think that is very, very important. Okay, a few more questions here. I see. Thank you very much. What is your advice to those people desperately wanting to achieve but didn't materialize and impact the faith? Very simple. Everything takes time. It's very important to learn, and everything takes a period of time. Just because it didn't materialize, I think we have this idea that entrepreneurship or investment success or any kind of success is a straight line. It never is a straight line. If it was a straight line, then I'll be a millionaire in 1 year. Unfortunately, it didn't pan out that way. Every single day we have to deal with things that don't go according to plan. If you look at the stock market, is it just a straight line? No, is it? Someday it goes up, someday it goes down, a bit like your life. So you understand that, if you have the right principles and you stick with it, eventually it's going to pan out for you. I think it's very, very important. How to overcome overthinking and cannot make a decision. Always realize that overthinking comes from a place of fear. If you have all the information ahead of you, you run through all the things I mentioned just now. At the end of the day, the decision becomes pretty clear what you should or should not do. I think that's really important. Okay, so I think we have a few more questions on screen. I want to take a look over there. How do you overcome the fear of risk? That's one question. Number two, what is your best method to overcome FOMO? I mentioned about FOMO. Very important. FOMO is understanding that at the end of the day, right? So FOMO goes back to Dunning-Kruger. Let's say you lose Bitcoin or Tesla, right? You see everybody jumping on it. They say, well, if you never, you are losing out. Okay, very simple. The moment you hear that, you understand that's going to hook your emotions, right? That fear is really just, it's going to hook your emotions. Now, before you jump on it, you need to ask yourself, are you making a balanced decision here? Why do you need to get invested in that? Is that something that aligns with your own goals and your own values, your own reason why, with your own investing philosophy? You see, it is possible for people to make a whole bunch of money and for you to make the smart decision for yourself. It is okay. Why? Because most of these people celebrate the wins. They don't really celebrate the losses. It's very, very important. I think that's really critical. Let's take a look here. So that would be the idea of FOMO. I tend to keep all the noise out. You see, I love that Warren Buffett. I think it was Bill Gates or somebody who went into Warren Buffett's schedule. And he opened the schedule expecting to meet a man who was really busy. He went inside his schedule and found large chunks of free time. Just nothing there. So why? Because it gives him a balanced view. He's there to read. He's there to keep the noise out. He's there to follow his own investment philosophy. And you realize the richest people don't get too attached to all the noise because the noise fluctuates. And if we get too attached to that, then we're never going to get anywhere. Okay, so I think the last question we have here, a couple of last questions. Oh, someone asked a question about mentoring. Well, let's discuss that tomorrow. It is an available option, but I don't want to get too much into that right now. This session is to add value to you guys. If you are interested in some form of mentoring, it is true. Ken and I do that. It is a deeply transformational process. I've worked behind the scenes with some of the greatest speakers around. Behind the scenes with folks like Tony Robbins, Half Ecker, and all these kind of things. They do great programs. But I'm going to tell you this. Okay, if you guys are interested, the mentoring program that I do with Ken, in my opinion, is the most transformational process in the entire world, because we combine all the different elements of transformation in one entire experience. And when people go in and when they leave, they're completely different. It's not just jumping around for a few days. It's not just, just being excited for a while. It's an entire journey, because that's the journey to take a person from ordinary and maybe even mediocre to a place of extraordinary and successful. So that entire process is something that if you are keen, I don't want to get into it right now. I just want to plant that in your mind. I just want you to know, because tomorrow when we talk a little bit more about it, you can come and check it out. Completely no strings attached. You can hear it. If you're keen, then you can find out more. Okay, so just if you are keen and interested in it, just check it out when we talk about it tomorrow. I love you guys, and always remember, when you have a certain element of detachment and when you're balanced, you can always make the right decisions that will positively influence your life forever. Love you guys. Bye-bye.
Thank you, Melvin. Don't you love this segment? It is a little bit different from what we talk about V-Summit. Many of you are thinking, I thought I'm here to learn about investing ideas, about numbers, about valuation, how to find the stock ideas. But you know what? As I mentioned, we can give you a lot of stock ideas, but at the end of the day, how then do you make that decision? Because I've known of many of the people who come for our talks, they talk a lot, and we talk a lot, in fact, in terms of stocks ideas for many years. And sometimes I ask those people, take action already or not, huh? They will tell me, don't know how to take leh, that kind of stuff. So decision making is really important. That's the reason why you can see how it links up together from Joshua's segment of sharing with you how not to sabotage your own portfolio of the 4 different types of thinking. So he gave you some question of, let's say, it's not about timing the markets, it's about the time in the market. He also let you know that when you have certain conviction and the share price goes up, what do you do? And if, let's say, the fundamentals you have actually studied but the share price keep coming down. What should you be doing? But a lot of times what Joshua do is ask you the questions. So your next step would be thinking, yes, these are the questions, I acknowledge them, but how do I then deal with them? This is where Melvin comes in to give you the broad framework, and he's an expert in that, to give you that broad framework of biasness versus your emotions. We need to take care of that, and how to take care of your biasness and your emotions. Sometimes you might have said, I've got certain conviction, but is it too much of a conviction? Is it so much of a conviction that you lost your balance? And how do you make sure that you have that balanced, informed decision? That is where you need data. Data, numbers don't lie. So we take a look at the data, and we have the next part, which is called community. Community allows us to have this thing called the devil's advocate. Sometimes you might be thinking of certain ways, but you need someone to challenge your thinking. How? You can always ask your analysis, your questions in the V app. The V app is one of the most powerful platform where the social bubble allows you to put in your questions, your analysis, and get the views from other people. We have more than 50,000 graduates and our network in that. You might have Ken to answer your questions, sometimes Clive, sometimes our coaches like Alex, Chen Hong, and sometimes me as well. And even our very senior investors who may not be the coaches, but I tell you what, many of our investors, they have earned their right to really answer your questions and give you certain perspectives. That's the reason why it is important. I always say this, investing, we do not do it alone. How to lower down your risks is to make sure that you have someone to challenge your thinking. That is the way that we learn and we continuously improve. So now that we have a framework, knowing that we need to use data and we need to have somebody's support, of course, some of you asked about mentorship. And really, this is one of the key things. Mentorship is really important. I personally have benefited a lot. Many of you would have known just now I introduced myself as the executive director of V College. But you know what? I was also one of the graduates of V College. I was also personally taught by Ken and Clive in March 2010. Yes, and that's how I improved along the way from someone who didn't know about investing, used to be a public servant, and I didn't even come from the financial background. Yet today, I can become financially free and, like just now, Stephen, using my passive income to send my family for holidays. The key thing is this: we know how to do it. We also have the framework. The next part, once we have the mentor, we need the step-by-step strategies, right? Yes. This is the next part. We will give you that step-by-step strategy where we are going to invite the next speaker up on stage. And he is also our associate trainer, Dr. Daniel Kao. He is also someone who didn't come from the financial sector, used to be a medical practitioner, yet as one of the graduates of V College many years ago, he also gets the knowledge of investing. And of course, after many years of researching and doing the analysis himself, he is an expert in finding exponential stocks. Many of the stocks that he have actually invested, like what we call the cheetah stocks, the fast growers, yes, he has made exponential profits. So he's going to share with you 4 key critical flaws to correct for greater profits so that you are ready for them in 2021. Dr. Daniel Kao, please.
Hi everyone, my name is Dr. Daniel Kao, and I'm really glad to be here at the V Summit of 2021. So just want to extend a very warm welcome to all the participants. Now, just a very quick introduction of myself in case we haven't gotten acquainted yet before. My name is Daniel. Just call me Daniel. Don't need to call me Dr. Carl or anything. And I have been an investor with the V community for the longest time, learning investing, growing together with the community over the last good number of years. And I must say that I'm really happy to see the V community grow, as well as see how the company itself has transformed digitally over the last few years as well. Okay, so this is a really exciting V Summit for myself as well. One of the main reasons is because this is the first time that I think we're actually doing it online, okay, and doing streaming. And the other reason that I'm really excited is because actually it's my first time speaking at V Summit. Okay, so I actually started off as a participant quite a number of years ago. And I can still remember back then when I was a beginner investor, my first V Summit, when I actually attended it, honestly, I had no idea what the speakers were speaking about on the stage. Okay, it was just all gabble of stuff that sounded really chim, and but I did extract some learning points from it, and it's really nice to see that over the last few years, I've learned so much from the community, the trainers, and everybody who's in V. Okay, from everybody, each other, and how much personally I think I have progressed as an investor as well. Okay, so today's session is not really about me, so I don't really want to waste time talking about myself anymore, and I just want to spend more time. Sharing with you a bit of experience from myself as an investor who grew together with the V community, some of the things that I have learned over the years. And this topic that I want to touch on today is really about uh, key critical flaws that I think investors like you and like myself, basically retail investors, that we need to constantly watch out for, especially in today's markets, that you really need to correct and make sure that you don't have these flaws. Okay, if you really want to, go for the long haul as an investor. Okay, so all right, so let's go on to today's slides. All right. Okay, so just to help you understand a little bit from where I'm coming from, I just wanted to help you see, because I have been in the markets for the last about maybe 10 years, and I can see from myself, from my own personal journey on how investor behavior has really changed over the last few years. And I think last year was really the year 2020, the year of the COVID, was really the year whereby many things change in the stock markets. Okay, I think that you guys might really agree with me on that aspect. Okay, so I just want to touch on, as somebody in the markets, how overall investing has changed for myself, so you can really understand where we are right now. Because some of you may be new, you see, because you may have just come in the year 2020, or maybe just join us in the year 2021. Okay, so this is my personal understanding of how investing has evolved over the last good number of years, maybe in the last century or so. Okay, so of course, when we talk about value investing, okay, it was revolutionized by this very wonderful and very intelligent professor, right? So it's called Professor Benjamin Graham. Okay, so he's the father of basically value investing. And back then, when he first started off, um, back then was all about focusing on basically his method of evaluating stocks was basically looking at the balance sheet. Okay, so he'll look at things like what's the current net asset value. So he focuses a lot on what the company owns at that point in time. Okay, so with the liquidation value of the company, Benjamin Graham could actually attach a certain valuation to the stock price, where he knew that if you buy below that, there's at least what we call a margin of safety. All right. So that was value investing 1.0. So this was many decades ago. All right. And eventually, Graham had a wonderful student, a very brilliant student. And that student is none other than Warren Buffett. Okay. So now Warren Buffett actually started off as a student of Graham. So his approach in the earlier years was very similar to Graham as well. So he started off by looking at the balance sheets of companies as well to determine what was the net asset value. Okay, what was the book value of these companies to determine an entry price that deemed something good for him to actually enter into these stocks. But later in his years of investing, Buffett actually had a change in methodology. This was heavily influenced by this investor called Philip Fisher, as well as his partner Charlie Munger. So back then, he made a switch into holding good companies for the long term. And to actually value these companies, they started to look at, they started to consider the future cash flows that these companies could actually bring in. Okay, so this with this change in methodology, there came what we call discounted cash flow, right? So that was the era when investors started to look for intrinsic values that were based on the sum of all future as well as present cash flows that a company could actually provide to you. Okay, so let me just repeat that. So some of you might be familiar with this method of valuation called discounted cash flow. So essentially, it states that the intrinsic value of a company is really just determined by all the sum of all present and future cash flows that the company can provide to you. And of course, since future money has to be adjusted for certain things like inflation as well as cost of capital, we need to actually discount it to the present value. Okay, so this is the concept of DCF, or discounted cash flow, right? Okay, so you can tell that how investing has evolved is that from the Graham era, whereby investors looked at what the company actually had at that point in time, it eventually moved to looking at the company's future. Okay, so what kind of cash flows that the company can provide to you in the future. All right, and eventually, probably in the last maybe 5 or 6 years or so, I started to notice that investors, particularly in the year 2020, started to pay way ahead for companies. Okay, so which means that for companies like Tesla, as well as some of the hot stocks of the year 2020, investors were really willing to pay way ahead for the future. Okay, so they're paying for future potential. Now, this is kind of like what we saw in .com during the .com bubble crisis, before the bubble burst. But of course, back then, I feel that if you were to do a comparison, probably the investors then were a little bit less discerning than the investors of today. So here we are again at 2020. So are we in a bubble? I think that probably valuations are slightly on the higher side, but investors are a little bit more discerning. So the weaker companies are probably not valued as highly as the good ones. But of course, the tendency nowadays is that investors tend to pay way ahead, for years ahead of in terms of growth. Okay, so this is what we're seeing. So what we're seeing is that people are paying. Can you notice a trend in this? Okay, so basically investors are paying for something that they have many years ago at that point in time, to eventually to the future cash flows, and now they're paying even more ahead for that. Okay, all right, so this is the general trend of which we are moving towards. Okay, so whether it will last, no one knows, right? Okay, but this is a state that we are in currently. Okay, so the way that I feel that in this current decade of investing, you must acknowledge one thing, okay, is that this decade of investing is definitely different from the last decade of investing. Okay, so why do I think that it's different? Is because firstly, there is free flow of information. Now, if you compare with 10, 20 years ago, the information that you can dig up on companies these days is very vast. Okay, so you can just go to YouTube, Twitter, financial analysis websites. There's just so much information on the stocks. And if you want to look up a company's financial information, there's like a software, very good software like VApp. Okay, that has helped myself a lot as well. Okay, so the idea is that you no longer have to dig really deep to find out the financials of a company. Okay, so which is why I feel that a lot of times these days, when you find a company that's so-called undervalued or extremely cheap for a certain reason, okay, you must be a little bit careful, because the so-called undervalued gems may not be as apparent, may not be as easily unearthed as before. Okay, the main reason is because the information is free flowing. So many people know which are the good companies versus which are the bad companies these days. Okay, and what I'm seeing, particularly over the last 2 years, is that I feel that retail investor behavior, platforms like Robinhood and all that are increasingly being driven by social media influence as well. Okay, so now a very interesting example of how this has evolved is, if you look at the year 2020, the Wall Street analysts are always saying, wow, this company is overvalued, or we need to go short on this company because it's so expensive. There's no reason why it's so expensive. Yet these companies keep going up. Okay, and the retail investors keep making money. So despite what the Wall Street analysts are saying. Okay, so I think in the year 2020 was a lot of it's a year of a lot of frustration, especially for the veteran stock investors, those that are exercising a little bit more caution. Okay, there are people who are looking at valuations. All these things don't seem to make sense in the year 2020 anymore. Okay, so all right. So just let me break it to you. This is how I see investing is moving ahead over the next decade. Okay, generally, I think okay, everyone in this day and age knows what the good companies are. Okay, because it's just literally all over social media, it's all over the news, and I think these companies are good. Okay, the only issue is that sometimes you have to be discerning with respect to the valuations that you get into. Okay, so as a summary for what I've covered so far, the main point what I want to drive home is that in this day and age, it is you no longer have an information age. Okay, so it's no longer like the Grahamian era whereby, you dig deep, you know something about the company that other people may not know, and you use that to your advantage. So it's no longer a day and age of information advantage, but I feel that as an investor, you can still build a certain advantage, a certain wisdom that people moving in and out of the markets quickly then may not have. Okay, with respect to you. Okay, so let me share with you what advantage this is. Okay, I feel that since most people no longer have what we call information age, because it's so free flowing, you can build what we call a behavioral age, and I think that this behavioral age will be your trump card. Okay, over the next decade of investing also. Okay, because information comes cheap these days. Okay, but wisdom as well as the way you approach the stock markets, now that is something that is not so common. Okay, all right, in all the insanity that's happening. Okay, stocks are going up like what 300-400% in like a month or so. Okay, all right, so today I'm just really going to share with you from my own personal experience, uh, because personally as an investor, I've been through many different phases myself. So I've been through things like, the feelings of FOMO. You watch a stock that you decided to stay out of, keep running, then you say, oh, I better buy before it goes up, right? And then things like fear as well. You really want to cash in on your profits because you ran up a certain amount. So all these are what we call behavioral biases. And I just want to share from my personal experience how I think that as an investor you can inculcate the right values as well as the right approach to holding stocks for the long term in the stock market. Okay, so how you can understand your own mind. Okay, so that's what today's topic is all about. Okay, so the first very common behavioral bias that I myself have encountered, or maybe you would have definitely encountered in your journey as a stock investor, is you are telling yourself that after you bought the stock, the stock price drops, right? And you tell yourself, okay, I will sell once it goes back to my original buy price because I don't want to incur some kind of loss, okay, to my position. So at least I want to break even. Okay, so that's what essentially you're telling yourself, right? When you actually buy a stock that drops, okay, and you no longer have the conviction to hold on to it because maybe something about the stock has changed. Okay, but you keep telling yourself, look, Daniel, I paid X dollar for it. Don't worry, lah. You'll go back to X dollar, and that's when I'll actually sell it off to prevent myself from making any losses on this particular position. Okay, so common story: Mr. Tan bought stock ABC at $100 because his friend recommended him too. Okay, so unfortunately, there came some bad news. Okay, so the stock price actually dropped to $70. Okay, so what was the bad news? Basically, the business was getting challenged. Okay, the earnings call was bad. Okay, and sales, the revenue of the company had dropped considerably due to intense competition that was rising. Okay, in the market. Okay, so the market, the consumer market, not the stock market, okay, simply was not interested in ABC's products anymore. Okay, so as you can see, Mr. Tan is currently sitting on a 30% loss, right? Okay, so probably you would have encountered this situation before. Okay, so if you have encountered this before, just give a nod to yourself. Okay, so this is something that sounds familiar, right? Okay, and if it's not familiar, then you probably just invested in year 2020 only, because year 2020 is the year where you just everything you whack, everything goes up, right? Okay, but actually in normal stock investing, this is actually a very common scenario. So there are possibilities for wrong picks. Okay, so you have to be aware of that. Okay, so now you're currently sitting on a 30% loss, right? So what should Mr. Tan do next? Okay, should he sell off his positions to cut the loss? That's option A. Or should he B, buy more to average down? Because this is what we call dollar cost averaging, right? Or C, just continue to hold the position just because we just have to think long term. Okay. So what should the answer be? So, just let the scenario run in your head. Now, this is a really common scenario that us as investors, we have encountered quite a good number of times as well. Okay. Okay, so what happened is that Mr. Tan decided to hold on to the stocks because you guys have been trained in long-term investing, right? So short-term investing, short-term price fluctuations are all so-called market noise, correct? That's what everyone says. So we just hold on to stocks, okay? And plus, he says, since he bought at $100, he must at least exit at $100 in order not to incur any losses, right? Okay, so go long term, guys, and ignore the noise. Okay, that's what everyone says. So because he had read about this on the internet as well. Okay, so over the next 1 to 2 years, the market share of ABC as a company continued to slip. Okay, and the price actually dropped all the way to $10. Okay, so he's sitting now on a 90% loss. So yeah, all right. So this is what we call the I have to break even bias. Okay, so this is a very typical mistake. The first thing is that you have to recognize that not all price drops are due to market noise. Okay, sometimes a company may get disrupted. Okay, so in terms of sales, in terms of how they're holding on to their market share, in terms of the growth as well. Okay, sometimes companies do start to fail, and if you feel that as an investor, the thesis of this company has actually changed as before. Okay, personally, I will hold on to a stock. Okay, it's a case whereby you're just kind of bluffing yourself. Okay. So probably for Mr. Tan, he also had a failure to understand the mechanics of the stock price disruption. He probably just assumed that it's some short-term price movements. Okay, and I think his mistake was that he actually followed a popular stocks as well, whereby he just bought into the stock because his friend recommended him to. So when he did that, he didn't have the conviction to actually hold on to the stock the right way as well. Okay, so he was just holding on because he felt that the stock was going to go up. He didn't understand why the stock price actually dropped. And of course, the biggest mistake is that he had a certain attachment to the entry price of $100. Okay, so the truth is, if you look at my slide, something I want to tell you is that the company itself has absolutely no memory of your entry price. Okay, so just because you bought it at $100, it doesn't mean that the price is going to go back to $100. Okay, that price of $100, that price tag only applies to you alone as an investor because that is your entry price. It has no significance to the market. Okay, it has no significance to ABC as a company as well. All right, do remember that. Okay, so all right, so do correct the bias. So I've actually included a little bit of a flow chart to help you understand decision making so you can make clearer decisions. Okay, so when the stock price drops, okay, the first thing that you need to do as investors is you tell yourself, don't take it at face value. Okay, so don't take it at face value means that you have to do some fact finding to find out the reason for the drop. Do not assume that the drop in stock price is because of just market noise, and do not assume that the drop in the stock price on the other hand is just purely because the company is dying as well. Okay, so we don't want to go to two extremes. We don't want to assume it's either without doing our fact finding. Okay, so you need to go to do your fact finding because that is your basic diligence as an investor. Okay, so after you have found the facts, okay, you have to decide for yourself that is this stock price drop, is it due to a fundamental business disruption that is going to be permanent, okay, something that's going to be long lasting, okay, or even worse, it worsens over the years, like in the case of stock ABC, or is this going to be just a pure temporary issue, whereby you can treat this as a opportunity to actually do dollar cost averaging and add more positions. In fact, okay, so this fact finding and this decision making process to find out what is the reason for the drop, okay, is in fact one of the most important things to prevent yourself from adding positions to a company that is actually so-called dying, okay, or holding on to a company that has no hopes of actually recovering from that point onwards. Okay, so you have to correct this bias onwards. Okay, so do not use your entry point, the stock price, as a benchmark for when you should actually exit a certain company. Okay, so one thing that I realized that actually helped me deal with so-called losses on a certain position is that you probably have to tell yourself, do not attach too much significance or importance to the performance of one particular stock itself. Okay, so sometimes, okay, the key is this. Okay, you own a portfolio. That portfolio maybe has maybe 9, 10, 15, 20 stocks depending on your preference as an investor. Okay, and your overall portfolio performance is your gains. Okay, and out of your overall portfolio, there will definitely be some winners and there will definitely be some losers as well. Okay, so do not attach too much importance to maybe one position actually going down. Okay, it's always focus on your overall portfolio. Okay, so only your overall portfolio gains matter because that is the one that's going to be driving your overall net worth as well as your wealth accumulation. Okay, all right. So personally, this has helped me a lot as well. This kind of thinking. So this will help you make decisions to cut loss with respect to specific counters, without having too much attachment to that so-called realizing that paper loss itself. Okay, so it's always better to cut your losers, especially if they're going to be influenced by some long-lasting negative fundamental changes. Okay, but of course, like what I said, if it's just a temporary thing, it's just a temporary news, you think it's completely no point, then you should exercise your discretion as a long-term investor and continue to hold the position. All right, so this is the first bias that I wanted to touch on. And hopefully this thinking can help you understand the process by which you decide whether you want to sell stocks, hold on to stocks, add positions, blah, 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 blah. Okay, in the end, it's really about understanding and doing your fact finding rather than being attached to stock prices that you actually bought the stock at. Okay, so if it's bad, just cut it, man. Okay, don't hold on to it and pray to the heavens that you somehow go up. Okay, all right, so now this is the number 2 bias. Okay, the first bias that I told you was when the stock price drops, right? Okay, so now I want to flip the coin a little bit. So sometimes you may be looking at a certain stock or counter, you really like it, and you think that fundamentally it's solid, the thesis is solid, everything checks out about this company. Okay, but by the time you're finished looking at the company, it's really up 100%. Okay, and you tell yourself, oh man, done, what a waste, I should have bought it when it was 50% cheaper from today's price. It's just sad, too late, I missed the boat. Okay, so I get this really often as well. People always message me telling me, hey Daniel, is it too late to buy a stock now? It already ran up like 50, 70, 100%. So it feels like, I already missed the boat. Okay. So over here, I have a picture of a scene from Harry Potter. Okay. So for you guys who follow the series, I like the series a lot. I love Harry Potter. Okay. You know that in the series there's actually a very pretty girl played by Emma Watson, the actress, right? So the very pretty girl is none other than Hermione, and of course, the person who likes her is Ron. Okay, but Ron, he's a very he can't really make up his mind because basically what happened in the early days is that Ron really liked Hermione, but he never dared to step up and go and tell her that that he really liked her a lot. Okay, so he never really got the girl of his dreams, and this was so for a good number of years. Okay, until I think at some point Hermione was almost gonna uh, uh, she almost went with relationship with other guys as well okay, so you can see in this scene that Ron is like, done, I'm so jealous. Okay, so I love Hermione, but I never pulled the trigger, so I never took action on it. Okay, so this is the case in life. Sometimes a lot of times we want something, we know that this job, okay, or this particular investment, we know that's good, but we are always waiting because of some element of fear. Okay, so we always feel that, what if things go wrong? What if after I buy the stock ABC, it drops because it's really run up so much, right? Okay, so let me show you a case of a stock that ran up 100% in 1 year. Okay, so just bear in mind, this is not the year 2020. This was in the year, I think, 2010 to 2011. This stock actually rallied about 100%, which is a very fast growth. Okay, by at least by those time standards. Okay, so 100% up. And I just want to ask you guys, So let's say you were looking at the stock at the price $110, which was at the start of the chart, this period in as reflected in the chart. And now we kind of two means procrastinate, okay, and we didn't really pull the trigger, and now the price is at $220, okay, and you ask yourself, done. I really want to own this stock. I know it's good. I've done all my homework. I think it's awesome, but it seems to be too late. I missed the boat, so cannot buy this stock already. Okay. So why is because if you buy the stock, what if it drops like 40-50% after that? You'll be sitting on huge losses, right? Okay. So this is a very common thinking, and I must assure you that even for myself, this is very common thinking as well. There's always this element of fear, especially for stocks that went up quickly in a short period of time, that you may be in for a short-term volatility, which means correction. Okay. Now I want to tell you that this is actually not untrue, which means that it's real. Sometimes when you buy a stock that has ran up a lot, you can run into a scenario whereby short-term traders take profit. Okay, so there can be periods in time whereby you experience some kind of correction. Okay, however, if you keep anticipating this particular correction, there's a chance where the stock can continue to run. Okay, and you completely miss out on the stock, even more than that. Okay, so I just want to show you what happened to this stock after that. Okay, so are you guys curious? Okay, so if you're curious, just just nod your head. Okay, so let's see what happened to this particular stock after it ran up 100% from the year 2009 to the year from the year 2010 to the year 2011. So what happened after this? Okay. So this stock actually, if you look at the graph on the right, 2010 to 2011 is just a tiny blip in the movement, okay, of the stock. So what happened is that today, okay, this stock stands at each stock stands at a market price about $3,000 over dollars, which is more than a 10 bagger from the time it actually went up 100% in the year 2011. All right, okay, so don't you find this amazing? Okay, even those stocks go up 100%, still can go up another 1,000% one. Okay, all right. So I just want to correct this thinking today. Now, whatever I shared today on the charts, it doesn't mean that you can just go and find any stock that has gone up like maybe 200%, 300% and say that, oh, Daniel says that stocks that went up a lot can continue to go up. Then you go and whack these stocks. Okay. Now that is a sure recipe for bankrupting yourself as well. Okay. Okay, so let me clarify this. Not all stocks behave this way, but there is one way of thinking that can help you understand better whether you can actually enter into stocks that have actually gone up already. Okay, meaning that these stocks can continue to run. Okay. Okay, so this is a very typical mistake. Okay, stock has run up so much, fear of short-term losses, as I mentioned. Okay, means that you never take a stake. Okay, but the good businesses actually continue to run as well. Okay, so there's actually only one truth, okay, that I want to help you guys with to correct your bias. Okay, use these two. Okay, this one truth has not changed over the last maybe 50 years of investing. Okay, it's simply just buying a good business and making sure you grab it at a fair valuation. Okay, so this is a simple flow chart. If you think that a stock has run up, but you still really like it, okay, meaning that it is a good business, you just have to ask yourself one more question. Is the stock still trading at an acceptable valuation? That is it still trading at a multiple that can continue to expand itself? If it is, then you just buy it lah. Don't be too worried because it's still it's still at a multiple that can move. Okay, but however, if it's no longer at a acceptable valuation, you think that it is in bubble territory now, that is different. Then that is a case whereby probably you should just hang on, watch and wait first, and wait for a better entry point. But if you think that it's still undervalued or trading at a fair value, even though it has run up, it's okay. Personally, I'll just continue to buy into the position itself. Okay, so think in terms of valuations, think in terms of multiples, but do not think in terms of stock price alone. Okay, so I think this is a problem that I see, especially on a lot of investing forums these days. A lot of people are thinking, oh, this stock is going to go to is now at $10. They're just saying that okay, it's going to go to $100 for some weird reason, but they're not looking at valuations. Okay, sometimes we have to understand how much further valuation multiples can actually expand themselves. Okay. Now, the third bias that I want to talk to you about is that people tend to buy cheap stocks as well because they think that it's so cheap, it can't go any lower, right? Okay, so example over here, at the start of the COVID crisis, of course, our pride and joy, Singapore Airlines, which happens to be a really good company. I love them. Okay, but in terms of stock price, of course, they got hammered, right? So this was in the COVID period, simply because things are not moving in the travel sector. All right. So you can see that it moved from actually $9 all the way to probably like $6, okay, in March. So this was the first part of the crash. And I think at that point in time, I had a lot of friends as well as aunties and uncles. They were saying that, hey, Daniel, SIA, they really corrected like 30% down, right? So $9 to $6, it seems like a good entry point because it can't go lower, right? But guess what? Okay, so if you look further in the pandemic, the price actually continued to go downwards all the way to like $3 something, which is another 50% drop. Okay, so everyone knows how to buy low and sell high, but I think many people misunderstand the concept of low because they think that they have caught the bottom, but may not be so. Okay, so let me touch on this stock called GoPro. In 2015, if you look at GoPro, it was trading about $36, where I've actually put my cursor. This was actually probably more than about 60%, okay, 50-60% off the highs of GoPro, because at its peak, GoPro was trading around $80 to $90, okay, as you can see from the chart. Okay, so more than 50% off its all-time high. So after all, cheap is good, right? Cheap gives you a margin of safety. So that was what Mr. Tan thought as well. Okay, so he thought to himself, how much lower can GoPro go? Okay, it's a very, very, very recognized brand, right? Okay, but guess what? Okay, so if you look at that, GoPro continued to slip as it did with its business fundamentals. And I believe today it's probably trading at a fraction of Mr. Tan's entry price. Okay, so as you can see from the chart itself, so the problem is that when you buy with a cheap valuation based on multiples like price to earnings, based on price to sales, many a times people are not really taking into account certain factors such as the market itself, okay, basically the sector, okay, how the market values such companies versus as well as the quality of the business as well. Okay, so a lot of times in this day and age, when you see a good company trading at a very cheap multiple for some reason, okay, it's best for you to go and do some digging. Okay, so there are some reasons why companies are trading at cheap multiple. So for example, number one is that they could be trading in less recognized markets with less media coverage. Okay, number two, okay, such stocks could be companies which are fundamentally disrupted, okay, which means that something is wrong with the business itself, and this something is wrong has already been factored in by investors. And you could be missing out on what I love to term as fourth dimensional factors. Means that you could be missing out on whether the company is actually slowing down its growth, whether acceleration itself is dropping, okay, as well as maybe the revenue quality. So example, maybe for mobile game developers, consistently they are assigned lower multiples because of the nature of the market itself, as well as their products, okay, as well as the nature of the revenue being may not be recurring. Okay, so value investing in this day and age, right? Okay, I feel that it's a little bit different compared with the old days because you need a great deal of foresight as compared to the old days. Okay, so value investing meaning that if you are looking to buying companies which are cheap and undervalued nowadays, okay, you really, really need to understand that sometimes you may be buying into temporary weaknesses of the business itself. It may not be a case whereby there's nothing wrong with the business and it's just cheap and under-recognized. Okay, a lot of times when you buy into cheap businesses these days, you're actually buying into weaknesses of the current business model, and you have to be aware of that. So in that sense, to me, I feel that value investing itself has gotten a little bit more challenging because nowadays you really need to have the foresight and the faith that this aspect of the business this aspect will actually turn around or get better in time, and therefore driving your share price up after that to realize a certain gain. Okay, so this is the way I see it. Buying the business itself for me is actually tougher than buying into a company where everything's going well and you know that there's very predictable business momentum. Okay, so this is the issue with value investing now, and I find that it's very challenging. So if you are able to carry this out very successfully, then I think that is hats off to you, because this is something that personally I'm not good at as well. Okay, because I'm just not good at it. Okay, so if you look at GameStop, I actually put this company in is because it actually rebounded very strongly recently due to a change in management as well as a change in business model. Okay, so you may tell yourself that, okay, GameStop looks very cheap now, you can buy, right? And you can get a rebound of it. But do you realize that probably you have told yourself that it's cheap maybe from 2018 onwards, okay, since it keeps going down. Okay, but the idea is, when do you know that it is cheap enough to start to rebound? That is the problem. Okay, and when do you know that it's going to turn around? And when do you know that the measures that the management have put in place are going to start to bear fruits? Okay, when is the point in time? So if you do not know that point in time, it's very challenging on your psyche as an investor, because you keep seeing the price keep slipping over time, and that is the real challenge to me as an investor. Okay, to practice value investing. All right, so to make money from stocks, okay, there's actually two ways to go about it in a nutshell. The first way is, of course, value investing, whereby there's a rebound in perceived valuation, okay, and you actually net a gain of that rebound, versus you buy a strong company that continues to grow and fundamentally improve itself. Now, that is growth investing. Okay, now I've actually put the picture of this Dragon Ball, these two very cute characters from this anime that I used to watch last time as a kid. Basically, these two kids, right, they actually combine and they form a whole new character after that. So if you combine these two methodologies of growth investing, looking for solid companies that keep improving, okay, versus as well as buying companies which are fairly or undervalued, that's when you actually get what we call GARP investing, which is growth at a reasonable price. Okay, so GARP, and this is actually practiced by well-known investor Peter Lynch. Okay, so he buys good growing companies below the PEG, right? Less than PEG of 1. Okay, that was his method many years ago. And in some sense, I think that Buffett is a GARP investor as well, because he buys great companies and he buys them at fair valuations. Okay. So do keep it a secret. Personally, I think that I really suck at identifying companies with value play. I tend to be wrong, and the problems of the business tend to deepen as well. So personally, I still stick to companies with they are absolutely great to begin with, and I just pick them up. Okay, at when the broad market gives me a chance to buy them at a fair valuation. So do correct the bias. I think the high quality companies, they can come across as have a certain premium attached to them, but you are paying for the certainty, and you know that these companies at times they can continue to run as well. Okay, so if you look at the tech forerunners of the last decade, right, your FANG stock and all that, they have been valued at a certain high, so-called high valuation. They are definitely not undervalued. Okay, yet they have continued to grow and exhibit very stellar performance over the last decade or so. Okay, so personally, I think the ability to pay an acceptable premium for a certain company, meaning that you're not overpaying, but you are still comfortable with paying a certain premium for a very high quality asset. I think that is a superpower, okay, because it demands a certain level of optimism from you as an investor. Okay, now the last bias that I want to correct is that this is a true story, by the way. I had someone who actually bought a certain stock together with me at the same price at about $20, and it went to $40 within 2 weeks. So it's a 100% gain. And this person actually got jittery and decided to sell it off, because $20 to $40 is essentially you already doubled you already doubled your capital, right? Okay, so it's 100% return. Okay, but by the end of year, sorry, not FY 2020, I just mean the calendar year 2020, the same stock was trading between $90 to $100. Okay, so he could have, instead of netting himself 100% return, it could in fact have been maybe a 400 to 500% gain instead. All right, so this is a very common fallacy as well. The stock has gone up a certain amount, I better cash out the profits before it drops. Now, I just want to share a bit of this revelation from a friend of mine that I felt really blow my mind, that could help you tackle the roots of this bias. The root of this behavioral bias is that people tend to see cash as the only outcome for their wealth. This is why every time you see a certain gain in terms of your equity, okay, you feel like you want to cash out so that you can convert it to cash, because the only way that you make money, so-called make money, is when you cash out, right? Okay, so we have to correct this behavioral bias. Okay, if you don't realize it by now, right? If you look at the ultra wealthy people like Jeff Bezos, people like Warren Buffett, their net worth, their 100 billion, 100 over billion net worth, right? It's not cash sitting in multiple bank accounts, all right? Okay, you have to realize that. So the best thing that someone told me this year is that he said that cash is really just a tool used by the rich to grow their wealth. Okay, cash is not the end point for your wealth. You have to do a bit of switch of mindset from today onwards. Okay, the way I see is that you have to understand that cash is used as a conduit. Okay, why is it a conduit? Is because it is used for its wide acceptance and liquidity. Meaning that if you are going to go down to 7-Eleven today to buy your breakfast or buy curry puff, okay, you cannot say, okay, I'm going to pay you using my Bitcoin. Okay, not yet. Okay, you can't say I'm going to pay you using my stocks in my brokerage today. Okay, can I give you 0 point something shares? No, I can't do that, right? Okay, so cash is actually used for daily expense for your daily expenses such as basic goods and necessities, and it's also used for hiring people, okay, and setting up businesses. And people use cash to exchange for other assets that actually grow. So one thing for yourself today, right, that I hope to give you a bit of realization is that stop pegging your net worth, right? Stop pegging your worth as well as your success to the cash in the bank. Okay, because your overall wealth should be spread across many different asset classes. And if you stop pegging the most important thing to cash in the bank, then that's the point where you realize that actually you don't need to cash out on the good and growing assets so quickly on. You can continue to hold them. Okay, so this attachment to cash, I feel that is really the root cause for basically intolerance to volatility. Okay, and overemphasis. And I think that this is a childhood conditioning flaw that unfortunately our previous generation have brought us up to be like that. People feel that always cash is the way to go. Okay, it's just like whenever there's during the pandemic, the first thing that people did was people start to run to the supermarkets and buy toilet paper, right? Which is very strange because you can't eat toilet paper, right? And you can only use it to wipe your backside. And I don't think in the pandemic you need to specifically buy so much toilet paper to you're not going to increase the frequency of wiping your backside. Okay, all right. But anyway, the idea is this: understand what assets they're actually placing your money in, and understand that cash is not the endpoint of what you want to achieve. Okay, so this is a behavioral bias. So if you understand this, even though your stocks drop 50%, you understand that hey, this is just your net worth, and you still are holding good assets. Okay. All right, so do correct this bias. Cash in time, definitely you end up in losses because of the effects of inflation. Whereas a good growing business, okay, you are going to end up with growth. Okay, but the problem is that cash is less volatile. So the good thing is cash is less volatile, but the problem is that stocks, you tend to see it have very wild swings. Okay, and people see it, the immediate benefit is that cash, you can use it to support your daily expenses. But a good growing business, you cannot use it to exchange for goods and services. So this is the problem, all right. But once you have enough cash in the bank to support maybe 6 months of your expenses, then hey, the rest, if I put into the market, you can actually stomach the volatility. Okay, so this is how you should actually counteract this effect of you selling out of your positions very quickly. So get in your head today. So are you investing for wealth or are you investing for cash flow? Because those are entirely different things. All right. So cash flow is made by trading, okay, which I think is fine. Okay, you can use it for salary, you can use it for your daily living expenses. But if you really want to grow your wealth is made by compounding, okay, and growth. Okay, so let's talk about this company that I promised I would talk about. Is this company called Unity? It's a very interesting company because it reflects the kind of businesses that I feel that people should be looking towards over the next decade. We are in the age of disruption, okay, and I believe that this disruption already started maybe 5 to 6 years ago, but it's accelerating, and it has accelerated because of COVID as well. And COVID itself has made people hyper aware of the changes that are taking place, okay, in multiple industries as well as our life. Okay, so this is one of the companies that are riding what we call secular tailwinds. Okay, so long-term trends that do not change. Now, for you guys who are in tune with pop culture and gaming, right? I believe that these two names on the screen, you could have seen it before, especially if you're into mobile gaming. So on the left, I have Genshin Impact, which is a huge mobile game these days, and I have Fall Guys, which is a PC game. Okay, so if you have seen these games before, just give a nod. Okay, over where you guys are behind the computer. You may have seen this screen as well during the loading of certain content online or certain mobile games. Okay, made with Unity. Okay, so Unity itself is actually, is not the game itself, but it's the development engine that provides tools to create 2D and 3-dimensional content, primarily. But you must understand that its applications, why I'm so excited is because its applications are not limited to video gaming, okay, itself. So what Unity does is it helps game publishers help to efficiently deploy their products across many platforms, ranging from Xbox to PC to PlayStation 5 as well as mobile. Okay, and currently Unity is actually expanding into augmented reality and virtual reality applications. Okay, so do bear in mind that this is not a buy or sell recommendation. I think that Unity currently is probably at a very premium valuation, so you just need to be aware of that as well. Okay. So what else does Unity do? Okay, Unity has applications across many industries like gaming, automobile, healthcare, architecture, film and animation. So basically anything, right, in your entertainment that requires 3D content creation, okay, is a potential revenue stream for Unity itself. So you can see that in the pictures below, on the leftmost, I have architectural renders. Okay, so this picture that you see is really done in Unity. Okay, I went to search for it. Then there's this new animation called Baymax Dreams, okay, from Big Hero 6. Okay, I love that show. Now this new TV series is actually done by Unity as well. Not done by Unity, done using Unity. Okay, created by Disney using Unity, and a lot of times Unity is used for like a rendering of cars and all that as well. Okay, so essentially, it has three main operating segments. Create solutions, whereby it makes up about 31% of the revenue. And essentially, this is the part where you use the software Unity, and they actually upsell you from the free software. And of course, there's a whole community whereby community-driven plugins, add-ons, and model packs. So this is subscription revenue. And they also have, for currently, the main chunk of the revenue at 60% is driven by what we call operate solutions. Essentially, they actually offer solutions for hosting, redeployment, monetization of solutions for content publishers as well. Okay, and they do a bit of revenue sharing with these content publishers, and of course, the rest of their revenue is actually accounted by strategic partnerships. Okay, and what I really like is that Unity has a dollar-based net expansion rate of about more than 140%, and you can see very clearly operating leverage in their current model with very clearly expanding operating margins. All right, so I don't want to go too much into financials because today's session, for myself, I'm not a very quantitative person, although financials are important to me. But I always feel that the value in my whatever sharing I do is that I can share with you a little bit on understanding the qualitative aspects of the company. After all, a lot of the quantitative aspects, the numbers and all that, you can find them on your V app as well. Okay, so in terms of CAGR wise, the gaming in the industry is set to grow about 8% year on year. Mobile gaming is going to outperform the rest of the platforms as well. And of course, there are other creator industries. And I feel that in general, as we move more and more towards the digital world, digital human interface interactions, we're going to see new things come out of it over the next few years. All right. Okay, so that's it for Unity. Just a little bit of sharing on the thought processes behind how you can look for companies with tailwinds as well as potentially disruptive technologies. Okay, so I hope you guys benefited a little bit from my sharing today. And stay safe in the year, even though we are heading towards what I believe should be hopefully, the tail end of the pandemic. I wish that all you guys stay in good health, stay safe, continue investing the right way, and do manage your emotions, and more importantly, do correct the 4 biases that I have laid out if you really want to continue investing for a long period of time and get excellent results. All right, so thank you for the chance to speak, and I wish you guys the best. All right.
Thank you, Dr. Daniel. Isn't it great to get to know so much about investing? Each and every speaker give you the nuggets. And we don't give a lot, probably, because, in this summit, you can't really maybe remember quite a lot, but they have put them in such good pointers, like 3 or 4 pointers for you to get as nuggets. And these are very important principles for you to remember. Like, for example, Joshua also have given you the 4 nuggets. Then Dr. Daniel also the 4 nuggets. This is what we intend to do for this whole summit, where you bring back all these nuggets. And if you can see what we are focusing this year is a lot, not just about buying, which we have been emphasizing a lot in the past few summits about, case studies on what to buy. But on top of that, we also need to know that many of you have got experience in investing. At this juncture, these are the things probably you would be facing, right? And we are telling you the things, the real stuff that real investors are facing. You are not the only one. When it goes up, can still buy or not? When I bought into Tencent, I remember I actually got it at about 200-300 Hong Kong dollars at that juncture because it was actually dropping. And I know the fundamentals are great. That was a few years ago. Of course, at that point of time, we have to talk about this thing called conviction. We also need to do our studies. And many of you would know like Tencent is one of the biggest company. If you look into China, not only we talk about WeChat, but just now, Dr. Daniel actually spoke about this thing about gaming industry. In fact, Tencent, one of the biggest gaming, that makes them the one of the highest revenue. Yeah. And if you see the rest of the gaming companies, actually, Tencent has been one of the biggest shareholders in many of this gaming industry, right? So this is where you can see when share prices has gone up. So you ask yourself this question. I didn't catch it like, let's say at $20 or even $30. Now it has gone up to $100, $200. Can I still buy it? But right now you see 700. That was the last, the last closing price of Tencent, near to about 700 Hong Kong dollars. So take a look at the fundamentals. When we focus on the fundamental, which just now I think Dr. Daniel has given a really good framework. I hope everybody have taken that down. If not, go over to the V Summit 2021 bubble. You should be seeing the slides, okay? Or if not, just now you should have taken the picture of that framework. So it's a step-by-step method. Is the fundamentals still good? Yes. So let's say if the price drop, then what do you need to do? So it's a very rational, logical, systematic way of investing so as to ensure the biasness, the confirmation bias is not in place. Sometimes emotions, really plays a part. And the other thing that will affect our emotions, especially during the period of the COVID situation, where we really know many of the prices have dropped because of the COVID, but it doesn't mean the fundamentals have dropped. But yet, why is it that we can't control it? It's because of this thing called holding power. This is something that I got a lot also from the participants or maybe people who didn't know about investing. Pauline, how come you all have the holding power? Remember what Dr. Daniel said about holding cash? Yes, cash is a tool. We need to make sure that we have at least 6 months of our expenses set aside. Then when we actually see the share price going down, we are not affected by just the share prices, just because we are actually tied down in terms of cash. However, we also cannot be looking at just cash alone, because if you take a look, if we are holding too much cash, it is actually going to be a drag because of the opportunity cost that we are losing if we don't invest in the stock market. Because you can see over this past year of 2020, it's really a good chance. If you just put and hold cash and put the money in the bank and said, you know what, I'm going to time the market. I tell you, now many of you are regretting. Right? Yeah. So we can't really time the market. When we know it's a good fundamental, we have the system in place. So those of you who are in our VIB, our full edition graduates or international or special edition graduates, you always know one thing. The first day that we always teach is always this part about financial management, having the amount of money set aside, making sure that we have the holding power for at least 6 months, and then every month systematically putting aside that money and then doing our homework. Okay. And when we have doubts, like one of the questions just now I've seen in the chat that's really good. The share price have dropped, but how do we sure that the fundamentals are still sound? Where? How? If you want to do a double check, the V app, the community, ask the questions in there. We have so many people to give you that wisdom. Okay, so this is one of the best avenue to do that. So this is what you should be getting in the V Summit, where you get the concepts and after that apply it in our daily investment journey. Okay, so ladies and gentlemen, now it's 3:30. Yes, we are going to go for a break. 15 minutes break. Let's be back at 3:45. We have heard a few case studies that are high growth. The next part of the V Summit is going to talk about cash flow. Although cash, it is going to be a tool, but how are we going to get more cash coming in? Come back at 3:45. We are going to share with you options, strategies, how you can get consistent cash flow. See you back at 3:45. So next part, just now I mentioned, we are going to talk about cash flow. Having just good stocks is not good enough. We also are looking for certain cash flow, especially sometimes, with limited capital. How can we do that to expedite in terms of our cash flow generation? You know who the person I'm going to invite. He's from Malaysia. He can't be with us live over here because he's in Malaysia right now. He has to do it from his home, okay? So yes, certain parts of it actually in our talks are recorded, and it has to be recorded because just to ensure that everything goes smoothly, okay? So Mr. Derek Lau is going to be the next speaker. He is our investment coach and trainer, particularly in this area called options. And I believe many of you have gotten the 1,000%. Edwin, Edwin is here, right? The 1,000%, the hundreds of percent because of his strategies. Really, he's going to share with you how to exponentially grow any stock opportunity. Listen to Mr. Derek Lau.
Okay, hello everyone. Testing 1 million, 2 million. Hopefully all of you can hear me loud and clear, yeah? So before I start, I just want to thank Pauline for the really, really warm, introduction. But if you guys don't mind, I would like to reintroduce myself so that you can understand me better as a person, okay? So some of you have never seen me before, I understand, all right? My name is Derek, D-E-R-R-I-C-K, and I'm one of the many coaches and trainers here in the V community, right? And my specialty is actually in options. So therefore, if you join the monthly VIOS workshop, you probably would know me. Or if you're in a VIOS Plus community, then you know me very well because I'm very, very active there, okay? And basically, my topic today is very simple. How do we exponentially grow any investment opportunity? How do we turn a fast grower into an exponential grower, all right? And if they are already an exponential grower, right, if you add this strategy, it's going to hyper boost your portfolio, okay? So first and foremost, I just want to ask, how many of you had a wonderful 2020? You had a wonderful 2020. Why? Because probably your portfolio, very easily increased by 20%, 30%, 40%, 50%, 60%, 80%, or even as high as 100% and more. Personally, my portfolio doubled in 2020. That's like my entire life saving just doubled in 2020 alone. And I'm very thrilled. I'm very excited. Okay. And, just to do a quick sharing, right? I'm going to share with you guys. If you check my portfolio, right? Okay, this is from my portfolio, by the way. If you want to see the positions or the stocks that are responsible for doubling my portfolio in 2020, these are the three companies: Square, Lemonade, and CrowdStrike. How many of you invested in either one of these three companies? Right? If you did, please let us know what company do you invest in the chat. Okay, let all of us know. So you see, your portfolio doubling, right? It always gives you a very good feeling. Yeah, you feel like you're the king of the world. You feel like, wow, I bought back so much time. Okay, but I'm going to tell you the truth. Not every stock increased like this. Some of the stocks that I have increased by 20%. Some of the stocks that I have increased by 30%. Some of them are not even making money, right? But thanks to these three, my portfolio did very well. But nevertheless, I really wish that I knew some other stocks. Because by knowing some other stocks, right, my portfolio could be more than double. Agree? I could be making 2 times, 3 times, 4 times my entire portfolio or my entire life saving. And I will be even more thrilled, even happier. So these are some other stocks that I really wish I knew, all right, or I've invested in. So stocks that doubled in 2020. For example, Fastly. Any one of you invested in this? You know, I discovered Fastly when it was $25 a share. But at $25 a share, I didn't really understand the company, so I put it aside. And that's the biggest regret. Why? I realized that I just lost a 300% return. Then what about Trade Desk? Again, I found the company at about $300 a share. Didn't understand it, didn't invest in it, missed out on a 176% return. Datadog, same issue, missed out on a 144% return. Digital Turbine, oh man, someone told me about this company when it was about $8, $10 a share, and I left it alone, guys. I didn't do anything, right? I do not know why I was sucking my thumb, and I basically lost a 600% return. Oh man, that's very bad. Okay, and there are some other stocks as well, such as like CrowdStrike 300%, AMD 102%, Etsy 285%, even Okta increased by 100 over percent. Yeah. So my question now to you guys is this. Basically, I'm a researcher, all right? I do a lot of research within the V community, okay? I dig up a lot of information about companies, and I want to know which companies are the ones that are going to be the fastest growers. But most of the companies that I discovered, that are exponential growth in nature, right? They are these brands, these different names, Fastly, Trade Desk, Datadog. My question to you, right? I'm going to put you through my shoes, right? Let you see what I see every single day. I want to ask you guys, how many of these brands do you know? Right? When I mean you know, I mean that you understand what they sell, you know exactly what they do, you know what problem they're solving. Literally, if you are if you are a layman, right? If you never use any of these products, most likely you will not even know what they do. These are not your typical consumer brands, agree? Yeah. Most investors wouldn't know what these companies do. So let me take Digital Turbine, for example, the fastest growing in the bunch. 596% in 2020 alone. So normally when I want to conduct my research, the first thing that I always do is to look at the track record. So when looking at the track record, right, I'm seeing things like this. Wow. Oh man, the revenue is growing by 116% per year, right? Year over year, sorry. And then the compounded annual growth rate or average growth rate is about 58% every single year. Over the past 4 years, that's fantastic growth, man. Nearly 60%. If you go over to the V app, you take a look at the numbers. Gross profit margin maintained at about 40%. Actually, it's improving as well. But then, if you take a look at the net profit margin, from negative to positive, means from loss-making to profitable. Take a look at the return on equity. Again, from negative all the way to 30%. That's fantastic, guys. What about the balance sheet? We always focus on the debt to equity ratio, right? 0.27. That's a very conservative debt to equity. Last one, cash flow. This will blow your mind. Take a look. The company is growing, right? They're growing from internally generated funds. So they generated cash from operation about 49 million. To grow the company, they spent only 7 million. And the remaining 42 million is free cash flow, right? In other words, it's a very asset-like business. But the question here is this. Historical figures, fantastic, wonderful figures. But the key problem is this. Historical results are not indicative of future results. In other words, whatever has happened in the past may or may not repeat in the future. It is our job, right? It is our job as analysts to scratch our head, right, and discover, what are the reasons why we believe the company is going to continue such a track record. So therefore, what do we do? As analysts, what do we do? Number one is we have to find out things like what's the business model? What does the company sell? Right? How do they generate revenues? What problems are they solving? So the business model. Second one is what's their competitive advantage? Every company will have a competitor, right? So you want to see what's their advantage over their competitors. Next, what is the growth potential? So can the company still continue to grow? What are the signs? What are the clues? Next, what are the risks that we need to pay attention to? This is also important. And lastly, what is the intrinsic value? Are we going to overpay for this company? That's also another question we need answered. So how do we identify all of this? How do we find out the answers to all of this? In other words, how do we make known the unknown? Right? If you ask me, the answer is very simple. It's basically to perform our research, right? To start a research on the company itself. And this is something that I always do, and I want to put you through my shoes right now. So how I always start my research is like this: annual reports. I'll go to the company website, I'll download a bunch of annual reports, okay, and then I'll start reading them. And you'll see what I read right now. You'll see something like this. For Digital Turbine, you'll see something like this. Oh, wow. Some of you, when you look at this, you're probably like, oh, you don't want to look at it, right? Why? Too many words. You don't, some people, I'm going to let you know, they don't like to read so many things, okay? And to make matters worse, this is only 2 pages. This annual report has 124 pages. 124, guys. And to make it even worse, this is not the only annual report you should read. You should be reading multiple years annual reports. How many of you, after you hear everything that I mentioned to you, this is what your reaction, right? This is what your reaction is like. You're probably like, no, not interested. Too much words to read. And then probably you start to doubt, oh man, is investing really this hard? Is it really this difficult? Do I really need to do all this? Then some of you probably come up to me, hey, Derek, you know what? I don't read annual reports. I read company, corporate presentations. So what does that mean? It means that you go over to the company's website, you go and download the presentation slides, and you start to read what they want shareholders to know. So for example, this is an extract from the presentation slide of Digital Turbine. But over here, you'll notice, even though it's easier to read, less words, you're going to have more problems. Why? For example, you'll be looking at this, what is advertising fraud? Never heard of it. Problem number 1. Then, what is OEM? Never heard of an OEM before. What is it? Then what about UI, UX? Never heard of UI, UX before. Not sure, right? Then we're talking about channel diversification. What channel? Discovery channel? What channel are we talking about? You see that we are potentially opening up another can of worms? Do you see that? There's a lot of things that we do not know, right? So even though it's easier to read, but at the same time, it is harder to understand. Then if you go over to the next slide, you'll see something like this. Wow. Diverse products drive revenue. Okay, diverse product driving revenue. But what about the rest? For example, every first day. What happens on the first day? Then every day, I don't even know what's happening on the first day. How can I know what's happening every day? Yes or no? Then if you take a look at the slides further, BYOD. What is BYOD? Don't know. Single tap installs. Never heard of single tap installs before, right? Then app wizard. What app wizard are we talking about? Right? What kind of wizard? Not sure. So do you see that many of the terms that they use are way beyond our comprehension, way beyond what we can understand? Okay. So what do you do when you don't understand? You ask Google. So for example, you Google what is BYOD. Now, a wise thing to do when you're Googling is to compare multiple websites. All right. Because if you take one website, that website may not give you the full truth. Right? I give you partial of the truth, may not be even real at all. So we compare multiple websites so that we get the real source of truth. But the problem is this, there's 5.87 million websites to go through. How many of you can see that it's a hassle? It's like, wow, it's nearly impossible. 5.87 million. So again, do you see? We have more questions than answers. In fact, I'm going to let you know, if you go to many of these websites, they're going to have even more terms that you do not know. Right? On the slides alone, a lot of terms that you do not know. Go to the website, another huge set of terms that you do not know. In the end, what you're going to be? You're going to be a full-time Googler. Googler, what is OEM? What is UI, UX? What is channel diversification? What is single tap install? What is content discovery? What is digital turbine? What is everything? Okay? So, to make matters worse, before you can even understand one presentation slide, your friends will come up to you. They will tell you, hey man, have you heard about these companies? You should check it out. Fastly and the Trade Desk. I heard they are fast growing. Distraction. Agree? You get distracted, you're researching on Digital Turbine. Oh man, my friend say Fastly is good. I'm going to switch. So you go with the Fastly and start to research. Then next day, someone will come up to you. Oh man, I just bought these stocks. It's going to go up. I'm very sure. You better buy. So you go and check again. Oh my God. Right? The second company haven't finished researching, the third company comes in. And then the next day, someone else probably going to come to you. Hey man, I bought these stocks, CrowdStrike, made me 100% this year, fantastic returns. Again, you're going to get distracted. And the most irritating distraction is this. Your friends will come up to you, they'll tell you things like this. You say, hey, I heard the coaches are buying these stocks. You better take a look. When you hear the coaches are buying, right, inside your heart, you have something called fear of missing out, FOMO. So you're going to abandon the original stock that you're researching. You're going to jump from stock to stock. So how many of you can see a problem here? The problem over here, right, is basically a problem that I'm facing. It's called information overload, right? Information overload will eventually cause something called analysis paralysis. In other words, too much information that you cannot make a decision, right? You become very indecisive. And when you're so indecisive, right, you can't make returns. So one of my jobs, right, is basically to make investing easier for the masses, right? Even the layman on the street, they're able to invest on their own. But then I realized that investing is actually very hard for the untrained investor, let alone investing for exponential growth. It's very hard for the untrained investor. Why? Let's say you're going to use VF, numbers look good, but from time to time, you got to check the annual reports as well. And when you go to the annual reports, you need to understand accounting. Okay, that's number one. What else? You need to know how to research. Thousands of websites out there. Which websites are the reliable one, right? How do we identify the fake news and the real news? How do we identify facts versus fiction? Right? You got to know all these, how to research. Next, you need to expand your circle of competence. Like some of you saw me, putting up a bunch of IT companies. If you're not from the information and technology field, if you're someone, who works as a carpenter or maybe someone who does, simpler jobs, probably you're not going to understand IT. Agree? Yeah. So you got to expand your circle of competence, and that alone is not easy. And number 4, you need to be very patient and very persistent. Imagine you just come home from work, you're dead tired, and you want to rest, and you see this face telling you, man, you got to study your annual reports if you want to make money. You're not going to do it. Agree? You're not going to do it. Even though you know you need to be persistent and you need to be patient. And the worst part is this, most of the time, we will not buy a stock that we have not researched. In other words, if we have not come to a conclusion on a stock, we will not buy it. So if you don't buy, this happens. So everyone, ladies and gentlemen, my question to you right now before I go on is, did I describe your problems accurately? Did I describe it accurately? To me, the answer is yes. Why? Because I've been in your shoes. Right? I've seen what you've seen. I was once an amateur, right? So I go through all this. So the question right now is this: are there simpler investments? Are there investments that are easier to do, easier to perform, and easier to execute? The good news is yes, there is. So in other words, for exponential growth investing to be feasible, to be doable by everyone, if you want to gain consistent returns like this, number 1, it has to be easy to understand. Agree? If you don't understand, then you cannot take action. Even though you want to take action, also you're quite scared. Number 2 is you got to be consistent. It cannot be a one-time return. If it's just a one-time return, not repeatable, then you're making pocket money, you're not actually investing. Number 3, for exponential returns, it has to give you hyper growth returns, right? Then only it will be an exponential, opportunity in your portfolio. So let's start with the first one. How do we make investments that are easy to understand? Number 1, we choose stocks that we already know. So for example, how many of you know these companies? Coca-Cola. Without reading the annual report, I know what they sell, canned drinks, right? Apple. Without reading the annual report, I know what they sell, iPhone and MacBooks. Starbucks. Before I even read the annual report, I know they sell coffee. So easy to understand, right? But let's say you never heard of these brands. Let me ask you another question. Make it even easier. Let's buy the whole bucket, buy everything. So for example, let me ask you, the next 10 years, will technology do fine? The answer is easily a yes. If that is so, then you buy this stock called XLK. When you buy XLK, you're buying an entire portfolio of stocks at one go. All right? You're buying companies like Apple, Microsoft, Visa, Nvidia, Mastercard, PayPal, Adobe, Intel, Salesforce, and Cisco. You're buying everything. But let's say you don't even understand technology. Let's say I ask you, will technology do well in the next 10 years? Don't know. What about if I ask you, will America still be relevant in the next 10 years? The answer is definitely a yes. America won't just disappear, right? So you can buy the entire US market, the S&P 500, top 500 companies in the US. Just key the stock ticker SPY and click buy, right? Therefore, you're buying these 10 different companies over here. So do you see that right now? Investment opportunity actually can be quite easy. You don't have to crack your head. Agree? Make sense? Yeah. So right now we know it's easy. Wow, easy to understand means easy to take action. Very good. But is the result consistent? Are the results consistent? Let's take a look. Apple, for example, between 2016 to 2017, gave investors a positive return. 17 to 18 gave investors a positive return. 18 to 19, a one-time negative. In fact, not even a big negative, it's just slightly dropping, right? But 19 to 20 positive, the rest of the years positive, even 2021. What about Disney? You'll see the same thing. Positive, positive, negative, positive, positive. What about XLK? Positive, positive, negative, positive, positive. So do you see that 4 out of 5 years, all of these companies are giving you very consistent returns. It's not just 1 month profit, 2 months profit, it's every single year's profit, okay, over the past 5 years. Now, the last question is this. Easy to understand company, very good. Consistent returns, very good. But what about the risk to reward ratio? Will it give me an exponential return? Let's take a look. So SPY, if you bought this stock in 2020, which by the way is the best year to make money, and you bought this stock at the bottom, right? The very bottom in March 2020, and you held on until today, you're only going to make about 70% return. Now think about that. To me, that's horrible. That's not hyper growth. Why? Because 2020 is the best year to invest and you bought it at the bottom. You should be making more than 100% return. Agree? But you're only going to make 69%. So imagine if you buy on a normal day. You're not going to make good returns. No way. Then what about Starbucks? Starbucks also, if you take a look, if you bought from the bottom in 2020, you're going to make about 55% return. How is this going to give you exponential growth? What about Disney? 66%. XLK, the best performing stock, right? Bought at the bottom in 2020, in March, you're only going to make 83% if you held on until today. All of these stocks never make you 100% return in just 1 year. So therefore, it cannot fit the category of hyper growth returns. Agree? Make sense? Yeah. So how many of you want a solution? You want stocks that are easy. You want stocks that are consistent, but at the same time, you also want hyper growth returns. Because I have a solution for you. So imagine if I give you a tool. Okay. I give you a very, very powerful tool. What does this tool do? Number one, this tool will allow you to make money in all market conditions, whether it's a bullish market, bearish market, or a flat market. All markets, you get returns. Number two, what if I can give you a tool that you can use to undo your mistakes? So for example, if let's say certain investment that you make, you didn't do well, this tool can potentially save you. What if I can give you a tool that can be used to amplify your returns, right? 100% return, double it to 300%. What if I can give you that tool? Would you want to learn? Yes, right? So for today, we're going to focus on this tool. How do we use it to amplify our returns? So number one, let's take Starbucks. Example. So in March 2020, if you take a look, Starbucks share price fall all the way to $58. $58, right? That is even below the green line, therefore undervalue. So if undervalue, right? Imagine that you have $10,000 to invest. Someone just gave you that money, asked you to invest in Starbucks. Traditionally, what would you do? Oh, already undervalue. I'll take all the 10,000 and I'll buy shares. Agree? I'll just buy $10,000 worth of shares. But if you give me that $10,000, this is what I would do. I would buy 160 shares at $55.55 each. Therefore, I will only invest about $8,888 in shares. Who's going to make more money? Probably going to say if the share price go up, right? then I'm going to make more money because I spent all 10,000, whereas you spend only 8,888. Well, what about the remaining 1,000 plus? Where did it go? Let me show you. So Starbucks, right? What happened? The share price recover all the way to over $100 a share. These are my investment results. If I bought stocks, right, you will see over here, when I bought stocks, I'll make about 86% return on the stocks. 86%, that's quite good. But overall for Starbucks, I'm making 116% return. Then you're probably scratching your head. You invested in 160 shares, your profit should be 7,006. Where did the extra come from that you make 11,000? I never show you. Let me show you. It's because I have in my portfolio also something called a call option, right? I also bought a call option and it gave me a 389% return, which is about $3,800 in profit. So 7,000 plus 3,008, you get 11,500. So this, my friends, is the secret. This is how we exponentially grow any investment opportunity. Let me show you more. Okay, what is this magical tool? Basically, as I mentioned, it is called an option. But for today, specifically, we are going to discuss the call option. So what is a call option? Now, a call option is very simple. It is basically a tool, all right, or a contract that gives you a right to buy a stock at a certain price called the strike price, right, within a certain period of time. Okay, so again, a right to buy a stock at a certain price. That's all. And basically, right, this contract is only valid for a certain period of time. Let's say 1 year, 2 years, or 3 months, 4 months, depending. Number 3, to buy one, you have to pay some premiums. Okay, you have to pay some premiums, which in other words is called money. Yeah, you got to pay money to get this piece of paper, this contract that gives you this particular right. But some of you are going to look at this, oh man, what is this? It's like very difficult to understand. Okay, we're going back to square one, right? So in layman, in super layman, think about a call option as steroids. Steroids for your portfolio, steroids for your investment. How does it work? Now let's take a look. SPY. Share price plummet in March 2020. Okay, if you give me $10,000 to invest in this, right, I will take $10,000. I will buy 40 shares at 223. That's number 1. Buy 40 shares at 223 and buy one call option at $901. So this is my total investment. The shares will cost me about $8,940. The option will cost me $901. So in total, I've invested about $9,841. That's my total investment. Then let's take a look at the results. The results, the share price went up, recovered, right? These are my investment results. So basically, the stock made me 69% return, but the option made me 1,200% return. So overall, my portfolio increased by 173%. Can you see that? That's the magic. Number 2, XLK. Share price falls in 2020 March. Okay, I will take $10,000. I'll buy 131 shares, and at the same time, I'll buy one call option. These will be my results. Okay, this will be my investment total. Investment in stock will cost me $9,003. Investment in options will cost me $955. Total investment will be about almost $10,000. Then if the share price recovers, you'll see that the stocks will give me 88% return. Fantastic. But the options is going to give me about 475% return. That's even better if you ask me. So my overall portfolio will increase by 125%. Do you see the exponential growth? Right? Exponential growth on a slow growing company. So next one. The question is this. Some of you probably, when you see all this, right? Man, on Monday, you're going to think, I'm not going to buy stocks anymore. Stocks not going to give me good returns, right? Why not? I just go all out on options. I just buy options. Okay? Anyway, it's going to make good returns, right? Buyer beware. If you overdose on steroids, you're going to harm your body. The same thing with options. If you overdose on these steroids, right, you're going to harm your portfolio very significantly. Example, imagine you bought Intel. Okay, you bought call options on Intel, and after 1 year, the share price just stay flat, flat, never move, your position will lose 100% or 98.92%. In other words, you would have lost almost all your capital. Nothing gonna get back. There's no repair, there's no U-turn. You're not gonna get anything back. You can only suck your thumb and receive that loss. That's number one problem. Let me show you more. For example, this guy I found on another investing forum. He mentioned that using options, he managed to turn his portfolio from $2,000 to $100,000 in just 1 month. That's fantastic, guys. There's no words to explain how fantastic that is. In fact, that $100,000 increased to an all-time high of $230,000. So this guy felt like the king of the world. So he continued investing very aggressively in options. He became arrogant, right? He became arrogant. He felt he was king, and therefore the market taught him a lesson which he will never forget, whereby his $230,000, right, depreciate, right, or reduce all the way to $1,000 using the very same tool that made him rich in the first place. So this is the danger if you focus too much on options. So how do you protect yourself? How do you protect yourself from all this? Number one, you invest only in high quality companies. In other words, always be very selective of your companies that you are going to invest in. Number two, you got to control your greed. High returns, yes, but you got to control, not let your ego take over your investment decisions. Next, make sure that your contract has enough time. So as I mentioned, every option contract has an expiry date. So when I go into a call option contract, I like to have long expiry date of at least 1 year. Yeah. And lastly, learn how to properly use options. Why? For example, if you log into the brokerage account, you're going to buy a call option, then number one, you'll see a lot of expiry dates. Number two, you'll see a lot of numbers. Which one do I pick? Out of this, which one do I pick? And this is why you need to learn. Okay. So for example, where can you learn? You can learn from YouTube, Google, or if you want, something that is more comprehensive, compile everything nicely for you step by step, then the VRS Plus program. So the last question here is this. We have seen how do you, hyper growth a slow growing company. We have seen that. We have known that. The next question is this. Just imagine what happens if you inject these steroids into a hyper growth stock, an exponentially growing stock. What will happen? Let's explore. For example, Fastly. So Fastly, right, if you take a look, if you bought stocks and call options with $10,000, right? If you invested with $10,000 stocks and options, you will make a 568% return. Why? The stocks will give you 419%. The option will give you nearly 2,000%. So in other words, every $10,000 investment is going to give you about $56,503 in profit in 1 year. That's how powerful it is. Okay. What about CrossRite? CrossRite, if you invested $10,000 to buy both stocks and options, you'll see that the stock will give you about 370% return. Okay. But for the options, it's going to give you about 3,000% return. That means every $10,000 you have invested in CrossRite with stocks and options, you're going to get back $64,000 in profits again in 1 year. Okay. Then what about Digital Turbine? Oh man, this one is crazy. If you invested $10,000 to buy stocks and options, right, this will be your result. The stocks will give you 1,400% return. The option is going to give you about 3,200% return. In overall, your portfolio, every $10,000 you have invested is going to produce for you $164,000. That, my friends, is hyper growth returns. That, my friends, is exponential returns, which is the theme of the V Summit today. Okay, so hopefully this will gear you up, for 2021. Oh man, this is something I gotta do to hyper growth my portfolio. We're not really interested in, if you are investing for 10%, 15%, 20% per year, that probably gonna allow you to retire at the retirement age. But if you want to kickstart, accelerate, right? If you want to accelerate your retirement, right? These are the investment tools that you need. Okay. So some of you are probably looking at this, right? And I'm going to share with you something. I'm going to share with you that ever since I learned options, I'm very firm. Not every investment will give you exponential returns. Many stocks out there, especially some of them in Malaysia, they're going to give you like 5%, 6%, 20% per year. Nah, not exponential return, not good at all. Not good enough. Not good enough. Huh? But provided you use the right tool, the right knowledge, you can turn any stock, right? Or basically, as I say over here, with the right knowledge and the right tool, an exponential return can come from any investment. But one last thing, some of you, even though I can't really see you, I know some of you at the back of your screen, you're thinking, there's a small bird talking in your mind. You're saying that all these things look too good to be true. Then another side of your brain, another small bird be talking, if it's too good to be true, then most likely it is too good to be true. Yeah, most likely it is. Can't be real. I've never seen people making 3,000% in 1 year. That can't be real. Doesn't make sense, right? It sounds like a scam. Now, my message to you is very simple. It is not say it is a scam. It is not say that it's not possible. It is just that you are not exposed to it. You've never seen it before. So I'm going to put you through my eyes. Okay, I'm going to put you through what I see. Then you tell me if it's possible. You tell me if it's real. Example, this is Jacqueline. Jacqueline made 1,000%, on 13 January this year. 1,040%. And we are just starting out 2021. Okay. Her boyfriend made this amount of money and she told me, as you can read here, right? His birthday was yesterday and this is his best birthday present for the year. Thank you, Derek and B College for exposing us to VIOS. That's the power of options, right? Second, right? My student texts me on my social media, say, hi Derek, just want to thank you for all your sharings. Why? Because in his options, it made him 493% return. This is not even 1 year, guys. Not even 1 year. Take a look. Next one. All right. These are people who make 537% and 790% on their investment. One is in Disney, another one is on Lemonade. Right? Yeah. So again, this is something that I'm seeing on a regular basis. This is Edwin. In the year 2020, all right, the year haven't even ended, back then. He has already made 1,001% return. Let me show you another one. This one you won't believe, but it's real. All real story. This is one more of my student called Tehan. So basically, as you can see here, within 8 months, 5,000% return. Okay, 5,000% return within just 8 months. He can't believe it himself, And then I always mention, nobody believes it until they see it for themselves. But some of you are probably still skeptical, wow, can't be real. Never see before this kinds of thing. Don't even know if they exist or not. Don't know whether to believe or not. Let me tell you what, I'm going to get you a live testimonial, right? A live testimonial. This is from the first student that I have when I was teaching VIOS Plus. Okay, so this is the first student I had and the first student that I coached, and he's also a multi-millionaire, right? So this person, some of you probably already know, his name is Ken. He's our CEO and the founder of 8VI Group. So basically, when he found out that I have this program itself called VIOS Plus, he's the first person to sign up and his result has been extraordinary. So without further ado, I'm going to call Ken up to share his experience with all of you using options. So everyone, please give a warm round of applause to Ken. All right. Again, louder. One very warm round of applause. Okay. Please invite Ken up to share with you. Let's go.
Thank you, Derek. Thank you. Excellent. Now, how many of you think Derek actually sharing just now is very powerful? If you think it's powerful, can you just type in the word powerful in the chat so I know that you are following Derek? Yeah, thank you so much, Raymond. Can see that. Thank you. Okay. Yes. Now, and I'll tell you the background. Okay. How I learned from Derek, right? About 3.5 years ago. No, in fact, close to 4 years ago. Yeah. Okay. My Malaysian director Gary Yao actually gave me a call. He said, Ken, we have a situation. I said, what's the situation? He said, we have this particular team member in Malaysia. They come in the office, okay, don't know what he do, but whole day long he will stare at the computer. And he will just focusing on studying computer. Then I asked Gary, so is he sleeping while he's working in a job? He said, no, he did not sleep. He was focusing in front of the computer. I said, what is he focusing on? He said he's studying a particular topic. in the niche area of investing. I said, what is that? He said, it's actually using option to complement the overall return for value investing itself. I said, that itself is interesting, okay? And after 3 years, right, okay, we let Derek just go and actually focus and actually really do his stuff and analyze and research. Okay, after 3.5, 4 years of research, right, Derek have nailed down 3 strategy, and finally one day he came to me and said that, boss, these are 3 strategy and this is my return. Okay, after seeing his return, right, with the strategy, right, basically I told him, please continue, your job is to stare at the screen. It's a true story. And we decided to actually start the program after close to 4 years of research and narrow down on 3 strategy. One of the strategy just now Derek showed you, right? Okay, it's called the call option, but of course it combined with other strategy that he'll teach you in the program. And when he launched the program, I can tell you, I'm the first student who signed up. First one, I pay my own money, sign the own program. Okay, the program that my company designed. Although I'm a CEO, I still use my own money to actually pay for it. Okay, so that I never take advantage of shareholder. Okay, important. And after I attended the program in 2019, yes, 2019, it's amazing because I still remember my first month, right? The cash flow I generated was about 25,000 US. And just like that, no, it's really quite amazing like what Derek say but I need to highlight one thing is this but of course after that every single month, right, my cash flow just from option itself easily 5-figure US dollar okay. Now Derek just now used the word an analogy of what we call a steroid. Okay, option is like steroid. Maybe I'll put it in another way. Okay, the share and call option strategy combo, right, I will refer it to turkey. Okay, that means that the share is turkey meat. You know, like festive season, you eat turkey, right? Okay. The option is the gravy. Okay. So a lot of people out there, they keep eating gravy. So you keep eating gravy, either you got kidney problem or you got diabetic. Agree not? Too sweet or too salty. But if you add gravy on the meat or on the main dish, then your whole meal, okay, will be quite tasty. Okay, this is the analogy I'm going to go for. So to answer one of the questions you asked, what is the allocation, okay, of between share and option? Usually it's about, okay, for me, 80% share, 20% option. If you think that's helpful, can you type in helpful? Thank you. Okay, and by the way, if you understand my analogy, okay, at least tell me you understand. Thank you. Okay, now, and I want to introduce to you the group of people who, hang on, let me see, is it highlight my iPad slide already? Oh, here, okay, good. So now I want to introduce to you the team of people that started this VIOS Plus team that support our V community of graduate to outsize the portfolio return using small capital. Okay, now I would like to use the word outsize. Okay, because when I saw the power of option, if you know how to use it properly, okay, not trading, really to enhance your good company selection, you can see a great difference, okay, in your investment result in a short period of time. So apart from Derek, now we have Richie, Alex, and Eric. Okay, later I will also invite Eric to share his experience of using option. Quite amazing, the result for him. Okay, so now, and this team, okay, for those who have experienced so-called the VIOS program, or you're in the VIOS Plus tribe, okay, if you find that, this team is really very helpful, and really, that means that no matter what day of the week, you ask questions, they're always there supporting, okay, helping you to actually answer your Q&A, things like this. Okay, if you think that really helpful, can you type in the chat? Okay, if you attended their program before and you're still in the tribe, okay, making good return, can you say that, okay, they are good guys, just put that good guys, okay? So, or VIOS Plus rock, so that I know that you're one of the graduate. Awesome, right? Excellent, really good guys, really good guys, okay? So now, since we launched the program in 2019, we have supported more than 1,000 V graduate with the option journey. Carefully, safely, okay, surely that make return. And many of them, in fact, have made back many times, okay, of their program fee. Okay, all the program fee, they make it many times already. Okay, and the most powerful thing here is you can do it again and again. Okay, it's a lifetime skill already. Can you type in the chat right now? It's called skill set. It become a life skill set. So once you learn this, right, you can generate, okay, cash flow again and again and again. Okay, it's a very powerful skill set. I see it for myself also. Okay, so now, and like what I mentioned earlier on, life change. Like just now, what Derek shared, Jacqueline, right? I'll not go through, and many others, right? Many others itself. Okay, so but what is so powerful? Okay, well, this one is even, let me see, this one is even close to 10,000% return. Amazing. Okay, so now, so the tribe, we have a VROS Plus tribe. Now I need to actually highlight this. It's not this VROS Plus is not for the public. If you're not our VIB graduate, right, or V College graduate, you can't even take part in this, okay, so-called VROS Plus. You are not allowed to even come. Why? Like I said, we still focus on the meat, okay, which is the fundamental, taking good company. So you will learn in the VIB International or VIB Full Additional Program, okay. The option VROS Plus is a gravy. Okay, so if you don't have the basis of fundamental, you're not allowed to actually come for this coaching and mentoring. Okay, so now, and how will you benefit our tribe people? How do we benefit? Mainly, I will summarize in 3 areas. First is learn, spot, execute. Okay, so now, what do I mean by learn? So, on a weekly basis, okay, and very regular basis, the coach, the VROS Plus coach team, okay, will have this thing called the trade mastery. So in a sense that they will show you, okay, new ideas and new strategy they thought of. They will backtest the strategy and constantly update with our tribe, right? Now, and of course, okay, you will learn there's a better way to actually generate a better return. Let's say, example, you identify a company, you want to buy a stock. Okay, in the VROS Plus tribe will tell you, yes, you can buy the stock. On top of that, you might want to consider to allocate a small portion on the original capital into the option so that the overall return can be enhanced. So you'll constantly learn this kind of new way to make an outsized return for your investment. Okay, given a shorter time period. And okay, a lot of our graduates after learning, right, like I mentioned, they will learn, okay, like 1,200% after learning, no. And the learning itself, you see the effect immediately one. Quite immediate. Usually within a month, you'll see result one. Okay. So now, say now, spot. Now, what is spot? The spot is very interesting. Derek and his team, okay, have this habit of spotting good company that haven't even take off yet. Usually haven't take off in a big way. I'll show you. Okay. And we'll share these ideas constantly on a weekly basis or bi-weekly basis, okay, in the VROS Plus tribe, in that bubble, right? I'll give you an example. So 30th of October 2020, which is about 2.5-3 months ago, okay, Derek and his team in the VROS Plus bubble, okay, only our VROS Plus mentee can be in there, okay, saying that ready start to watch Square and CrowdStrike like hot, ready to pound, right? Okay, let's take a look. That is the date, 30th of October. Look what happened, okay, after they spotted. Okay, now, the trend usually uncannily, like, if you actually take action, right, okay, the price itself, the return from Square is really 47%, right? And CrowdStrike is really 77%, right? From the 3 months ago, no. Yeah. Excuse me. So next one, take a look. This one is actually, I believe this is digital turbine. Share on actually on the 12th of December 2020. Okay. After share, up to this point, it's about 28% or close to 30%. So now next, take a look. 13 November. Oh, this one. The one of the favorite drink for the VIOS Plus tribe. I think after Derek shared this particular company, right, this opportunity, most of the VIS Plus people start to buy this drink already. Whether you got exercise, never exercise, you also buy this drink. Okay, because I know because you all keep mentioning it, right? And it's pretty amazing. Okay, why? Because after Derek share, the return is 100%. And this is on the share level. No? Can you imagine if you add on to the option, call option with the gravy, that return is even more amazing. Okay, yeah. So now, and lemonade, classic. Okay, 28th of actually September, Derek started to share in the tribe itself. Okay, so he said this, I have only one advice. Watch very, very carefully, okay, and pay very, very, very close attention. Okay, if you don't, you're potentially doing your future generation a huge disservice. Drop mic. Okay, and close to 200% return. That is the power of the VIOS Plus tribe. Okay, that's what Derek say about outsized return. Okay, now, and most importantly, having the knowledge to learn. After you learn, the tribe, okay, or the mentee or coach is able to spot the opportunity. But if you cannot execute or you don't know how to execute, also cannot make return, right? Agree or not? Okay, so now, therefore, the most powerful thing about VIOS Plus tribe is that something I mentioned earlier on is called a trade mastery, where we will guide, okay, all our mentees to do the trade. Because if you do it alone, okay, you might actually have what I call hesitation. But if you actually have your mentor and your coach doing together with you, okay, and surely and steadily as a tribe, then you have more confidence. And very often, like I said, we focus on execution, a lot of execution. Okay, so now the key thing here is to execute. Okay, so many, too many already. Okay, now but I want to actually to bring on one of the coach VIOS Plus one, also learned from Derek and originally. Okay, so to share his experience, how he combined the learn, spot, and execute and make an outsized return. Okay, so now watch this video carefully right now.
Thank you, Ken. Hi, everyone. My name is Eric, speaker and trainer of V College. Here, I would like to share with you how VIOS Plus strategy have improved my result tremendously. All right, so let's look at my screen. So I'll be using Huya as an example here. So last year, I found this company around November period. And when I learned about this company, wow, this company is very huge in gaming, huge in China. That's why I like to build up my position. Okay, so how I build up my positions, I build up using this strategy called VIOS. So for those who are in full edition program, you'll know what this strategy is about. Okay, so I sold the put, collected premium of $1. So $1 for every contract, right? So every contract is 100 shares. So I collected $100. So likewise, I collected another contract, which is around $365. So all in all, 4.6, right? I collected $465. So my yield is roughly like 20+%. How many of you like that? If you like that, just type in the 1. Okay, so I collected yield from this sell put position. Next, you ask yourself, how can we improve our result further? That's why in our VIOS Plus strategy, we have one strategy called glass cannon. Okay, so this is a buy call strategy whereby I buy at 480, buy at 480, and right now the call position right now is 6.6. So my ROI for the call position is 37.5%. How many of you within 2 months you like this kind of return one? If you like that, just type in the 1. Okay, so this is how I collected premium and buy a call. But I would like to switch your perspective a bit right here. Switch your perspective. Okay, so we're buying a call. There's a capital outlay, right? So I have an outlay of $4.80. If you get that, just type in 1. So there's a capital outlay. But I've collected premium $4.65, right? Okay. So do you see that my capital outlay actually is only 15 cents? And with the current value, the call options current value of 6.6, my ROI is at 43 times. Okay. How many of you don't mind this kind of return? If you like that, just type in a yes. All right. Okay. So you ask, hey, can this strategy be implemented or duplicated in other companies or moving forward? Okay. So let me share with you another companies that I use similar strategy. So other companies that are using similar strategy is Palantir Technologies. Okay. So Likewise, I've studied company. I like this company. This company is growing. That's why I grow this company by going into put position. So I sell a put, collected 58 cents. Another put, collected $2.30. Another put, collected $5.10. So all these put, so-called premium, add up together is $7.98. So I collected $798 upfront. Okay. So next, I do the same thing. I want to improve my result further. So I went into this buy call position, the glass cannon strategy. My RO right now is at 75%. How many of you don't mind this kind of return? If you don't mind, just type in a me. Okay. So let's switch the perspective again. So by buying this Palantir put call options is $8.50. I collected the premium $7.98. So my capital outlay is 52 cents. Okay. At the current value of $14.90, my ROI is 28 times. How many of you like this kind of return? If you like that, just type in the me. Okay. Yeah. But let me ask you, for those who know how to sell put, can I continue to sell put? And do I do that? Or did I do that? And the answer is yes. This month, I did another put. I collected another $3. So if you could see right here, do you see that my call position is theoretically free? And do you think that I can continue to use this strategy to implement in other company or just by continue selling put? Okay, so this is how we have improved our investment result using VIOS plus strategy. Okay, so this is my sharing. Ken, I pass time back to you.
Thank you, Eric. Okay, now I think this is really amazing. Another true testament to tell you that how you learn, spot, execute, outsize the return using very little capital outlay. In fact, sometimes even free capital itself. Not on your own capital first. We're not saying that you don't need to use capital, but you stand by your capital. Okay, you don't need to outlay that capital first, right? So now that itself is very powerful. That's why it helped a lot of actually our VIB full edition graduate to generate outsized return, quickly cover all the cost fee and much more. Okay, and we have been receiving a lot of testimonial, too much already. So therefore, if you are, how many you want another ang pao? Okay, if you want ang pao, can you type in ang pao quickly? Okay, really, this one is a big ang pao. Type in right now, ang pao. Okay, I'm going to give you a big ang pao quickly. Okay, so now, and like I said, VIOS Plus okay, is only for the VIB full edition graduate. So take note. So the ang pao is this for the bonus. For those who decided to actually to really want to capitalize and learn, okay, and learn how to also spot and execute using very small capital. In fact, don't need to use your own capital outlay to make outsized return. Okay, so and you'll be coached by us and our team. Okay, over the next 1 year. First, after you go through a VIOS Plus program, right? Okay, which is I believe is a 3 days program. Now, after that, you have an unlimited lifetime review. I'll tell you, this unlimited lifetime review, what is the value here? The value here is Derek and the team constantly, they backtest their strategy. And they will actually come out with refined, sustainable strategy, if they discover one, and share with the tribe. Okay? Now, because the knowledge itself is not static one, it's continue evolving. Right? Just like we discover new company business model, same thing for investment strategy using option itself, right? So now that itself is one-time investment, lifetime usage. Next, worth about 10,000 easily. So next is, this one is powerful, really powerful. After the 3 days program, right, you can go to the chat, those who attended VIOS Plus, you'll know, okay? The 1 year free support, okay, where you focus on spotting opportunity, learning how to actually to customize using stock and option, or sometimes just using option to do an outsized return. Okay, focus on execution, right, and result. And that itself is worth about $50,000 easily, because I've seen, okay, our graduate within a year make about $30,000, $40,000, $50,000 a year just from using this strategy that actually taught by Derek and his team. Now, let's take a look here. Okay, is this so-called program value easily worth 25,000 or 22,000 easily? I'll say yes. Why? You just look at actually one of the graduate who say this. He say, Okay. Just add a testimony to prove small account also possible to grow big, right? So now he invested 10,000 and within a short period of time, the 10,000 become 25,000. That is a profit of 15,000. So roughly is the 60,000 ringgit lah. So if you ask me this program value, is it 60,000? No, I say easily 60,000 lah. Easily lah. And he continue to make money. If it doesn't stop one time, it's a skill set. You do it again and again and again one. Okay. So now, for the ang pao, I'll tell you right now. Okay, total value received easily about 22,000. Okay, I'm going to sign up. Now, today you will have a saving of more than about close to 90%. Now for Singapore grad itself, only for VIB full edition, Singapore grad, okay, is 2499. Okay, and you can, excluding GST, and you can opt for 36-month interest-free installment. Malaysia grad for VIB full edition is about 7,005 ringgit. So you can see it's a direct, okay, conversion. Now, then you ask me where's the ang pao? Okay, the ang pao come in this. Listen, after the VIS 2021 event, right? VIOS plus, okay, the cost fee will increase. Please mark my word. I repeat, just in case you do not know, okay, or you do not hear clearly, VIOS plus program after VIS 2021, the cost fee will increase minimally to 3,000 in Singapore dollars, okay, and in ringgit to 9,000 ringgit. So if you take action today, okay, confirm you will save, okay, about $500 Sing or about 1,005 ringgit. Okay, I'm not joking one. You come back again after this weekend, you see the price increase one. Those graduates stay with us long enough, you know, after we say, hey, invest already. Okay. So now still a last chance for you to take action right now. So if you have been wondering whether to do it or not, I'll tell you, just do it lah. You know why? Just do it. I always tell the graduate, ayo, you do one put option, you really make back the cost fee already. Or sometimes two put option, make back the cost fee already. No brainer one. Seriously, no brainer one. Okay. Really no brainer one. And plus, there's a 36-month interest-free installment. Okay. Oh, how to sign up? Okay. Cool. Okay. So, now, for VIB full edition graduate, this is a QR code you can scan. Or, okay, team leader in a different chat, please put in the link right now in that team, in the group. Only VIB full edition grad can use this link, okay, and scan the code. By the way, we'll know whether you're full edition grad or not. Now, so don't worry, Singapore and Malaysia grad, you scan this link. The IP is smart enough to know which location you're at. They will convert the currency automatically. So you don't have to worry. Just one link can already. Upcoming batch is on the 5th to 7th of March, okay, which is soon after Chinese New Year. Now, if you are not a VIB full edition graduate, you are the international and special edition, but you also would come for the VIOS plus, can. We have a bundle special for you. So you scan this code, the bundle special include VIB full edition and the VIOS plus program together. Okay? So now, I said you cannot jump without attending VIB full edition program to come for VIOS plus, because we do not allow, you need to have stronger fundamental first, okay, to identify good, solid company first. Okay? So this is the link. If you are VIB International or Special Edition graduate itself, scan this, okay, and plus. Or now the IC, group IC, can you actually put in the link into a respective chat group? Thank you. Also, there's a 12 to 36-month interest installment. Now, however, if you're non-graduate, you're not any of our graduate, but you have just, your jaw just dropped. Okay, you have heard something that you like, unbelievable one, and you are very keen to explore right now to learn about investing. Okay, now please scan this QR code, okay, or the IC right now will put in the link, okay, for you to click in to learn more about introductory program, a workshop, so that you can actually start your journey right now. Okay, everything starts step by step, no need to rush. Okay, don't worry, market open from Monday to Friday, except for weekend and public holiday. So sure got opportunity one. Okay, trust me on that. So now, and I'll give you another ang pao. Listen, another ang pao. Okay, those who sign up now, those who sign up now, okay, for the VIOS Plus or the bundle one, okay, tomorrow there's a special session during lunch, okay, where you'll be given a link to watch a session conducted by me and Melvin, which in this session itself, I will share with you a case study that's 100 bagger. Listen carefully, 100 bagger. And none of the V College coach have talked about this company at all. None of the HCF team, including Joshua and Ashley, Clive, have analyzed and talked about this company at all, but it's 100 bagger. So only for, okay, people who sign up today, the VIOS Plus program and the bundle one, okay, and the existing VIOS Plus graduate and Infinite Wealth mentee. This one, both of you, these two groups come for free one. Okay? Yeah, come for free one. Okay? Don't worry, come for free one. So for the VIOS Plus, okay, mentee, graduate, and an Infinite Wealth mentee, right? You will find that link tomorrow from 12 p.m. to 2 p.m. inside the VIOS Plus bubble. So for those who actually sign up for the program, we will send the link to your email. So you have to watch out. Okay? So because you're not in the bubble yet, okay? So that you will not miss out. So now, right now, okay, you have any question, quickly take the opportunity, okay, talk to your group IC in the chat. I would like to invite, okay, Pauline up right now. We'll do a Q&A session and share more about investment idea with you. Okay, just give me about 30 seconds while I invite Pauline up. Hey, hi. So now we have Pauline with us here. So Pauline, you want to share with the audience, how
yes.
did option help you to improve your portfolio return?
Okay, you know, how many of you know me for many years already? I think many of you probably have come for my so-called the 2-hour free webinars and the rest of other sessions probably. And you know, a lot of times I talk a lot about passive income, dividends. And in the past, when I first started off, let me just share with you my learning journey. I think this one will be very applicable for many of you, probably even if you are new, or maybe you are like 2 years or 3 years in your investing journey. This is going to help you, I think, if I share my experience. Because unlike Ken, Ken is my mentor. He taught me. So he probably didn't know what we go through, right? But I sure know one because I started off with someone who didn't know about investing. So when I first came for last time, used to be called the MIP program, Millionaire Investor Program. Okay, I learned about really the whole fundamentals about investing. So for those who are our MIP grads, hello, yes, we are the old batch one, the old birds. The MIP is equivalent to the right now VIB full edition. Okay, so because of the COVID, we started off one which is called the VIB International or VIB Special Edition, which is kind of like the online, more not so much in depth, okay, to let people to start up with investing. And then one focus a lot about getting passive income like dividends. But we also know one thing. So why is it that Pauline Teo changed strategies? Not that I wanted to, it's because really in the past, when I first started, I still remember Ken actually taught me. Ken and Clive taught me when we look at the companies. So it's a very, really look at brick and mortar business. And then like Brad talk, I invest, I capital appreciation, I collect dividends.
Correct.
Japan Food Holdings also
Correct.
made me 300%.
Correct.
Okay, you all know Japan Food Holdings is still listed in Singapore, still give quite good dividends. But there's an issue with all these companies. So these companies right now, because of the COVID situation and businesses have changed because of technology, a lot of these businesses can't really give good dividends unless, okay, there's an unless you were like us, invested many years ago.
Yep.
Yeah, so it's like a case of when I bought bread chalk last time, it's only like gokak, 50 cents. Then it privatized at $1.70. And the other one was, let's say, Japan Food Holdings, which I actually bought at last time, like I think I can't remember because I sold it off already. I think 30, 40 cents, that kind of prices. And right now it's still at about, I sold it off at about 60, 70 cents.
Yep.
And I collect good dividends. In fact, many of those companies I invested in Singapore, like Vicom also, many years already, still keeping it. My Sheng Siong also, I still keep it and giving me good dividends. But your question will be this, Pauline. You see, all these companies that we talk about, we cannot invest what, right? This is what I heard, many a times. So this is where, because businesses have changed, we changed strategy. And I also, like Ken, 2 years ago, went to sign up for the VIOS Plus. Yeah. The thing about this, even though it's our, so-called, we work in the company, we pay school fees for your information. Yes. Yeah, because we believe in it. We believe if we actually invest our own money into it, I will tell you one thing. Why is it that both of us, we put our own cash into signing up for the course? Can we just attend like that? I think if Ken say, I want to attend, Derek will not say no. Right?
But to first acknowledge
Yeah.
the hard work and the contribution of individual and a team, research, right?
Yeah.
Effort.
I think most importantly, also, I realized one thing. When I put in the money in VIOS Plus,
I learned.
one thing? I must take action.
Correct.
Yes, I must take action, because options to me last time, I'm not sure just now when you look at Eric's case study, after I looking at it, I was like, you all understand?
Yep.
How many of you, after looking at Eric's case study, your one word is called blur? Type in blur right now. Really, type in the word blur. If you are blur after, you see, Amy is saying blur. Everybody say blur. Well, what is he doing?
But I can tell you, although they say blur, right? They still want to make the return.
Precisely.
You are blur, but you're not blur in making the return. You are blur because you don't have the knowledge.
Yeah, Amanda is like, I went, what? Yeah, you say like, but I know Eric make 28 times, but how? You have that kind of question mark, right? That was what happened to me when I saw like Derek
Yeah.
when I saw some of the people is like doing options, like, how come y'all can do this? Of course, now I can explain. And so I'm going to explain with my case study, okay? This is the case study. I'm going to do a bit slow, right? Because I understand with this case study, okay, you might not understand. It's okay. So just get to know the idea behind it. Then after that, you can always come for our VIOS Plus. All right.
MIP grad can sign up, right?
MIP grads can sign up at the special rate.
Yeah.
Okay. You are considered the full edition program. That's why it's always good to come for our programs early. When I come for the MIP many years ago, a lot of things are unlimited. Really. How many of you really agree with me? Until now, today, your coaching is unlimited, right? The MIP grads every Tuesday. Okay. So let's move on to the LMND. Lemonade. You see, this is the options that I've done. I will go slow, I promise, so that y'all can understand how bit by bit, okay? Yeah, I will talk slow this time around. Okay, so, all right, so you will see over here, there's so many square, circle. What does that mean, okay? So Lemonade, I'm not going to go into the full details of the analysis. If you want to know the full details of the analysis, what Lemonade does, because I know some of you who are not our graduates, you may not have heard of this case study. Lemonade is not selling like lemon sparkling water. All right, I just want to highlight this. They are in some, they are actually selling insurance, yes. But it's not just insurance, it's insurance tech. Yeah. Okay, something like a fintech.
Yeah.
Okay, so I've downloaded the app. If you want, you can download the Lemonade app. Then you will know roughly what they do about buying insurance online. You can sell it online, and it is very easy for people to buy and sell insurance without going through like an agent. Okay, so that also helped them to bring down the cost. Okay, so simply, if you want to find out more about Lemonade, okay, go to your V app, right? Okay, so I'm just going to share with you the principles behind what I've done. Okay, how I generate that cash flow. Okay, so I'm going to explain. You see the first square at the left-hand side over here, right? So I'm going to show you in circles. So you see this is LMND that says the laminate. What did I do in September, October period? I can't remember exactly what is the date. It should be in October. Okay, when laminate after, you know, the good thing about every time I love about Derek saying the case study, because he said it, I think, in October period.
September actually.
September, late
29th
September,
December,
October,
29th, yeah.
yes. Then it crashed. Whoa. I always like it after Derek say already.
Derek he always have the joke. He say, you know, yeah, every time I say a case study, after that the price will crash first.
Yeah. So I said, good man. The price dropped. Okay. So that is where I did and what we call a sell put. And what I did was, I did a sell put with the expiry date over here. You see 20th November. So for those who are new to option, follow me closely. I'm going to repeat that. Follow me closely. What I'm doing. So you can see over here, right? 20th November, that's my expiry date. And this one is at $60. Okay, you can see I wanted to buy $60. I did a sell put and with 100 shares. So you will not, let's say, if it drops to $60, I would buy the share at $60, which means in total, 6,000 US dollars. Okay, so I intend to buy the shares because I know at that point of time, it was undervalued. Okay, now what was my premium? Take a look over here. For every share at that point of time, it is $5.69. Now, this is where I want you to do a little bit of a work so that you can follow me, okay? Now, $5.69, if we talk about 100 shares, that means in total, how much did Pauline get in premium? Everyone, 5.69 times 100. How much is it? Everyone type in the chat. So you roughly know how much I've collected in that month for my premium. Thank you very much. You are so smart, everybody. 500. Oh, Linda, you even calculated the percentage. See, this is the beautiful thing if you know what I'm talking about, right? Okay, so this is where you can see I've collected $569. So you can see, okay, over here, I've calculated the premium for you to see. Every premium I collect before I buy the shares. Okay, I'm going to repeat that. The premium I collect is before I buy the shares. I collect for every share $5.69 times 100 shares. I collected $569, which is 765 Sing dollars, which is about like 2,300 ringgit. I convert it for you, so you don't need to convert. So it means one of the things I want to highlight is this. Do you realize $765, just now we talked about, like let's say the VIOS Plus program. If you use 2,499, plus the GST, maybe divide by 36 months. It is definitely less than 765 lah. Okay, so you have positive cash flow. Don't worry, your premium can pay off for your cost fee one, confirm one. Okay, so you do this right. All right. Then after that, you see it's 10% return. How many find that 10% is really good? Type of good over there. Okay, type of good. Oh, Ken just calculated for me. So the monthly installment only $74. Hello? $74, you make it 10 times. Good, right? Okay, so after that, I sit down there and pray hard. Why pray hard? Because Pauline want to buy the shares. So I thought I have no chance to buy the shares because the day before, when I take this down, the left-hand side, this part, do you see it's at $62? Okay, when I take this, it's at $62. I thought, no chance already lah. Okay. Okay, can't read the chat because we want why? Because we don't want to slow down the system. Okay, but never mind. Y'all know what I'm talking about. So I said, no chance already. Then I tell you what, that night somehow my prayers are answered. I got the shares. It dropped to I think $59 or $58. I bought at $60. Okay, so I bought at $60. Then after that, you know what happened? Okay, so I got the shares. Happily, Pauline has the shares in November 20th. Okay, November 20th. Then how many of you want to tell me what's the share price right now? What's the share price? Type it in. You can see from your VApp. The share price as of the last closing, 153, correct? Not?
Yeah.
So you can see from the slide, at that point of time, okay, when I actually download this, I still have the 100 shares. Okay, so can you show the slide again? Yeah, you can see over here is $172 in my slide. All right, please show my slide. Thank you. It's $172, correct? So what happened is this. It was actually before it dropped to $153. All right. So what happened is, you see, so my ROI is like 188%, right? So, but it's not just 188%. You have to understand, Pauline still collect the 9.5% return. So I actually got 198% for less than 3 months. Okay. Then after that, it went to about $180. Ken actually wrote something. Those who are in the IW, you have the first piece of news. What did Ken say? Anyone?
Infinite
Wealth
Mentee,
one.
anybody?
Those who follow Ken on the V app.
Those
he
are
said something.
mentored by me one. What did I say?
Yes, he said capital recycling, right? Correct. So what I did was, see, this is the thing. With a 200% ROI, then you say, yeah, remember what Joshua said, remember what Daniel said, right? So now it's like, wow, shoot up like within 2 months, I mean, I think it's a good company. I think it will go up, but I didn't expect it to eat steroid, Really, I didn't expect you to eat steroid until what? It's like one night I sleep, the next day I wake up. What happened? Why is it suddenly $100? So yeah. So what I did was at $180, I sold off. Okay, see, everybody learn this step. Okay, called capital recycling.
Yep.
Okay, now that's the beautiful thing. Okay, so you're afraid what is shoot up, right? So what happened is Pauline sold off 35 shares at $180. So everybody times use 35 times 180. Have I taken back my US $6,000? Yes or no? Yes or no? Everyone.
Definitely.
Yeah, easy maths, not very complicated. Even those who don't know how to do options.
Well done, Raymond. Well done.
Raymond, you did the same thing, right? Yeah, this is the thing, okay? Jean also, right? Yeah. So this is why I said, once you are in this, you are very rational one. Okay. No, I don't want to sold off everything because I sell off everything just in case. Will it go up more than $180? If it's a good company, there is a chance. Because, if I sell off everything, how much do I take back? Maybe at about $180 times like 100 shares is 18K. Can I take back 18K? The answer is yes lah. But if I take back 18K, my next question to me is this,
what are you going to put in?
Yeah, where am I going to put in?
Yeah.
Correct or not? So since I've not thought of where I'm going to put in, I just sell back to take back my capital. Okay. So this is called what I call the kia su kia si method in Singapore. That means I still can make money. I don't lose a single cent. Yet I don't forgo just in case it goes up more than $180. If not, I will really really hit my chest. For those who actually sold off your Square and your SC, you know what I'm talking about.
But the most also to add one point to what Pauline just mentioned, right? This capital recycling have a third advantage. The third advantage here is just in case the company or market correction.
Yes.
The price actually come down more sharply. Now you have the existing capital of 6,000 to go back in and actually to deploy and buy more.
Precisely. Okay. Do you see right now, Pauline has only like, let's say 65 shares left. Now it's $147. You might have said, oh, Pauline, you time correctly, ma. No. Okay, a lot of people thought, wow, I really every day, bye like that, go and pray hard and say that this is the highest price. No, it's just because I'm very rational. I know what I am doing. Okay, so this is where I'm gonna ask you the next question. What do I do with the $6,000, guys? Now I take back 6,000 capital, right? What do I do with it? Everyone, type it in. What do you think we should be doing? Do we spend it? I mean, cannot go on holiday, ma. Right? Yes, thank you. Sell put again.
Wow,
give yourself a round of applause.
Wow, really very good. Wow, very well mentored.
Yeah.
I'm quite sure this one is a VIOS Plus or Infinite Well Mentee one.
Okay. Can I? Right. Then this is what I do. The next step. So you can see. I believe this one is better. So in this case, now you can see me plus the slides. Oh, so good. Hi. My slides normally the words very big. You can see very clearly one. Because I got lao hua already at this age. That means I cannot see small stuff. That's why I'll put the font very big. So what I do is I use more advanced strategies at that point of time. Okay, I'm going to show you something. Because I told you LMND Lemonade, the share price dropped drastically. So some of you say buy call. We can actually do buy call. Okay, that's one of the things that we can do. But I didn't do buy call. What I did was, instead of buying a call, I did something else, which is, okay, you can see over here in the slides that Pauline actually did what we call a long put. Okay, this is the more advanced strategy. Those who are in the FE program, the full edition program, okay, you would have seen that we didn't teach you this strategy, huh? Okay, so this is the more, that's why it's taught in VIOS Plus. It's called the long put. Okay, if you want to find out more, this is where you get a lot of cash up front. Okay, so I actually do a long put whereby the expiry date, as you can see over here, it is in March 21, which is like 2 months later. Okay, but I only did it like in October during that crash. Yes.
Wow. So the strike price is $50.
Yeah, the strike price is only $50.
Wow.
Okay, and then after that, I take $13 per share, which means how much did I take? Everyone, I take $13 times 100 shares. How much Pauline collect again? Sorry, Pauline is a money magnet, if you realize. Okay, 1,300, cool or not? So I stand by my $6,000 thinking that I can buy at a $50, right? Maybe I may buy because it's not expired yet, just in case it dropped. Okay, it dropped to $50. You see, I can recycle that capital to buy for every share at $50.
Wow.
But then again, frankly speaking, do you think I'm able to buy at $50? Everyone, make a guess. I mean, I don't know lah. You might want to make a guess.
The share price currently is 150 lah.
Yeah, the share price is currently at 50.
You have to drop about, I think, 70 to 75%. I think that was a major crash for this company.
Right. So that's the thing. So do you realize the $13, the $1,300? Can you please type in these two words called free money? Free money. Yeah, most likely not lah. I think so. Unless something happened to Lemonade lah. But I don't think so. Looking at the situation right now, people are still buying, in terms of it. So you see, I got a $6,000 now as capital. I got another $1,300, $7,300. Can I buy Huya or not?
Okay, Pauline, the way you go, I can tell you some of them really, the mind is like, whoa, overdrive already.
Okay, Amanda asks, can we still buy LMND Lemonade at $148? This is where you need to know the valuation.
That's where we can mentor you, yeah.
Yes, that's why you see, if you ask me, okay, maybe I will do something else. All right, yeah, that's why I asked about Huya. You remember I asked about Huya? Okay, I give you the hint already, Okay, don't say I don't give you a hint. Okay, so some of you say, let's say you don't have $6,000. Huya only $20 per share, okay? Yes, so that's what I'm saying.
Some of you ask, example, let's say, how to join Infinite Wealth Program. Infinite Wealth Program cannot join one. Infinite Wealth Program, you need to actually pass a certain criteria in order to be so-called selected in. Okay, because we only want to, we can only mentor people, mentee who are actually what we call high desire level. Yeah, because Infinite Wealth there's really massive action taking. Right? So if you want to find out a bit more, okay, maybe we can share, tomorrow, but not now. So any question? Yeah.
Yep. So actually, I have these questions for you guys is like, how much capital I have and things like that. But, you all have actually calculated. So no point for me asking those questions. If you all want to see the kind of gains that I've collected, it's like an infinite gain, Yeah, I've got my stocks over there that is actually pure profit. I've got my 6,000 collected back, which I can stand by to buy additional stocks. I've got my 1,003 premium, which I've actually collected. I've got another premium that I've collected in $569.
Yeah.
I just want to ask the last question. Is my risk high or low, everyone? High or low in doing this? Do I keep my risk high or low? Low, right? Yes, thank you very much. Those who have seen this would realize if you have actually a better, more strategy, okay, the risk after we take, in the first place, when I actually do it with a $5.69 in terms of getting the premium, I already make my break-even price minus $5.69 already, which is like a $54.
Correct.
Which is even lower than the $60.
Correct.
So I have a lot of buffer in that sense. See, this is the thing. We do value investing. We look at the 3R. So let's say you have the V app. You have the V app, you will have heard of Lemonade lah. Don't tell me you have not. If you have not, that means you didn't come. So not my problem already. Okay, so you have to attend, right? So you have your V coaching. Anyway, it's free. Those who subscribe for V app, what's stopping you, right? So every Tuesday we have that those case studies.
Yeah.
Yeah, and we have more. Okay, so you don't need to buy Lemonade. There are more, right? Okay, so then the other one is you learn about value investing. which you have the 3R concept, you know how to value the company. And then after that, we talk about options, okay, which we will share with you in a full edition program, the simple way of doing option, which every month.
Yep.
For free, also, you can come and do options. Just that one. Let's say you don't want the VIOS Plus. You just are our full edition or MIP graduate. You know, a lot of MIP graduate don't really come back.
Yep.
Come back. You have your unlimited session, you know, every month. Just look at your Singapore calendar, okay, or your Malaysia calendar. And then we will share with you which are the stocks that we look at. You can do your options. In fact, the options can fund, let's say, your next VIOS Plus course. Then you can know how to do, like, for example, Derek will show you more sophisticated strategy. I'll show you one of the many that he shared with you. Okay. Yeah, and it's just a very simple strategy. We just make money like that. Right?
Yep.
So we are supposed to answer question. I talked too much already. Okay.
No. It's good. You can continue.
Yes.
So
yeah.
I think Debbie asked, is VIOS Plus class conducted virtually or physically now? Now, Debbie, VIOS Plus class currently is virtually. Okay, because Derek conducting it is stationed in Malaysia at the moment. He can't fly over, so it's virtual. Okay. Yeah.
Okay. The thing is, okay, first question, how is options premium being determined? Okay, you come for the VIOS Plus class, Derek would share with you, Ken, because there's somewhat implied volatility, blah, 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 things like that. By the time I explain, it's like a full course already.
Yep.
But the simple answer is this: you do not need to determine. It is there in the thing or swim. You just click. They stated one. All right. But there's of course some calculation that they did the calculation. Okay, so you just click over there. You see whether it is it makes sense or not. We'll teach you how to calculate whether it makes sense or not. Normally, every month we collect at least a 2 to 4%. Okay, at least I tell you, can you imagine every month 2 to 4%? Okay, then your 1 month, your 1 year is like easily 20% just on options.
Yeah.
And I'm not even talking about stocks. I still have my stocks that has a 30% last year, you know, in terms of the return. Add together 50+% for someone quite lazy like me. Actually, I do options only once a month. I'm not like Ken. Ken always asks me, Pauline, how come you don't post? Then I say, I only do once a month. After I do, I sleep. Okay, so I didn't even sometimes monitor. Then I get it lah. Then I got money inside my thing or swim. Then I just buy shares. So that's what I do.
So there's a question here. I think it's a very good question from the various chat itself. The first question here is, may I know how do you guys continuously discover new potential company, okay, to actually look at? Very good. I think, Pauline, this is a point that maybe you want to use a VApp screener to show them.
Oh, yo, VApp screener. Okay, you want to answer the next question while I open up the VApp, okay?
Okay. Good. Now, so this question, next question here is, when the stock price of a good company retracts, but is still above valuation, will you invest in it or stay away and potentially watch it take off without vesting and interest? Very good question. Now, the answer to this question here is, okay, I repeat the question just in case you didn't catch it. When the stock price of a good company retracts, but is still above valuation, will you invest in it or stay away and potentially watch it take off without resting and interest? Very good. So now my answer, and based on my limited experience, okay, is this. 3 things I depend on. The first thing is the investment horizon. So how long do I actually take in view of my holding of this business? Do I believe this business will continue to grow, have a competitive advantage for the next 3 years, 5 years, 10 years, or even longer? So maybe longer, hard to say lah. So when I look at an investment idea, right, I always ask myself, will this company still be around in 5 to 10 years time? Very important, right? So with this horizon in mind, then I move on to the second evaluation criteria, okay, which is, what is the so-called growth rate of the company? Is it what we call a hyper growth? When I say hyper growth, it's like, you know, the revenue top line is growing like massively 50% to 80%, even more than 100% a year. Okay, so because that makes a difference. Or are they what I call belong to what I call a category leader? Category leader means in the VApp you'll see usually they are gorilla. Okay, they are very dominant in the industry, very well established. Give you one example. Guizhou Moutai is like one example. You don't expect Guizhou Moutai because they are very big already. You don't expect Guizhou Moutai to grow their revenue by 100, 200%, okay, on a year-to-year basis. But I do expect Guizhou Moutai to grow at least according to China GDP growth rate or above the China GDP growth rate. Because when China economy grow, the consumption expand, increase, more people will buy more premium product. In this case, Guizhou Moutai, Baijiu. So I will expect the top line will grow by maybe 15-20% a year, which is very good already. So this will ultimately impact onto actually the valuation, okay? Because see, if a company can grow what we call, when I mentor our Infinite Wealth mentee, our Infinite Wealth mentee, we all look at only one category of company called hyper growth company. The reason is because our objective is to use very small capital to 3 times, 5 times to 10 times our capital within 3 to 5 years. And only hyper growth company can usually do that, because when they are small, before become big, so they have a runway to grow, right? So now, if a hyper growth company that's growing very fast, even at sometimes they are more than 50 to 100% above valuation, right? I will still buy them. Okay, I give one example. Right? Never mind. Let me see. The example maybe I will give during tomorrow, the special session. Never mind. Tomorrow special session, I give the example. Apart from the 100%, 100 times growth company. But tomorrow, the 100 bagger is a good example, which is hyper growth company.
I tell you, they all were like that. Then the share price crash, bow, because you said don't share anymore.
And when they cannot like that. No, but
I'm also anticipating. I was like, the PO bomb dropped
no,
down.
but I'm not done yet, right? I'm not done yet. So it all depends on that. Well, then come for sign up for VLS Plus lah. Then you can come for the special session tomorrow already. There's so many things you can know, right?
You're smoking more lah. Then sometimes you will
So
say
the third thing, I'm not done yet. Third thing, okay, the third thing, what do I actually depend on? Depend on the portfolio that I have in terms of my so-called option on other stock. So example, let's say if I have 2 good companies, okay, one is overvalue, one is fair value or slightly overvalue. So where do I actually allocate and their growth rate is comparable, right? So where do I want to allocate my capital? Of course, I want to move towards to the fair and slightly overvalue one, as compared to actually more overvalue by 50, 100%, right? So that is from a risk perspective, because you have choices to evaluate and choose really, ma. So I repeat, 3 things out. This is how I see it. First, okay, the investment horizon. Second, what type of company are they? Third, what is the choices that you have in your portfolio right now that you can allocate? Okay, yeah.
All right, thank you. So 3 things you need to take note. So now take a look at my screen, because I'm going to show you regarding how to do this thing called screener. And this one is in the V app. So you just now that question was up, Ken, how you all find? There are 3 ways to find companies, okay? So first way is definitely, we always say within our circle of competence. That means in the stocks that I know. For example, let's say, oh, I'm a shopping queen. A lot of people know I'm a shopping queen, okay? It's true, okay? I'm a shopping queen. So let's say, oh, I know Alibaba very well. Okay, so Alibaba that time got news, what Ma Yun went missing, blah, blah, blah. Then you say, wow, good opportunity or not. Wow, undervalued. Then after that, wow, you bought at, let's say, just like how many? Within 1 month, just 1 month ago. Wow, dropped to 220. So in less than 1 month, now it's $260. Everybody type in what? Okay, everybody type what? HUAT. Really leh. Right. This is within our circle of competence, correct? Not okay. So after that, after within our circle of competence, then how many of you also like me, right? Okay, bought at 220. Then after that, you say actually, sorry, I bought actually lower than 220. I have to tell you that. Okay, then after that, you say that okay, I finished using my circle of competence. No way to actually find out. Never mind. You do screener. Okay, so this is the part I'll go a bit slow. So in the this VM, you will see over here, there is this part called screener one. Okay, so you can see, so I've got to refresh it. How to refresh it? Okay, I'm going to type in something. Okay, so this you see got the part called screener, right? So you click on under invest, there's this part called screener. So those who actually came for our VIB, you would have known that I have various screeners one. Okay, I'm blowing it up a bit for you. Okay, so I've got screeners like, for example, on REITs. Okay, I put in my criteria inside. I've got screener for growth stocks. For example, I'll just show you the growth stocks lah. So like over here, there are 74 companies. So what I do is I actually put in the criteria. Okay, so there are 25 stocks in the exchanges. Okay, I'm not 25 stocks, 25 stock exchanges. There are more than 42,000 stocks. Okay, so you can go to the screener. Then after that, all right, I will put in criteria. It's just a one-time setting. Blah, 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 put in the criteria. Then after that, I will just roll it. No? After roll it, then it will start. Okay, yeah, it will start. And then of course, because I only put in like Indonesia, Singapore, because your majority of you come from Singapore, Malaysia, Indonesia, the Southeast Asia market, and then you want to invest also in US market, right? So this is why I put in the 5 exchanges. Of course, you want to put more. If your plan can allow you to put like 7, like the V Pro, of course, feel free to do so. Okay, so from there, I find like, all these companies. Let's say if I don't know what's called Medifast, I click. Okay, so after I click Medifast, A, B, Pi. Sorry, I also invested in Medifast. Okay, what happened? Why you didn't? Sorry. Okay, so how do I do? Okay, here. So you can see 10 years. This Medifast. We actually invested only for like 2 years only. Okay, so those who actually come for Infinite Wealth, you have heard of my Medifast case study, right? That time some of you say you don't understand. Hopefully now you understand. Okay, so you can see over here that you can do all the analysis, even the company information. Let's say you don't know. Go and read Medifast, what they do, blah, 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 blah. So how many of you heard of this brand, Optavia? I've got a few of my Facebook friends actually do this. Well, show me about what slimming lah, whatever lah. Okay, so these are the things, okay? Ladies will actually show all these things one. So definitely we all know. We have tested various ways of slimming products. Okay, so we know all these things. You want to find out more about the website, just click on here, website. Then you can also take a look at the star chart. So this is what I do. Whoa, the star chart not bad, huh? Okay, like growth, health. Almost full marks. Okay, yeah. So then they say, so undervalued, overvalued, not going to show you. You go and click yourself, okay? Yeah, because I know everybody will say, can you show me whether undervalued or overvalued? Okay, no need. You have your V app, you see yourself. So this is what I actually do. You can see over here, I also have one more thing. Sometimes I don't have I told you I'm quite, not say lazy, but I want to have an efficient method. Let's say even VIOS, I got one, I've got one screener just on VIOS. Okay, so I will just put in a criteria, and then every month, when after my last premium, let's say I got a lot of free money, ended already, right? So I know, okay, all these stocks, because stock market, as you know, a lot of companies that we want to buy, like for example, that time I've been wanting to buy like Facebook, Alibaba, it keeps going up. From $150, I've been doing options for Facebook every month. I religiously do Facebook options from 150 to 170 to 200 to 220. Really, I very on the ball one. Every month I want to buy. Every month they give me free money. Give until I tell you, my break-even price was like $100 over only. So I take a lot of free money from Facebook. Every month I just take free money. Okay, so almost my Facebook is going to be like free shares, you see, because I take all this premium. So that's why every month I just have this. Then I see, once a month, which are the ones that meet my criteria. I'll actually put it. What criteria did you put in the VIOS? Okay, if you want to see quickly, chop. I show you, y'all take picture can or not, all right? So this one, bonus, I don't intend to share one. Okay, everyone want you take picture over here. 1,000, 2,000, 3,000, 4,000, 5,000. Okay, below, take picture. 5 seconds, Okay, because it's a bit big, 1,000, 2,000, 3,000, 4,000, 5,000.
Pauline, they take picture our body inside.
Never mind my body quite good.
Okay.
We train very well. Okay. So my criteria over here. Don't say I don't share, I share for you already. Okay. Yes. So after that, I click start. All right. So this is what I do. I've got my criteria over here. So this is how I save time, you see. So every month, we want to find ideas. Of course, what's the third way?
And going forward, just to remind you all, going forward, we're going to have a notification feature. So once you set these parameters for screener, right, you don't have to reset it anymore, because the system will actually notify you if new company is being discovered based on the criteria that you set going forward. So it will save you a lot of time. So you will constantly get notified if there's new company that fulfill your criteria in those exchanges you are actually interested looking at. Understand? If you find this is a good feature, can you type in a good so that I know that you understand? Yeah.
Yes. So while everybody's typing the good feature, there's a third way that we actually do it. For example, if you see I do this kind of criteria, Lemonade did not come out. Okay. So how come I know lemonade is actually from Derek. So the third thing that you need to take note of is this thing called community.
Yep.
All right. I believe many of you, if we don't talk about Fastly, if you are not in a, I want to ask you this question honestly. If you are not in our community, will you know Fastly? Yes or no? Type in. If you are not in our community, would you know Square? No, right? If you are not in our community, would you know Lemonade? No. So this is the beautiful thing about coming into the community. Why? Pauline only knows shopping. So you ask me to buy shopping stores, I'm very good, okay? But I've got some people who are very good at technology. For example, I'm sorry, I'm not very tech person. So I need the help, the support from, let's say, like Derek, like for example, Alex, and the young people like Ming Yao. They are very tech savvy one, okay? So I actually get the things from them and say, oh, got this kind of company. Okay. Then after that, the ideas are there, right? Then after that, we go and study it. So that's the reason why community is very important. I keep telling people, do not do investing alone. Yeah. You see, a lot of people like to say, never mind, I come over here, then I see, then I do it alone. You do it alone, really. How much do you know? Frankly speaking, right?
So
do it
that's
with the
next question.
community. Yes.
Next question here is, I tried buying option in a particular day, but it did not go through. So when should I put to buy? Should I buy only one equal to 100? If I then now how many return? Okay. So your question got two. First is, let me answer your second question first. Now, one option contract equal to 100 share. So if you only want to buy 100 share to own 100 share, right? Example, you just only put one. Don't put 100. 100 means you want to own 100. What? One 10,000 share. Okay, 10,000
right? Share, that means 100.
Yeah.
100 options.
100 option. Don't put 100. If you don't want to, you just put one can already. One equal to 100 shares. Okay. So now, one option equal to 100 shares. Now, next is, now my method is, I sleep quite early. So I sleep even before the US market open. So how do I actually make money from option and actually US stock? Simple. I use this method called GTC. Stand for good till cancer. So even my option, right? I also work. Sometimes the option that I want, the premium one collect, right? The market don't have one. Maybe let's say I want to collect a premium of, let's say, $5. The market right now only can actually offer at $4.50. So what do? I put a GTC at $5. Now that I just close. GTC stands, like I said, stand for good till cancer. So then you just let the market, actually the share price, the option premium price go up and down, all these things until you hit, then automatically you will fulfill. Right? So I don't even need to actually look at it. So that's the beauty of the GTC.
But remember, if you put GTC, you remember, because sometimes it didn't hit the share price until like 6 months down the road, then you forgot about it. Okay, or the options. Then say, actually, I don't want already. Okay, so don't put out there and then you forgot about it. Okay,
but we will all this we will guide you lah. If you come for VOS Plus a session, we're training. If you are Infinite Wealth mentee, of course, my mentee definitely you know lah. Okay, how I train you. Okay.
Okay, there's another question which is really important. What is the downside or risks of options? Okay, now, I can't really tell you like that. As much as I want to brief you what are the risks and the options, really it's all about the stocks investment. And when you look at Derek's strategy, he has a lot of strategies that you can do things like, for example, certain call, certain sell call, diagonal call, whatever, vertical call, those strategies, there are some risks involved, but it's very low risks. Of course, you have to understand, Derek, when he came for our VIB class and as our VIB graduates, he is only a student. How much does a student have? Right? And then after that, he start work. Okay, he start work, and then he work in this place called V College. He earn ringgit for your information.
Yeah.
So he earn ringgit, go to US market to actually buy. How much, like for example, okay, he cannot be compared to me and Ken. Why? Because we are in our 40s already. We are not young. We have worked for like 20 over years. Okay. He just start work. He's in the 20s. Right? So he doesn't have that kind of capital. That's the reason why he really drill and do a lot of things to see with limited capital. How can I keep my risk low, yet my returns high?
Yep.
This is what he is good at. And because he has that thing in him that I have to make my capital, things like that. I don't have much capital. How do I do it? And someone with ringgit buying to US dollars. That's why it works.
Yep.
That's the beautiful thing.
Yep.
So as I mentioned, are there risks? There's a bit, but you know your risks are being capped. Okay, because Derek, in the first place, you have to ask him. He got a lot of money to lose. Also, don't have what? Not much of a capital, right? So you ask Ken got a lot of money to lose. Maybe yes lah.
Hey, wait. I have money doesn't mean I want to lose them. Sorry. Okay, infinite wealth grad. If you infinite wealth mentee, if you hear this, don't get the wrong belief system. Have money doesn't mean you can lose them. We still need to protect our downside. Okay, so we need to take care of our risk. If we can take care of our risk, our return will take care by itself. So my mentee, you will know. Okay,
We'll
this is what
gonna slap. Yes, Douglas said. So you have to know, even though at this juncture, when both of us, we say that, we can take certain risks, but really we keep our risk still very low. That's the reason why I practice this thing called options, where I don't do options trading. That's the reason why we put in criteria. Do you realize that? Yeah, we said you must actually come for our full edition, where we have gone through certain emotional stability modules before we move you up to another level, okay, called VIOS Plus. Can you make quick bucks in VIOS Plus? The answer is yes, definitely. With limited capital, yes. But there is this thing called greed that might comes along. That's the thing which, once you know in our FE program, you would be able to appreciate better and control your risk and the downside better.
Yep.
That's the reason why. It's not about just, what is the downside and the risk of options, things
you
like that.
experience it.
Yeah, you experience it. It's the emotions.
Yeah.
Yeah, okay.
And if you and another just answer, you want to find out what are the good companies to potentially to buy, right? Okay, example. Okay, how many you find just now Joshua, the V Quant Fund, very impressive. If you find that just now earlier on Joshua present the V Quant Fund is impressive, can you put it impressive? Yeah, just put it impressive. I want to see first. Okay, impressive. Okay, I want to see the response. Okay, because the return really last year, the stock pick they have 60 companies, right? The return so far 147%, outbeat the market index, okay, by a far miles, So some of you actually, that's how I saw the question here is, I'm not a accredited investor, how? Okay, how do I actually leverage on this? Okay, so now we're also thinking away. So one of the way here is just thinking only. Now, that's how I believe Joshua actually give you a link, right? A link to actually for you to actually indicate your interest in the V Quant Fund. Now, please submit in the link. Even you are not a accredited investor, you just say that in your answer, say I'm non-accredited investor, but I'm still keen to find out about V Quant Fund, because we might be able to come up with something for the retail investor, okay, to take part on. Maybe not in the fund side, not in the fund side, not in the fund side, okay. Maybe it's like a service for you to know, okay, what is a V Quant Fund portfolio on a consistent manner. Example, okay, or we can use the algorithm that V Quant Fund uses and produce, okay, what we call a short list of company and update it regularly. Okay, it's like a copy trade service lah. Okay, you understand? So this one is for non-retail, non-accredited investor to leverage on, so that you know constantly what are good company that the so-called the V Quant Fund is actually looking at. Okay, or the parameter of it. So can group IC, can you put a V Quant Fund link inside here so they can actually submit? Can you put in the V Quant Fund? Yeah. Okay. Thank you, Amanda. Can you? Yeah, thank you. So this is the link of the V Quant Fund. Just submit in. Although you're not a accredited investor, don't worry. Just answer the question. Just say I'm not an accredited investor, but I'm keen to find out more about V Quant Fund. Okay, there's other ways to actually support you. Okay.
Okay, have you answered this question when the stock price of a good company?
Yeah,
okay.
answer already.
Answer already, yeah?
Yeah.
Okay, any more questions that for
Nope.
us to answer? No more?
Mhm.
Okay, so ladies and gentlemen, do you like this session of us sharing with you in terms of the real stuff? Because we don't want to just give you theory and theory.
Yeah.
Too much of a theory, actually, you all might say, yeah, I know all these things. People talk about it. But how do I apply it? So if you realize the V Summit, and the beautiful thing about V College is we stress a lot about this word called execution. That's why just now Ken mentioned, right? To learn, you spot it, and then execution. We want to make sure that even after the second day tomorrow, we are going to tell you more about execution, because once you have learned this, I believe a lot of all these speakers, they do have nuggets. Just like I mentioned, each of them, like, let's say, give you 4 nuggets. Okay, some of you want 5, some more. Okay, fine. All right, so 4 nuggets each. How do you practice it? How do you apply them? It is very important. It's not just about knowledge, but you need to make sure that it translates to this word called results. And results is definitely about financial freedom. Yeah. So of course, learning is one of the ways that you continue to be with us. Okay. Yeah.
And I want to add on to the first day of Value Investing Summit 2021 is, you guys are simply awesome.
Yes.
You have actually been very patient, very kind, okay, very compassionate, yet display a fighting spirit to continue to learn in this journey, never give up. That is the kind of competitive spirit that we have. Okay, we know that today maybe the resolution is not too good, maybe their audio or video out of sync. Sometimes the video don't play, or sometimes the audio don't play. Okay, but you guys are still so appreciative, and here into the first day give our team so much encouragement, and because of that itself, that you continue to learn, you give us more motivation, inspire our team to actually do better, to serve you, to find more case study, to come up with better tool, to use more technology to help you to actually generate more alpha, more return, okay, and make your money work harder so that you can achieve financial independence and financial freedom. Thank you so much. And I'll see you, the whole team, okay? We'll see you tomorrow on the second day.
Yes.
Okay, at 9 a.m. Please be punctual, okay?
Yep.
Awesome.
Tomorrow, what will be the focus on? We will have invited quite a number of overseas speakers, and they will all appear tomorrow. Like, for example, Steve Torso, Oliver Ripple. I tell you, Oliver Ripple, he's going to have a panel discussion with Ken, and he's in a company called Nesper. If you want to know this company called Nesper, you go to V app, all right? And then you type Tencent. Okay, you go to V app, you see Tencent, and you see who is the biggest shareholder. It's not Ma Huateng. Okay, it's not Ma Huateng. It's not the CEO. It's not even the founder. All right. So then you will know why we invite this guy over. And Tencent, let me tell you, is one of my biggest portfolio. So now you all know, right? I've been telling people that Tencent is one of my biggest portfolio a few years ago. So now with the share price, you know why I actually invested in Tencent. Okay. So ladies and gentlemen, tomorrow we are going to talk about a lot of things on multi-bagger. So you might have heard, Simi, what multi-bagger? Multi-bagger? You mean to bring back? No. Tomorrow I'll explain to you more about multi-bagger, because this is what we talk about when it comes to exponential growth. So ladies and gentlemen, thank you for joining us for day 1 of V Summit 2021. We hope you have enjoyed the session as much as we do. Tomorrow, same time, same Zoom link, we are going to let you really learn more about exponential growth. See you at 9 a.m. For those who still want to sign up for VROS Plus, feel free to do so, because you will get access to the video. Just now he did mention about the 100 baggers. That's not that he almost want to say one. Okay. So sorry you have to just watch the video tomorrow already. You didn't manage to con him to say it, okay? Right. Okay, so see you tomorrow. Bye-bye.